Second, he's going to describe his balance. We're going to do it together. We're going to describe our trading policy. We're going to describe our balance. But remember, semiconductors, we need to have them in America. Pharmaceuticals, we need to have in America. Cars, we need to have in America. And steel and aluminum, come on, America. Oh, and lumber as well.
And wine and champagne.
Important things for our national security.
And the wine and champagne, sir. Don't forget the wine and champagne.
This, come on, that's just that, you know, if you make him unhappy, he responds unhappy. But come on, let's get back to the core basics here, which is a trading policy that says America has allowed the world to lean on us, to take from us, to grow off of us, and now it's time for a little balance. We've got a $2 trillion budget deficit. We want to bring certain jobs home. Let the president do the right thing for America. He will respond after we're done organizing things to make sure the world grows. But today, just remember, he's the president of the United States of America. He's not the president of the world. He's going to take care of American workers, and it is time.
Mr. Secretary, I just want to make sure that the audience is in on our little joke there, because they might have missed the post by the president a couple of minutes ago. So I'm going to share it with them and then come back to you in just a second. So the president of the United States put this out on Truth Social moments ago, said the European Union, one of the most hostile and abusive taxing and tariffing authorities in the world, which has formed for the sole purpose of taking advantage of the United States, has just put a nasty 50% tariff on whiskey. If this tariff is not removed immediately, the United States will shortly place a 200% tariff on all wines, champagnes, and alcoholic products coming out of France and other EU-represented countries. So, Mr. Secretary, just to bring you in, I imagine you are aware of what the president said based on our conversation just now. Have you given the Europeans a warning on this? Have you given them a time limit to back away? Are you taking the same approach you did with the Canadians just a few days ago?
Well, I think the president has made it crystal clear that he finds this tit-for-tat really abusive and aggravating, right? His objective is steel and aluminum tariffs. Let him build his steel and aluminum business in America, because that's important. And then, you know, they say, okay, we're going to tax whiskey. And look, I find all this back and forth really off the topic. The key topic is rebalancing American trade. We're going to spend lots of time together, you know, but the president was totally annoyed that the Europeans did this. And so you're going to hear back from someone who emotionally cares about America. He cares about America, and he wants to take care of Americans. And why are Europeans picking on Kentucky bourbon
Secretary
or
Lutnick,
Harley-Davidson motorcycles?
Are you saying this is an emotional response?
It's disrespectful.
Are you saying this is an emotional response, or will we see 200% tariffs on wine, champagne, and alcoholic products before April 2nd, when the president says is the big one, and we're going to get the reciprocal rollout?
Well, the joy of my job is that Donald Trump makes the decisions, right? And the people around him, we talk to him and we advise him. April 2nd is when we do reciprocal tariffs. And he's called out these products. He wants these countries to respect him. And all this showed you is that Europe and Canada do not respect Donald Trump and do not respect America's ability to build its steel and aluminum industry, which is vital for national security, whereas you watched Mexico and you watched the UK be pragmatic and thoughtful, and the way we're going to deal with them is going to be better. So these are just black and white things. Why would you put against steel and aluminum, would you say Harley-Davidson motorcycles and Kentucky bourbon? It's just illogical. I think the president is saying, look, I am going to respond always bigger and always stronger. We will talk together. You know, he wrote that tweet this morning. We will talk together. If that's what he wants to do, we will do that. But the answer is April 2nd, a thoughtful approach to reciprocity and national security of those products he's called out. We're going to increase our domestic production of those and have a reciprocal model. And hopefully when I talk to the Europeans, they'll realize that they should take these things down, cool these things out, and let's properly negotiate.
Do you have plans to speak to your European counterparts today?
Of course.
Like who? Are you speaking to, let's say, Ursula von der Leyen, or potentially some heads of companies like Bernard Arnault, who was also at the president's inauguration?
Generally, as the Commerce Secretary, I speak to the trade ministers. That's generally how it goes.
But a lot of companies also, and I know executives, have been calling you, sir. Is that not correct? They're looking for exemptions. Exemptions, carve-outs, fall squarely in the Commerce Department.
So let's talk about exemptions for a moment. Steel and aluminum tariffs went in 2018. And when we came back into power, the Biden administration had granted 490,000 exemptions. Imagine 490,000 exemptions to steel and aluminum tariffs. I mean, I don't know that our department could actually collate 490,000 Christmas cards, let alone 490,000 steel and aluminum tariffs. I mean, come on, it's ridiculous. So yesterday, what we did is we just got rid of all the exemptions. That's all we did. The steel and aluminum tariffs were already on. We just said, look, let's just build back our steel and aluminum industry in America to protect America. It's so logical. It's so important. Yeah. And then all we get, you get some countries who understand and some countries who just go right back to old school. And, you know, the president's going to deal with them with strength and with power. And he's remembered that they like to respond with just go after their wine and maybe they'll pay attention and listen. But the fact is, April 2nd, we're going to go, April 2nd, we're going to go with a reciprocity, thoughtful, global process.
Secretary Lutnick, it's going to take a while to actually get those tariffs in place after all of the appeals process, et cetera, after April 2nd. And in the meantime, as all of these discussions around tariffs continue, a lot of businesses are just halting investments. You're seeing consumer sentiment decline. You're seeing their spending activity decrease. Can you give them a sense of when they'll have certainty?
The opposite actually is coming true. You saw Apple, $500 billion. You saw SoftBank, $200 billion. Eli Lilly, $40 billion. I'm meeting a company today who sent me a note saying they want to invest $65 billion in America. The scale by which American companies are committed to invest in America, and global companies
Secretary Lutnick, excuse me, what I'm talking about,
huge,
let me explain to you what I'm talking about.
Investments, and those are coming. Well, let me finish. These are huge investments coming to America. Over 1.7 trillion committed in Donald Trump's first 50 days. Anyone who thinks people are uncertain doesn't understand what Donald Trump is saying. He's saying, bring your production to America and you will avoid all the tariffs. Come build in the greatest economy in the world, and you will avoid tariffs.
That's maybe long term, but what we're seeing in the short term is that small business confidence has fallen to a 4-month low. They say a high degree of uncertainty about what the regime is going to look like. They talk about increasing likelihood of having to increase prices in response to the tariffs. You're seeing this with respect to airplane tickets that are falling off a cliff as of February. I'm just wondering, when you take a look at these types of indicators, at what point does it become concerning to you?
The greatest deal maker who's ever lived is sitting behind the desk in the Oval Office. He understands that the best way to get our farmers, our ranchers, and our fishermen's produce and products in the rest of the world, which they block it. I mean, India blocks our farmers. All these countries block our farmers. The way to grow it is to make deals with them where they have to understand the power of the U.S. economy is that you need to take our products. We want to unleash American ingenuity and the capacity to export. And when other countries put giant tariffs on our products, let's be clear. You can't go to Europe and see an American car. You can't go to Korea and see an American car. You can't go to Japan and see an American car, but you sure see their cars here. So the concept of Donald Trump saying, hang on a minute, you have got to be kidding. We need to unleash the American economy, and if we've got to teach the rest of the world to treat us with respect, that they've beaten on us and they have abused us, and their tariffs are so high that they've got to actually treat us with respect, bring down their tariffs so that it's reciprocal. Remember, they will never live with us having the tariffs as high as they have them. So what they're going to do is they're going to bring them down. Let Donald Trump run this economy. He knows what he's doing better than any president who's ever sat at that desk. Let him do his job. There's going to be a lot of talking, but in the end, there's going to be the greatest growth economy America's ever seen. We are going to export, and people are going to build in America. Those two things are going to happen, and they're going to happen because Donald Trump's going to create fair trade. Start saying the word fair trade, because right now, trade in America, go look at the numbers, unfair. Europe, huge. India, huge. Right? China, the highest. There's no inflation in these countries. What there is blocking Americans from doing business there, and Donald Trump is going to break down those walls.
Let's talk about China. So we heard from a foreign ministry official in China who said this, that Beijing has done the United States a favor, and Washington should have said a big thank you for all they've done to control drugs. And I imagine they're alluding to fentanyl directly. Mr. Secretary, I just wonder if the president has seen those comments in the last 24 hours and what his response is to them.
The president, as we have said, on April 2nd is going to take a holistic approach to everything. March has been the month to reduce the border and fentanyl deaths in America. And I hope to God China's reducing the production of the fentanyl ingredients that kill 75,000 autopsied Americans. And as the president rightly knows, that number is way, way more. We need China to stop making the ingredients, and we need Mexico and Canada to stop shipping them into our country. That is March. March is very, very focused on that. Hopefully they'll get down and we'll have a good reduced border. Obviously, that's so far so good, but we need to reduce those fentanyl deaths. And then come April, you're going to see us start to focus on lowering tariff away and increasing tariffs at home, so at least we get a little balance. If they want to lower them, reciprocal tariffs mean take them down, and we'll keep ours down.
Have they given any indication they're willing to do that? Because you've been ramping up tariffs over the last month on China. Have they given any indication they're prepared to do that? Just to stress test this theory, because tariffs have been ramping up on China over the last 10 years now. Any indication they're willing to actually step back and do what you're asking them to do?
You know, China is always a separate thinking. You know, the Chinese Communist Party thinks about things in a much, much different way than everybody else. And I don't know how they're going to deal with bringing these things down. I would like them to bring it down. They have a huge market, but remember, we consume more than 2 times what they consume. They have a big economy, but they're a production economy. They sell to us. They need to sell to us. We are the greatest consuming economy in the world. We are the customer that everybody in the world needs. Now, they've put huge tariffs in China because they're trying to build up their consumer production domestically. And that's where they stand. So you don't hear all of you talking about how horrible China is and all the inflation in China and all this sort of stuff. It's just not true. The fact is, America is going to build up its industries here, drive down tariffs there. I don't know what China will do, but my expectation is the whole world who trades with us will bring down their tariffs and allow our farmers, ranchers, and seamen, allow our production, allow our car manufacturers to export more and grow. We are looking for fair trade.
Secretary
Fair trade. Let's say it over and over again.
We got it. I think it could maybe be a bumper sticker for you. There are reports this week that potentially underway are plans for Xi Jinping to meet with Donald Trump. Are we expecting a meeting between these two leaders either in the spring or early summer?
I mean, look, the president runs his agenda, but from my perspective, when strong leaders meet each other, that is useful and effective for the world. But Donald Trump will make those decisions himself. I am focused on reciprocal tariffs on April 2nd. I am not in the agenda of who President Trump decides he wants to meet.
Secretary Lutnick, we're just 2 minutes away from the latest indicator from the United States, which is PPI data and inflation read and initial jobless claims. You've talked about how the data that we are getting right now is Biden data. At what point does it become Trump data?
I'd say we fully wear the fourth quarter, and we may well wear much of the third quarter. But for fourth quarter, for sure. You know, the American economy, right, a $29 trillion economy, you can't take office on Monday and have the news media say, oh, look what you did on Tuesday. I mean, come on, that's so silly. So the real way the world works is, for sure, the fourth quarter is Donald Trump's quarter, and the third quarter, his policies start to really embed in America. So that's the right way to look at it. First and second quarter are Biden's sort of left behind difficulty, and then you see Donald Trump dig us out, build us up, and by the fourth quarter, you're going to see growth rates because you got all these companies committing to build in America, get their shovels in the ground because we get regulations out of the way, start to produce those jobs, start to bring back trade craft. You know, electricians who build giant factories, HVAC specialists who cool those, and then mechanics who fix robots. You've got tradecraft coming back to America. It's going to be amazing. We're going to have the greatest training program ever because we need to train our great workers for the AI revolution and the tech revolution that is coming, that Donald Trump is bringing to construction and development in America. And we need to train our people, and they're going to have great jobs.
So going forward, do you just look through all of this weakness? You've talked about how, and we've heard a sort of detox period, et cetera. Do you look past all of the data in the first and the second quarters as simply backward looking and look forward to what deals are getting done?
My job is to look forward to what deals are getting done. I'm going to bring in, because Donald Trump has created the policies for me to bring in enormous investment to the country, 1.7 trillion so far committed. And we're going to put out a website and literally show these companies construction and manufacturing in America quarter by quarter to show this kind of growth. Remember, each trillion of this kind of committed construction is worth 1 point of GDP. So at 2 trillion, which we definitely will have for sure, that's a ½ a point of GDP for all 4 of his years. So as that grows, you're going to see that growth come into our GDP numbers. Obviously not today. Someone says, I'm going to build 65 billion in America. When can they get in? In the past, it would take 1.5 years to get the permits to build. Under Donald Trump, it's going to take less than 6 months. They're going to be in the ground this year, and the fourth quarter, you're going to see this power. So, yes, do I have to say the first quarter is surely Biden, the second quarter is Biden, but starting the third quarter, you start to feel some Donald Trump, and the fourth quarter, you will feel the power of Donald Trump's economy.
Secretary Lutnick, I'm sure you've seen this report in Politico. It says that White House officials, Trump outside allies are, quote, growing increasingly frustrated with you, sir, privately complaining about the close proximity.
You got to stop the fake news, please.
Oh, hold on,
God,
I want to give you the chance, sir, to respond to this.
Stop the fake news. I don't want to respond. When you read fake news, okay, I spoke to the president last night. He said, why do these people write this fake news? It's just nonsense. Imagine Jameson Greer, who's our USTR, who works with me, and obviously, if you remember when the president nominated me, he nominated me to say, go select the USTR and work closely with him. Anybody who says this kind of stuff, these articles talk about the Council of Economic Advisors. They're not even populated yet. The nonsense that we have to read while people just are trying to be troublemakers where it's entirely fake news, I don't need to respond, okay? I really don't need to respond. I speak to the president all the time. Our economic team is one. We are together as one. We get along incredibly well. We speak to each other all the time, including yesterday for an enormous amount of time, every day, today again. It's got to stop. I mean, look, these lousy, media outlets, they try to create something so that you'll talk about it. Think about it. They got you to talk about them. I don't even want to say their name. They don't deserve to be read because it's nonsense.
Out of respect for you, sir, we just wanted to give you the opportunity to respond, and in your own way, I think you have. Mr. Secretary, thanks for being gracious with your time. You've been very generous. Appreciate it. We've got to get some Biden data. Commerce Secretary Howard Lutnick there. Let's get to that economic data. I'm joking. PPI and jobless claims out just moments ago. Mike McKee has the information for us. Good morning, Mike.
Morning, John. I'm not sure this is Biden data because yesterday the CPI came out lower than expected, and the administration called it Trump data. Today, lower than expected. So let's see what they say about this. PPI comes in just flat for the month of February. The expectation was it would be up 0.3%. It was up 0.6% the month before. So a significant slowing in producer price inflation. The core is down 0.1%, and the core ex-trade is up just 0.2%. So on a year-over-year basis, headline 3.2% for year-over-year, and the core 3.4%, ex-trade 3.3%. These are all signs of significant progress on the wholesale level. Jobless claims, 220,000. That's down from 222 last week, and it does show there hasn't been much change in the labor market. Continuing claims, 1,870,000, down from 897,000. Federal claims for the last week, 1,580, which is a decline from last week's number, but we're going to start changing the data point that we care about and look at continued claims for federal workers. That'll give us a count, 8,215. That's an increase of 803 from the previous week. So progress being made. One other point for the PPI. A lot of the PPI is lower, but interestingly enough, steel prices, aluminum prices, both went up in the last month, perhaps in anticipation of the tariffs. And then the things that go into PCE, like airline fares were flat last month, same as the opposite of what happened with CPI. And so that should be good news for PCE, portfolio management, up by 0.5%. That will feed into PCE on a negative side.
Mike McKee, thank you, sir. So for the second straight day, we've had a softer than expected inflation read. Yesterday was CPI, this morning is PPI. Just want to draw your attention to the bond market. Just take a look at this. You'd expect yields to be dropping. They're not. Again, they're higher. On a 10-year by about 2 basis points to 433. I don't think these moves are large. I don't think they're big. But I think the direction is interesting and suggests that maybe the market is focused on something else. And that something else might be the threat of further tariffs. This came from the president just about 30 minutes ago. The United States will place a 200% tariff on all wine, champagnes, and alcoholic products from France and other EU countries. This was in a Truth Post social post just moments ago. The president saying he will place the tariff if the EU does not remove its 50% tariff on whiskey. I think that's the issue right now this market's got, Lisa. Just how relevant is the economic data going into the Federal Reserve next week when we've got the threat of policy changes that could completely change what this data looks like right now?
You're picking up on exactly the right thing, which is that backward-looking inflation data has less relevance than, say, the labor market cracking, which might give the Fed the excuse to cut rates. What you're seeing right now is disinflation. Yay. Otherwise, that might give a pass to the Fed. But what you're seeing is a labor market that's holding in there better than people expected. So instead of focusing on the disinflation, people are looking to the tariffs and saying, forward-looking, they're going to have a very difficult scenario on their hands. Front-end yields up, and that, I think, is notable.
With us around the table, Neela Richardson of ADP. Neela, good to see you. Good morning.
Great to be here.
Let's talk about this data. How relevant is it for the Federal Reserve, for anyone setting policy right now?
It's relevant because it gives us a baseline, and that baseline is strong. You see inflation moderating. You see the jobs market holding pace, unemployment low. So overall, the U.S. economy, despite the uncertainty and the malaise and haze of uncertainty, the U.S. economy is still solid. What we have to learn now how to do in this transition period is drive through the fog. Can we still grow? Can we still maintain? Can inflation still moderate? And importantly, can firms still hire when under foggy conditions instead of clear ones?
In the fog, people are looking for some sort of little lights to get a sense of what direction we're going in. And one of those lights was the guidance from some of the big airlines talking about travel, particularly from businesses cutting back. How much do you see that as an indicator of companies taking the first steps to trim costs before taking that extra step of cutting jobs?
Right. Well, we've already seen it in the data at ADP when we put out our national employment report. There is a hiring hesitancy, and that is completely in line with not knowing what the economic climate is. So you think about airlines and airline prices and business travel and whether the consumer, which has been trending softer and weaker as well, will show up at the airport. So while there's a lot of well-deserved attention on tariffs, let's not lose sight of the consumer whose spending has slowed in this interim, and they're anchored on higher prices, not necessarily lower inflation, which could mean that their spending patterns also slow simultaneously with this increase in uncertainty.
We were speaking earlier today with former New York Fed President Bill Dudley, who said this market seems to think that there's going to be some sort of Fed relief valve. He doesn't see it because he doesn't think the unemployment rate's going to really creep up all that much, and that is sort of the key indicator for this Federal Reserve to cut rates. It seems like initial jobless claims weren't out of the ordinary, 220 versus actually expected 225,000. Do you agree with Bill Dudley?
Yes, I actually think that you might see unemployment rates creep down and before they trend up again. If you look at the data, what it suggests is a certain stasis, and we've talked about this, a certain stability in the labor market, especially looking at ADP data, we see a stability in small firms. There's not a lot of turnover there. There's not a lot of separations. There's not a lot of layoffs, and importantly, there's not a lot of hiring. On the large firm side, higher turnover, which is consistent with an unemployment rate that is either holding steady or going down, as there's still some opportunities with these larger firms. So overall, the labor market picture is holding up. So there's not a lot of wiggle room for the Fed, because that holding up could turn into labor market tightness pretty quickly.
Why is this number 220,000? And I ask this because a lot of us were expecting to see the results of some of the DOGE cuts in these data, and we don't seem to be seeing a material tick up. If anything, the jobless claims went down.
These are early innings, and the response has not been completely incorporated into hiring decisions across the board. Also, this isn't a macro indicator. Really, the heat comes from the sector analysis, the frying grain data. So when you look at the data in terms of education, healthcare, you see a lot of hesitancy. In fact, a real slowdown in that sector in response to new decisions on federal grants to universities, hospitals, and social assistance. So these effects are going to ripple through the economy in different ways at different times. So a headline number, it's not going to tell you the whole story. It's just going to tell you a piece of it. And that piece is still important to the markets, that the labor market still looks solid.
Neela, appreciate it. The good news, the baseline's still pretty decent. Neela Richardson there of ADP. Thank you, Neela. Thank you very much. Joining us now is Kayla Cedar of State Street. Kayla, welcome to the program. This came from Torsten Slock of Apollo. I'd actually love your thoughts on it. So he said this is the wait-and-see economy, went on to say that in a wait-and-see economy, it eventually leads to a slowdown in the hard data. Do you think it's premature to extrapolate the weakness we're seeing in the survey data into the hard data anytime soon?
Well, first, thank you so much for having me. And yeah, I do think it's a little premature, especially because when we do see some of the hard data, it still looks strong. And some of that more high frequency hard data still looks strong. So, you know, the claims data we got today looks okay. When we look at some of the consumer credit lending data, credit card lending is still very strong. So from that perspective, you know, that tells me it's hard to bet against the U.S. consumer right now, even though uncertainty is higher than it was before.
Kayla, do you think that this market has overpriced some of the weakness that we've seen in the soft data and extrapolated it into a pretty big economy that is pretty solid? Or do you think that right now the market's picking up on something that could come to pass in, say, 6 months' time?
You know, I think from here, when it comes to expectations for the Fed and Fed cuts, 3 cuts right now, you know, looks like that that looks to me like the market is pricing in more uncertainty. However, to get more than that priced in is going to be really hard. I think you need to see more of that weakness in the hard data that we haven't seen just yet.
Which is the reason why right now the bond market's move is so interesting. On the heels of this data that came out just 13 minutes ago we're looking at bond yields creeping higher even on the front end, even though we did see that disinflation continue with PPI coming in softer than expected. It seems like the bond market, as John was saying, is looking at something else and expecting the Fed to be on hold for a longer period of time. Do you think that is the correct response? Do you think that bonds don't offer the same kind of ballast as they have in the past?
I still think cash is the better decision right now for a couple of reasons. One is that the front end of the yield curve, so thinking bills versus 2 years, that's still inverted. And, as previous speakers mentioned, the Fed isn't in a position to cut just yet. And I think as well, when we look at where we see the market increasing rate cut expectations, it's not, it's not for next week. It's not for the May meeting either. And so that keeps cash pretty attractive right now.
Bond yields higher across the curve at the moment on the 10-year, up by 2 basis points at 433. Katie, we've got to leave it there. Katie seated there of State Street on the bond market. Following economic data, the kind of economic data that if you're the Federal Reserve, this is what you want to see. Softer on CPI, softer on PPI, going into the Federal Reserve meeting next week. Make it easy, breezy. Inflation's trending in the right direction. We can maybe reduce interest rates over the next 12 months or so. They can't do any of that. They can't do any of that because they don't know what policy is going to be down in Washington, D.C.
And in some ways, they could probably say policy's been a pretty good place, at least if you take a look at the jobless claims. But again, this is backward looking. Everyone is saying that. And when you look at the high frequency data, this is the reason why, and I keep going back to this, Stuart Kaiser said that the University of Michigan sentiment survey tomorrow is oddly important. It might be the most important data point of the week because we'll get inflation expectations and sentiment, and that seems to be in the driver's seat.
The policy is frenetic at the moment. Just 45 minutes ago, the President of the United States is talking about a 200% tariff on EU wine, champagne, and other alcoholic beverages unless they strip away their 50% on whiskey. And Secretary Lutnick comes on this program and says, we're done with this tit for tat. But you look at what allies are saying, and they're saying, but you started it. We would like to have a negotiation, but you come out with truths saying we're going to go to 50% on steel just on Canada, 200% just on Europe.
There was a piece of that interview that jumped out for me, and he alluded to this. He didn't say it explicitly, but the idea of dealing with China was different. Because we asked the question, if you put tariffs up on China, is there any evidence at all that China are reducing theirs in response to that, if that's the desired outcome? And at the moment, over the last several years, we've seen no such outcome whatsoever from the Chinese Communist Party. Almost alluded to the idea that it was easier to bully democracies that are accountable to their own electorate because they have to respond, they have to take the temperature down because they know the economic consequences won't be good.
There's been a different approach, not just with China and the leadership there, but also with Russia and some of the autocracies that are not guided by the same types of democratic principles have had a quieter time of it, which is sort of interesting in terms of negotiating tactics. But ultimately, there might be different outcomes, too, that are desired.
Also, China did not live up to Trump 1.0 phase 1 trade deal. And I imagine that is in the back of their mind. So they're not willing to negotiate at this moment yet with China, though there are reports that potentially there's a meeting underway that could happen in the spring, early summer. Did you notice Secretary Lutnick did on this instance not want to get ahead of the president?
Yes, a shift, a change. I will take note of that. Equity futures right now in the S&P negative by 1/3%, with an update on stories elsewhere this morning. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Just the details of what President Donald Trump said on those tariffs. He's threatening to enact a 200% tariff on European wine, champagne, and other alcoholic beverages. The president writing in a Truth Social post that he will move forward with the duties if the EU doesn't repeal a tax on U.S. whiskey. The Federal Trade Commission, meanwhile, is moving ahead with an antitrust probe of Microsoft that was open to the final days of the Biden administration. Bloomberg has learned that the FTC is scrutinizing Microsoft's decision to slash funding on its own AI projects after striking a deal with OpenAI, which could be perceived as hurting competition. 2 NASA astronauts stuck in space will have to wait a little bit longer to get home. A launch pad problem prompted SpaceX to delay a flight to the International Space Station, and the crew needs to get to the International Space Station before Butch Wilmore and Suni Williams can head home after 9 months in orbit. And that's your brief, John.
Danny, thank you. Thanks for this morning. Appreciate it. Up next on the program, we'll set you up for the day ahead and give you a sneak peek of next week as well. From New York City, this is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The opening bell about 40 minutes away. Equity futures going into that declining just a touch. We're down by 0.25% on the S&P. On the Nasdaq 100, lower by 0.4%. The trading diary through the next week or so looks like this. At 12:20 Eastern Time, President Trump meeting with the NATO Secretary General on Friday. UMich consumer sentiment, another important read on inflation expectations. Then at midnight, a U.S. government shutdown deadline. Sneak peek of next week, retail sales on Monday. Wednesday, a Fed rate decision and an important Chairman Powell news conference. Also important, of course, is what is happening with the relationship between the United States and a range of allies, including the EU. Take a listen to what the Commerce Secretary Howard Lutnick said just moments ago about the European Union.
The EU has just so many years treated us so harshly. They just can't stop. Look, their tariffs are way up here and our tariffs are down here. How about relax? Let us balance it. We are your largest, most important trading partner. Treat us with respect and let's get a little balance. And Donald Trump is out there saying balance, balance, balance. April 2nd, he's going to describe his balance. We're going to do it together.
Let's bring in Tyler Kendall from the nation's capital for more down in Washington, D.C. Tyler, the president saying more than balance this morning. Pretty strong message for the Europeans about an hour ago.
right, John, that post on Truth Social, President Trump threatening up to 200% tariffs on alcoholic goods. It was interesting to hear Howard Lutnick on this program saying that President Trump was, quote, aggravated by the response that he saw from the EU, and that this White House wants to see partners like Canada and the EU start to negotiate a little differently here, like they've seen from Mexico and the UK, for example. You'll recall when the UK Prime Minister Keir Starmer was here at the White House last month, President Trump was pretty open that he much prefers to negotiate with London over Brussels. I was also struck by in that interview that he gave us some indications on when this White House is going to start to transfer from what they have been calling Biden data to Trump data, telling us to look ahead to the fourth quarter.
When it comes to today's meetings, Tyler, it's going to be all about Canada. And Howard Lutnick in that conversation said a lot of what's being driven in terms of Canada and what he would maybe say they're posturing comes from domestic political considerations. If that's how they're going into this meeting, that kind of mindset, what do you think we're going to get out of it?
That is the biggest question here, perhaps, and important to note that at that meeting also will be Ontario's premier, who Howard Lutnick has already negotiated with at least once this week to get them to drop that 25% electricity tax in order to have this meeting today. What this White House really wants, it remains to be seen. This interview from Howard Lutnick really pushing that they are trying to rebalance trade, make this all about those reciprocal tariffs. But we know going into today, this White House has put a lot of factors on the table, from border to national security to also how they'd like to see tariffs used as a revenue raiser.
Hey, Tyler, appreciate the breakdown. Great summary of things right now. Busy day ahead for everyone down in Washington, D.C. Bloomberg's Tyler Kendall there. Lisa, we did get one answer, one very clear answer. Biden data versus Trump data, right? We figured this out? We've got a calendar now?
We've got a calendar. Trump data is third quarter, maybe, but definitely fourth quarter. Okay. Biden data is first quarter and second quarter. So what we're looking at right now is Biden data. And what the Biden data shows right now is initial jobless claims that came in lower than expected and disinflation in the actual PPI, although maybe with the bond market stiffing out, revisions to the upside on the prior PPI reading. So still an inflationary undertone here that has some people's attention.
One thing that they're taking full credit for, maybe Trump capital investment, say, Howard Lutnick brought it up. Apple's $500 billion. Actually, that started previously years ago, and a lot of that happened under the Biden administration, but obviously he's not going to point to that. I'm struck this morning by the president coming out with 200% tariff on EU wine, not because we haven't seen a chaotic, frenetic rollout, but also because you can imagine his friend, who he likes to consider his friend, Bernard Arnault, the shares of LVMH this morning are now taking a hit because of this. What kind of carve-outs potentially can we see with this administration? Because Howard Lutnick's basically saying there are none.
We're opening up a major debate without realizing it. Can you substitute French wine for Napa Valley wine? I say.
Okay, really?
I'm old world. I'm an old world girl, so no.
First of all, they all have different tastes. You taste the land. It's enjoyable to taste different land.
Nice.
It's like traveling through a bottle.
Opus one's pretty good.
Yeah, I know.
You know, it's like this.
I'm shocked you brought that up.
I remember once.
Good wine.
Do they subsidize you?
I remember once for dinner, Obama did Virginia champagne. I'm not sure it landed.
I've been down there. I've seen all those barrels.
Oh, I know you have.
Yeah, no.
Yeah, every time.
That's good stuff. All right. Coming up tomorrow, Chris Verona, Strategas, Jessica Taylor of the Cook Political Report, Maya McGuinness of the Committee for a Responsible Federal Budget, and the NATO Secretary General Mark Rutte. Looking forward to doing all of that and more as we make our way into the weekend. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special BNP Paribas Open update for Bloomberg TV and radio from Tennis Channel. New mom Belinda Bencic continued her dream return to the WTA Tour with a thrilling three-set victory over Coco Gauff to reach the quarterfinals. The victory follows her triumph in Abu Dhabi last month and was her first top three win since beating Jessica Pegula in Charleston 2 years ago.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down the venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, you know, with lots of supporters, a really mind-blowing level of innovation against emissions. And, you know, in the last 9 years, that's gone better than I would have expected. So only now could you even, you know, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up very like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. You know, in the meantime, some people who care about this issue are really out, you know, trying to think, do we need permitting reform? You know, do we find, what new ideas haven't we found yet? You know, how do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but we can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never.
Ready? Go.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
Thank you.
All right, we're looking at futures a little bit lower, not moved by the inflation data this morning. 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, fresh PPI data shows that price pressures are abating while government shutdown risks add to trade war jitters.
In a Bloomberg interview, Commerce Secretary Howard Lutnick praises the UK and Mexico, but blasts the EU and Canada for retaliatory moves on tariffs.
And Ed Yardeni joins the chorus of Wall Street strategists cutting their S&P 500 targets. Yardeni says the tariffs heighten the risk of stagflation. Let's take a look at where these markets are trading. We actually saw a little bit of a bounce yesterday, but you're not seeing that follow through this morning, despite, as Matt mentioned, we had claims lower than expected. We also had PPI pretty much unchanged from what we saw at last month's reading, but you can see the S&P 500 down pre-market about 0.1%, a little bit more if you take a look at big tech. This week is shaping up to be another painful week for these markets. We'll see what changes the narrative, if anything. But then you take a look at the bond market as well. We've seen this rise in yields all week, and you can see that continuing a little bit today. 10-year Treasury yields higher by just about 2 basis points if you round up, and we're sitting at 4.30 on the 10-year yield.
Can I just say, I think there's a technical problem with my chart here, but if you push on your Bloomberg terminal, CHRT, you can see a wealth of charts. And there's a really good one by Phil Serafino, speaking of stagflation, about the Goldman Sachs stagflation basket outperforming the S&P. There's also a great one by Tasneem Brogger showing that defense stocks, not utilities and healthcare and staples, but, you know,
actual
war, really outperforming green or clean energy stocks. So a wealth of charts on CHRT Go on the Bloomberg, and I highly recommend checking out that function.
Maybe we'll pull them up later in the show. I'm interested in stagflation. As you and Katie know, I have been losing my mind over this Yardeni call.
Losing your mind?
Losing my mind. I didn't even shake you this morning, but really he's the last one to throw in the towel. He has been calling for the roaring 20s. Let's see if stagflation fears throw a wrench in that. Let's also talk about stocks moving pre-market. Looking at Intel rising more than 13, almost 14% pre-market. They're getting a boost after finally naming a new CEO, and that's going to be chip industry veteran Lip-Bu Tan. And next up, though, not as bright of an outlook here for Adobe, down 7% pre-market. They have disappointed. They have given a tepid outlook for revenue growth. It was a stock that already, as our own Bloomberg intelligence analysts say, was controversial. Also looking at U.S. beer companies like Molson Coors moving higher, with President Trump threatening 200% tariffs on alcohol products from the EU. Molson Coors up 1.2%. These have been kind of volatile throughout the year because, of course, input prices matter there too. Now in the last hour, U.S. Secretary of Commerce Howard Lutnick spoke with Bloomberg. Here's what he had to say about EU's treatment of the U.S.
The EU has just so many years treated us so harshly. They just can't stop. Look, their tariffs are way up here and our tariffs are down here. How about relax? Let us balance it. We are your largest, most important trading partner. Treat us with respect and let's get a little balance. And Donald Trump is out there saying balance, balance, balance. April 2nd, he's going to describe his balance. We're going to do it.
It is absolutely fascinating what we've seen this morning, the threat of 200% tariffs on wine and champagne. But I did wonder, when we saw this retaliation from the EU, why not, instead of retaliate, reduce the 10% tariffs they have on autos and trucks? That's what Donald Trump's very angry about. And Europeans don't want to buy American cars and trucks anyway, so it would really be symbolic. Why not reduce the amount of tariffs they have on U.S. Dairy and meat? Because they make enough there. I just don't understand why continue to start a fight.
Well, clearly they didn't talk to you first, but I mean, that's not where we are in this global trade war, if you want to call it that. This is all about escalation, retaliation, and you take a look at the words that are being thrown back and forth. It doesn't seem like that world that you described is coming anytime soon.
You know, what's interesting to me is, in addition to the trade policies, what he said about the economy and the economic data, our surveillance anchors had asked him specifically, when is the bad data no longer reflective of the Biden administration and starts to reflect Trump policies? And he gave a time frame. He said Q4, not Q3.
Q4.
So I wonder if that means they're willing to take a bunch more pain until the end of the year. It has already been something that's been wiping out price targets, as we've been talking about for the S&P 500.
Yeah.
Maybe that gives them a little bit of cover.
Well, you think about Yardeni, for example, lowering his price target. He did say
that.
Ed Yardeni.
He who coined the phrase bond vigilantes.
Yes, you might be familiar with him, dear viewer, but he lowered his price target. We had been waiting for that, as Shonali said, and he said that basically tariffs, they aren't this bluff negotiating tool that maybe we thought they were, but he did mention the 2026 midterm elections, that maybe that will be the tempering impulse on what we're seeing right now.
That's the biggest reason to be watching what's going on in Washington. Everything can change, or a lot can change in a couple of years, and stagflation, as we know, Matt, has been a nightmare scenario for the Federal Reserve if they were to hit it. So we'll talk a little bit more about what that would mean.
All right, let's talk about this with someone who knows what the Federal Reserve considers a nightmare and not. We had inflation data within the last hour, still probably Biden's economy inflation data, but we'll break down that story with Michael McKee. He joins us here on set. Mike?
Well, sweet dreams for the Fed with the PPI numbers today, because they're pretty good. Although yesterday, the CPI numbers were good, and they were Trump numbers, according to the administration. So this may be Trump numbers, not Biden numbers. PPI headline comes in flat for February after being up 0.6% in January, pushes the year over year down 3.2%. Look at that, a 0.5% drop in the headline year over year. Core X trade down 0.2%, or up just 0.2% rather, and on a year over year basis, 3.3%. A point on that though, the February drop there is due to margins for wholesalers and retailers. They shrank. So maybe some under the hood problems for retailers going forward in this PPI report. The other thing I want to mention about PPI is that egg prices were up 53.6%. Donald Trump tweeted a short time ago that egg prices are down, America is back. He's wrong. Egg prices are not down. Also, scrap steel was up 8.6%. Steel mill products up 2.7%. Tariff anticipation. The other number out this morning is jobless claims. Almost no change there, 220,000. And federal initial claims fell a little bit, 1,580 from 1,634. So not so bad. The number we want to watch from now on, guys, is continuing federal claims. They were over 8,000 this week. As the damage mounts in Washington, that number is going to go up and give us a much better sense of how many people have actually lost their jobs in the weeks going forward.
Yeah, that's why I feel like next month is Trump numbers when it comes to labor, when it comes to inflation. We're going to start seeing those things hit. At least that's my take. We'll see if it bears out in the numbers. Mike McKee, thanks so much for joining us. Let's talk about this to Wei Li. She joins us from BlackRock, where she is Global Chief Investment Strategist. And Wei, certainly if these aren't Trump numbers on the economy, these are Trump numbers on the markets. What do you think about the hit the equity indexes have taken?
Well, what we have seen so far is that U.S. exceptionalism is coming under pressure, and specifically U.S. growth exceptionalism is coming under pressure, and U.S. tech exceptionalism is coming under pressure. But let's be very clear, the current growth data does not point to us heading towards a recession. You look at the robust job creation, you look at the still very good kind of earnings expectation for this year, 12% expected for this year, revised down from 14% at the beginning of the year, but still consistent with slightly even above trend trajectory, right? So the current data in terms of growth does not point to recession. But of course, if this extremely elevated uncertainty were to persist, there is a path towards there. But we do think that the sharper the economic pain, the sharper the market pain is going to force a quicker kind of journey towards policy clarity, and that itself may well lead to some of this policy uncertainty, risk premium being priced out. So that's on the growth exceptionalism. Currently, the U.S. economy is not doing so bad. Right. And then in terms of tech exceptionalism, markets obviously have sold off, but in our assessment, it is not commensurate with worsening fundamentals. You look at CapEx indication, it's even up 40% versus what was a record year last year, despite DeepSeek and profits and margin and earnings expectations. They haven't notably dropped either. So there is a bit of a disconnect. And I think the very elevated policy uncertainty is the reason, together with deleveraging and some of the crowded positions being washed out.
So let's put this together and how investors should be thinking about their portfolios right now. You mentioned this policy uncertainty actually could force clarity when it comes to maybe some monetary policy, but you also mentioned maybe the fading exceptionalism of American equities and American tech. And if I put that together, what does that mean for how I should be weighting the US, for example, versus Europe versus maybe Asia?
Well, we recently closed European equity underweight because we see this market being so unloved, so under-owned. Now there are momentum catalysts for that to turn around that can go on. So we're neutral European equities. We're keeping our Chinese equity tactical overweight as well. A similar story applies there. But we're not downgrading U.S. equities at this juncture because the price action, like almost 10% from peak to trough at this point, is overpricing recession risk in our assessment. So we're also keeping our U.S. equity overweight. You look at tech specifically, last year we went overweight tech since mid-2023. And for most part of that journey, I hear investors and clients come to me and say, well, I don't question the tech story. I don't question the AI transformation, but it's just price is too much. It's gone up too high. Now, fundamentals haven't deteriorated and price is quite a bit lower. And all of a sudden people are getting very anxious about it, right? So I think for those that do have the luxury of not having to de-risk at this juncture, there are good opportunities right now. But I would say, though, markets pricing in terms of treasury and market pricing as though it can be a good recession diversifier or portfolio diversifier that is under appreciating the sort of environment of high debt and inflationary pressure that we're in. So we would lean against treasuries acting as a recession diversifier in this environment.
So, Shonali, a lot to dig into there, but the tactical overweight in China kind of reminds me of what we were talking about with Carson Block yesterday, that China is a trade. Don't get married to China, but you can date China.
Yeah, no, it's very interesting because, of course, China has its own uncertainties on a macro basis. As far as the macro basis in the U.S., you also said that you are not underweight the United States, but you look at strategist after strategist lowering their price targets. You look at an S&P 500 that is not only down on the year, but has struggling for now many weeks to break back sustainably above 6,000. So my question is how much more downside risk there is before things get better?
That's a great question. Let me clarify a little bit. I think in the near term, the crowding position getting washed out, and there are still some of that in the system despite the significant deleveraging that we have seen. So that dynamics can still put pressure on U.S. equities, and certainly we're seeing extraordinarily elevated level of policy uncertainty, and that should warrant a higher risk premium at this current juncture. But over the 6 to 12 month horizon, which is our tactical asset allocation horizon, we do believe that some policy clarity will be forced out of market pain, and that should lead to some of that risk premium getting priced out. And ultimately, we're in an age of populism, and what happens in Wall Street and Main Street should matter. One cannot tolerate pain for too long. So it is a matter of time horizon, I would say, and the fact that current market disconnects with worsening fundamental, which is not a huge amount, is why we're not downgrading our U.S. Conviction at this point, but very much recognizing that there are very good reasons that markets could come under pressure in the very near term.
All right, that's a good place to leave it. Really great to get some time with you. That is Wei Li of BlackRock. Meanwhile, a quick check on futures. You can see those losses in the pre-market sticking around. The S&P 500 down about 0.1%, a little bit more if you take a look at big tech, which has really been the pain point in these markets. The NASDAQ 100 currently off by about 0.3%. The Russell 2000 holding up. This has kind of been a head scratcher this week. It's been outperforming a little bit, but it hasn't exactly been hard when you take a look at the pain that has been felt in the big benchmarks, Matt.
I wanted to show you a chart I found this morning in the JP Morgan story, which I thought you would find particularly interesting because of your side gig on the ETF program. So this is the NASDAQ 100, right? And we're looking at it over a 2-year perspective. On the bottom there is the volume in the queues. And every time the volume in the queues gets well over 75 million shares, it seems to be a turning point for the NDX. And I just think it's fascinating. Literally every time going back to September of 23, maybe it happens again.
It's not only fascinating. I want to point out that our later guest, Stuart Kaiser, has been recommending that you buy puts of the QQQs to hedge as well. So a lot of trading around it. Yes, selling, but also protection on the downside.
Yeah, I will say, going back specifically to volume, which this chart is highlighting, it's interesting because if you bring it back up, you can see that line and you can see we don't breach it that often. But I will say, if you take a look at the Qs, if you take a look at SPY and you think about the volume, it hasn't been crazy. We're not seeing 2020 levels. And a lot of folks have pointed that out to me and said, this is an orderly sell-off. What we're seeing right now doesn't exactly qualify as panic.
Silver linings.
Exactly. We'll continue to watch that one. But coming up, Intel appointing its next CEO, an industry veteran. We'll take a look at the company's future next. This is Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today. and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
One of the very critical things is that a lot of young entrepreneurs don't realize is that when you start as an entrepreneur, you're not just building your business, which of course you are, but you're also building your organization. And most people don't realize that. And building an organization is not just about hiring people. It's about the culture, it's about the systems, the values, the mission. You know, it's about how you operate, how you do things, how you retain people, how you keep them motivated. So it's all of those things put together. And over time, you realize that, you know, a lot of effort has to go into it. And then eventually you have an organization that has a life of its own. It's, you know, and it's sometimes you look at it and you marvel and you think about, you know, how was this created? And was I the person that was behind getting this thing done?
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
President Trump threatened a 200% tariff on all wine, champagnes, and alcoholic products from the EU if the bloc's 50% levy on American whiskey, Kentucky bourbon, isn't immediately removed. European spirits and drinks makers dropped on the news, and Commerce Secretary Howard Lutnick says he'll talk to his EU counterparts today. Lutnick spoke earlier on Bloomberg Surveillance.
The president has made it crystal clear that he finds this tit for tat really abusive and aggravating, right? His objective is steel and aluminum tariffs. Let him build his steel and aluminum business in America because that's important. And then, you know, they say, okay, we're going to tax whiskey. And look, I find all this back and forth really off the topic. The key topic is rebalancing American trade. We're going to spend lots of time together, you know, but the president was totally annoyed that the Europeans did this. And so you're going to hear back from someone who emotionally cares about America. He cares about America, and he wants to take care of Americans. And why are Europeans picking on Kentucky bourbon
Secretary
or
Lutnick,
Harley Davidson motorcycles?
Are you saying this is an emotional response?
It's disrespectful.
Are you saying this is an emotional response, or will we see 200% tariffs on wine, champagne, and alcoholic products before April 2nd, when the president says is the big one, and we're going to get the reciprocal rollout?
Well, the joy of my job is that Donald Trump makes the decisions, right? And the people around him, we talk to him and we advise him. April 2nd is when we do reciprocal tariffs. And he's called out these products. He wants these countries to respect him. And all of this showed you is that Europe and Canada do not respect Donald Trump and do not respect America's ability to build its steel and aluminum industry, which is vital for national security, whereas you watched Mexico and you watched the UK be pragmatic and thoughtful, and the way we're going to deal with them is going to be better. So these are just black and white things. Why would you put against steel and aluminum, would you say Harley Davidson motorcycles and Kentucky bourbon? It's just illogical. I think the president is saying, look, I am going to respond always bigger and always stronger. We will talk together. You know, he wrote that tweet this morning. We will talk together. If that's what he wants to do, we will do that. But the answer is April 2nd, a thoughtful approach to reciprocity and national security of those products he's called out. We're going to increase our domestic production of those and have a reciprocal model. And hopefully when I talk to the Europeans, they'll realize that they should take these things down, cool these things out, and let's properly negotiate.
And that was U.S. Commerce Secretary Howard Lutnick earlier on Bloomberg TV. We'll be bringing you parts of that interview throughout the morning, but let's turn our eyes to Intel. Absolutely surging this morning after the company announced last night that Lip-Bu Tan would be its next CEO. Tan is a former head of Cadence Design Systems, a respected semiconductor veteran, and just recently he was on Intel's board, so now he's back. Here with more is Bloomberg Technology's Caroline Hyde. Caroline, let's talk about what exactly he's going to do, because his early signal is that he's going to stick with Pat Gelsinger's plan to make chips for other companies, but I have to imagine he was brought in for a reason.
And many feel if he can't do the job, then no one can. And that's what Bernstein, Stacey Ragson, is currently saying. He is a veteran of venture capital. He's invested a lot in Chinese chip makers, SMIC in particular. We've seen the fact that he's turned around a company before. Cadence Design Systems was in a difficult time in 2009. And this is a company that helps you build the blueprints of designing incredibly sophisticated chips. So he understands the business model entirely. But from his first note to his employees, it does seem that, yeah, he's sticking with the foundry business. He's sticking with wanting to re-improve them as a product manufacturer. This is a company that has lost 50% of its market capitalization over the last 12 months. It is still in 70% of all PCs and servers. It is integral to the overall tech ecosystem, but it is below the top 10 chip players out there in terms of market cap. They need to resuscitate their brand. They need to resuscitate their product innovation, particularly on the AI accelerator front too.
You know, one thing about this whole thing, the Wall Street reporter in me wants to ask you about his capacity as a deal maker, but the tech-curious person in me wants to ask about his tentacles across the technology industry. He was on the board, for example, of Celestial AI, which yesterday was on your show that I moonlit on for a second. Learned a lot. It's a company that has, for example, relationship with the Porsche holding company, was talking about the ability to use more AI in cars. Do you think that this is a new CEO of Intel that can kind of push the AI story in the United States in a far bigger way than maybe meets the eye?
I think he's been on the board of Intel, and he left citing needs to reprioritize back in August of 2024. Now, other reporting shows that his frustration with bloat and with a lack of ability to reorientate towards this new artificial intelligence future that all of us talk about so much. Think about how much AMD has stolen on their march when it comes to PCs, with the new future of AI PCs, when it comes to servers, and ultimately they have lost most of the shining light to NVIDIA. They did not manage to pivot into the generative AI space, did not get into the GPU offering, and overall we see the Gaudi offering just falling flat. So yes, I think the fact that he has been on boards of generative AI companies, he understands Chinese manufacturing as well. All of this is just going to speak to a really holistic view, I think.
You know what I think about a lot is the great state of Ohio.
Yeah, I barely think you think of anything other than.
And, well, Intel was planning a $30 billion factory in central Ohio, right near my hometown of Granville. Go Blue Aces. And it is on hold now. And really, the whole CHIPS Act funding is in question now, right? Yeah. Because Donald Trump wants to stop that. How much money has Intel gotten already from the U.S. government, and how much will they miss out on if that is killed?
They're promised $8.5 billion. And Pat Gelsinger, before he was ousted, came on Bloomberg Technology, came on across our networks, and was frustrated that he couldn't get the money quick enough. Of course, the CHIPS Act money comes in installments. You have to hit certain landmarks in terms of boots on the ground, in terms of things that are constructed, in terms of overall foundry manufacturing to get the money in.
Apparently in terms of like diversity targets as well, and like Biden-era regulation.
Someone speaking from the mouth of the new administration. It sounds like, yeah, there is a
that's
frustration.
Actually, I'm just talking about the actual rules. It doesn't matter what administration, right?
That is exactly why there has been this pushback from Trump and others about the CHIPS Act, because they felt that in many ways it was too environmentally focused. It was ultimately was bringing in other areas of DEI that they felt wasn't really core to getting foundries out and manufacturing as quickly as possible. Remember, there's reporting that they were trying to have negotiations with TSMC to potentially try and take some of these foundries off the hands and start building themselves. So really interesting time.
Caroline, up against the hard break, but fantastic reporting as always. Tan, of course, has a big job ahead of him. We'll continue to follow that story. But coming up next, it's the opening bell. We'll walk you through all the market action with Stuart Kaiser of Citi next. This is Bloomberg.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. On a day when we had inflation data in the form of the PPI really coming in cold, you would expect these arrows to be green, but they are not. We see futures down on the S&P. NASDAQ futures also off. For Katie, Russell 2000 futures are doing well, and apparently those small caps are slightly outperforming. But you hear the opening bell there. On the New York Stock Exchange, it's PR week, so a lot of journalists are going to know these people. I'm looking for Christina Alessi. I don't see her there, but I know she's down on the floor. Down at the NASDAQ, you've got a SPAC, Maywood, ringing the opening bell, and they've only been trading for a few days, but still outperforming the broader index with a gain of 1%. In terms of the major indexes in the live cash trade right now, Katie Greifeld, what are they doing?
Well, Matt Miller, you make a good point that we've gotten really good news on inflation this week. You think about CPI coming in cooler than expected. You think about PPI just this morning, pretty much unchanged from the prior reading. It's not helping out these markets right now, and I think it's really telling that this buy-the-dip impulse has faded in this market environment. We'll get into that in just a bit, but you take a look at where we stand right now. The S&P 500 losses deepening as trading kicks off, down about 0.3%, even more if you take a look at big tech with the NASDAQ 100 off about 0.4%. I've been keeping my eye on the small caps. They've been the outperformer this week. They're still the outperformer right now at this moment, but the color is also red. Let's find some good news and look under the hood and talk about Intel. As we were just discussing, it's surging this morning after incoming CEO Lip-Bu signaled that he's sticking with the strategy of making chips for other companies. That, of course, is Pat Gelsinger's plan. We'll see how he breaks from some of those routes that his predecessor laid, but you can see that Intel right now higher by about 12%, Janali.
You left me with the bad news. I'm keeping an eye here on Adobe, Katie, because it's disappointing investors with a revenue outlook that's below expectations, and that's despite a recent focus on monetizing new AI features. You have Adobe down more than 9.6% at the market open, Matt. It's been a bit of a tough story for Adobe, relative underperformer in the world of AI.
Getting decimated, Adobe. I know a guy who loves Adobe, the suite of Adobe software.
What's his name?
Joe.
Yeah, he's a good guy.
But I don't love it. Adobe is one of those things, you subscribe to it by accident one night, and then you try and quit for like 2 years.
Yeah.
And they just keep sucking money out of your account.
You'll have to talk to that Joe about it, because I think that he keeps hitting renew.
You know, I was kind of excited about your charts. I'm excited that Dollar General's up today.
Yeah, what, did I have a chart?
You did.
On Dollar General?
Well, you had the stock chart. It's moving higher.
I've got American Eagle here as well as Dollar General, yes. American Eagle dropping, giving a weak forecast, the retailer anticipating near-term headwinds from tariffs, and Dollar General gaining after forecasting sales will grow in the high end of expectations.
Listen,
always moving me
you
along,
know I love
Shonali.
the dollar
Move me
stores.
along. You know
I
what?
love the dollar
Don't waste any time talking. Get to the
Get
next.
to the movers.
Yeah. All right. Another day, another strategist cutting his S&P price target. Ed Yardeni lowering his best case target, saying President Trump's tariffs have heightened the risk of stagflation. You can see here, it has dawned on us that President Trump's tariffs aren't negotiating chips. They jeopardize U.S. inflation and economic growth. Let's take a deeper look with Bloomberg's Alex Semenova. Alex?
Hey guys, so Ed Yardeni of Yardeni Research, a notable perma bull, is actually scaling back his outlook for U.S. equities for this year. He sees the index going only to 6,400 compared to his previous target of 7,000. And of course, we had Goldman Sachs earlier this week also lower its forecast for the S&P 500. But on the other hand, you have J.P. Morgan cross-asset strategists saying that this correction is actually overdone based on signals from credit markets. Credit markets have been right over the past 2 years on multiple occasions at a time when equities and bonds perhaps overplayed the risk of a slowdown. So that's offering some much needed reprieve from JP Morgan compared to what Goldman and Yardeni are saying.
Yeah, it's interesting that JP Morgan took that stance because you can look at these markets and say, one is right, and it seems like JP Morgan is saying it's the credit markets that are right now. But I want to talk about another story that you have out on the wire this morning. I referenced it a little while ago, basically that the buy the dip impulse that has really supported this market for the past 5 years, it seems like it's faded right now, that appetite just isn't quite there, Alex.
Yeah, Katie, investors have really been able to flex that dip buying muscle over the past 2 years. In fact, through last July 24th specifically, the S&P posted its longest streak since the global financial crisis without a 2% drop, 356 days. So it was a market that was going up, and investors got comfortable stepping into any pullbacks and being rewarded for it. But anyone who's done that in the past 3 to 4 weeks, as we get these sporadic tariff announcements, has really been punished. As you can see today, of course, we got a bounce yesterday, and we're back down today.
All right, great reporting as always. That is Bloomberg's Alex Semenova. And let's keep the conversation going now with Stuart Kaiser. He is Citi Head of U.S. Equity Trading Strategy. And let's start right there. Buying the dip. You actually said late on Tuesday that we are not dip buyers here. You also recommended some tactical trades, but let's start just with that. Why not?
Well, I mean, look, why we're not buying the dip, 3 core reasons. Number one is just the assault on kind of core long positions and momentum stocks has just been kind of nonstop for the last 6 weeks. To be fair, Tuesday was probably the best day of the week in our view in terms of market internals, where you had a down S&P tape and you had tech and momentum stocks kind of performing pretty well. But we don't think that sort of position de-risking is 100% done. We do think we're later innings, but we don't think we're quite there yet. Second reason, the Trump and FOMC puts, if they exist, I think are much further out of the money than the market's anticipating. And then lastly is economic data. PPI, I think, is a good example today. Anytime over the last 2 years, the softer inflation prints you've gotten the last 2 days would have been welcomed. The market's worried about growth slowing down now, so they've kind of flipped the script and are reading those softer inflation prints as evidence that demand is softening, as opposed to the good news that might be associated with the easing inflation data. So for 3 reasons.
One thing that's been difficult for a lot of investors in this market is capturing the low, and then capturing the low in a volatile market where that low kind of keeps changing. What would give you confidence that we've hit that barrier of the pressure really ending in this kind of rotation of selling that is coming from everything from momentum trading to people that just don't think that this is the right time to buy a big tech?
Yeah, look, I think there's 2 things. One, on the data side, is really all about the labor market. We did get decent news out of the labor market last week, though the internals of that jobs report were a little bit on the soft side. And second, it's just going to be price action. As I mentioned, I mean, the last 2 days have been positive in the sense that those tech, AI, momentum stocks have traded higher, in particular on Tuesday when they rallied in a down tape. We're going to need to see a little bit more evidence of that. I mean, our trading desk has used the term buyer strike, for most of the last 2 weeks. I would say the last 2 days, we actually have seen some buyers starting to bottom pick a little bit. The problem is a day like today is going to be very, very frustrating for them. Not seeing follow through on yesterday's recovery, I think, is going to make people a little bit cautious about trying to dip buy again.
I thought only the bond guys did that, Matt, a buyer strike.
Well, if they did, they would be called bond vigilantes.
That's true.
And that would bring up Ed Yardeni again. He cut his target from 7,100, was it 7,000, 7,100? It was 7,000, but now it's still 6,400, right? And I think Scott Kroner
next year as well.
But it's higher still, is my point, right? From here, it's another 15% higher. Scott Kroner also has a target that's another 16, 17% higher, right? Everybody, even those who have lowered expectations for, say, the first half, still have higher targets year end. What gets us there? Is it the TCJA extension? Is it, you know, the end of the tariff war? Does the Trump administration get sensible?
Yeah, look, I think it's a combination of all of the above. I mean, coming into the year, I think you would have argued strong underlying fundamentals, really bad risk reward around those fundamentals because of valuation and Trump policy, et cetera, like that. You know, sitting here today, you know, what is the kind of key to unlock? I think the next bit of upside would be success in the budget and tax negotiations, I think. You know, U.S. economic data doesn't feel like it's going to get us there. Consumer sentiment has been dented considerably. You know, if you were to get, you know, a budget agreement that had some spending cuts, but also did extend those tax cuts, I think the market would kind of respond really positively to that. If you're hoping tariff wars are going to end, I think you should be patient because I don't think you're going to get, you know, much an end to those negative.
But we're not going to get a recession, right? I mean, J.P. Morgan was out with, I think you sent me the story.
Yeah,
they said that the stock market is discounting a recession at 33%. Bonds are showing it at 9 to 12%.
Specifically the credit markets. Corporate spreads are very narrow right now.
Yeah, but you know, the credit market, I'm not sure is the best signal right now for equity markets. You know, the difference today between previous quote-unquote crises would be that who holds the debt, right? This is government debt. It's not really on the corporate side of the ledger. Corporate balance sheets are still really, really healthy and really, really clean. So I think that's why we haven't seen a significant blowout of spreads. That said, you know, flows through our desk the last week have been very, very heavy to hedge in HYG over the next 3 to 6 months. So I think what the bond market is saying is maybe if the equity markets are 33 and we're at 10 or whatever numbers you're using, that gap has to close. And if I'm paying very, very low implied volatility to hedge in the credit space, maybe that's a good value kind of recession protection for me.
Yeah, and I was taking a look at some of the ETF flows this morning, and you definitely see a bid coming out of corporates, but you are head of trading strategy. We talk to a lot of long-term investors, and they tell us to calm down, but let's get tactical here, because you recently recommended some hedges in the form of QQQ puts. You also recommended puts on XRT, and then in the bond market, IEF basically calling for calls there. Walk us through how those different hedges fit together.
Yeah, I mean, IEF calls is basically the view that U.S. economic growth is slowing and you're going to get the 10-year yield lower on that. You know, this is an area where we've gotten pushback from clients all year that we actually think lower 10-year yields are negative for U.S. equities because to get those yields lower, you need negative economic growth to push you there. So if you are of the view that U.S. economic data is going to slow, unemployment rate is going to rise, you're basically positioning yourself for lower 10-year yields. Qs is very simple. That's just simply positioning. If people have to sell, what do they own? They own large cap tech. You might as well hedge that directly. The XRT and potentially small cap, I think, would fit in the same category if you are worried about consumer sentiment and U.S. growth, then the U.S. consumer has kind of been the white knight of the global economy for the last 5-10 years at least. So if you were to see real risk there, you want to, again, hedge that, you know, through the retailing side. So it's really, I mean, all of these are you know, different sort of varieties based on what you think is the chief risk to U.S. equity markets. The last 6 weeks has been positioning. So I think Qs has worked the best. If you are worried about recession, I think, again, it's 10-year yields lower.
Stuart, it is always great to see you. Always a masterclass when it comes to positioning when we speak. Come back soon. That is Stuart Kaiser of Citi. I do want to go back to Intel because we've really seen momentum pick up just as markets open. Intel shares jumping 18% at one point. That would be the biggest one-day gain since March 2020. We've come off that level a little bit, but still higher by 16.5%. I just want to pull up a year-to-date chart of Intel versus NVIDIA. I know that I'm going to have a lot of people, maybe Matt Miller included,
it's a $100 billion company.
To zoom out, but you take a look at this reversal in fortunes just in the early months of 2025. Intel up 22%, NVIDIA down 13%. I don't think a lot of people saw that coming.
Yeah, the PE still, though, is the ratio that we should watch at in a market that is now looking at valuations. What's interesting to me, you know, we did this with Starbucks. How much money?
Wait, what is the PE? I'm looking at 39 on NVIDIA.
Right, and so the estimated
Intel?
PE, we don't have it on the Bloomberg terminal. I'm wondering it's because of the earnings story that they have there.
I see
what they're actually
50 as
posting.
the estimated PE on
Estimated,
Intel.
right.
Yeah.
And so, yeah, price to earnings ratios here correcting. But another point I want to make out is Lip Bhutan, $16 billion man. That's how much has been added to NVIDIA's market cap, not NVIDIA, Intel's market cap just this morning on the heels of that pretty stunning rise.
Making it a $100 billion company.
There you go.
Compared to what for NVIDIA?
A gazillion?
2.8 trillion.
Right, I didn't have that off the top of my head. Pretty staggering. Anyways, coming up, we're going to talk about shelter from the storm. Microsoft snagging a Wall Street upgrade thanks to its consumer exposure. Details on Top Calls next. This is Bloomberg.
AI, how it has penetrated pretty much all sectors, including music. AI can write music, compose music. How do you see AI changing the landscape in fashion?
Yeah, AI definitely helped. When I did the jewelry, I used the AI, helping me to give some idea. But ultimately, you still have to do a lot of it. To just give you very superficial ideas, but at the end, you still have to customize and have to really make it and do that. I do not think that AI and the technology can replace the human mind at this moment. Yeah.
Are you concerned one day we won't be able to differentiate designs by AI and designs by an actual designer?
I don't know. For me, I see that, when a designer doing is the spirit, is the heart that the computer don't have.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets
with the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
All right, welcome back to Open Interest. Taking a look at stocks accelerating to the downside right now. The S&P 500 now down 0.4%. A lot of interesting action when you take a look at the NASDAQ 100 down about 0.7%, even with this huge rise that you're seeing in Intel. Its biggest day since March 2020, not helping out the benchmark right now. It's the small caps, actually, that are still outperforming for the day. Very small gains, but that's all you need in this market. The Russell 2000 up about 0.1%. Meanwhile, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Wells Fargo getting raised to a buy over at RBC. The analyst says that the stock's weakness provides a good entry point. Next up, we have Microsoft getting raised to a buy over at D.A. Davidson, with the analyst saying that it has the least consumer exposure compared to its big tech peers, making it best positioned for a slowdown. And finally, American Eagle getting downgraded to a sell over at Barclays, with the firm citing macro headwinds that are weighing on teen spending. Now coming up, private capital firms under pressure. We'll speak with Goldman's Alex Blostein next in our Wall Street Beat. This is Bloomberg.
Loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Wall Street more and more is adopting unmarked assets. Private equity, venture capital, private ABF, private credit. Those things aren't marked. Mark to market is what creates the need for honesty. And to me, the next big risk is, in this sea of subjectivity, in this changed environment, will investors really know what they own? Or does everything become Silicon Valley Bank and Lehman Brothers?
Strong words. That is Jonathan Lewinson of Diameter Capital Partners speaking with me about the next big risk. And that brings us to the Wall Street Beat, because the large alternative asset managers that are publicly traded have underperformed the broader market since the start of the year. And in a recent note, Goldman Sachs senior analyst Alex Blostein wrote that the sharp decline has largely been a function of rising earnings risks to capital market sensitive earnings streams. Alex Blostein does join us now here on set. I mean, these stocks are just so reflective of me to how high the hopes were for an IPO and M&A boom that never seemed to materialize. We're almost through a quarter of the year.
Right. Well, thank you for having me. Good to be with you. So you're certainly right. I mean, the stocks come in really heavy into the beginning of the year with expectations for capital markets recovery just starting to finally pick up. That is not the environment that we're in so far this year. So in the note, one of the things we pointed out is that if you stress the earnings stream for all these companies, there's about a 15% earnings risk to where consensus is for 25, 26. But importantly, these models have also become a lot more durable. And one of the things we keep pointing out to folks is that the management fee streams for these businesses have been growing through effectively every capital market cycle. So when you go back to 2018, 2019, when you look through COVID, when you look at the regional banks crisis, the management fee stream has been very durable, predictable, and growing. That's the part of the model that we're really focused on.
Well, I think this note captured a lot of people's attention because private markets are inherently private, and there's a lot of skepticism and curiosity about what it actually looks like. And the FT had a great article about it, and our chart was private credit underperforms. Theirs was in private markets, no one can hear you scream, or something to that effect. So when you take a look at the stock performance, is this really just these stocks coming off after a really hot 2024, or is there something at work in private markets?
Yeah, so we don't think there's a systemic risk in private markets. And when you look at how the asset class performed throughout the recessions and throughout the downturns. Inevitably, there's going to be slower returns, but the asset class has done much better, and actually much better than a lot of the public asset classes. So the thing that we keep focusing on is that the business models for a lot of the alternative managers have evolved drastically. And Chanel, you and I talked about it a bunch in the past, where the reliance on carry balance sheet income is what's likely going to be most scrutinized. When you look at the other end of the spectrum, and when you look at management fees, when you look at fee-related earnings, we think that continues to grow. And look, the fundraising environment could get tougher because people obviously expect to get some of the capital back. That could slow down some of the fundraising. But when you look at some of the larger addressable markets, whether it's the wealth channel, whether it's the insurance channel, that all continues to grow.
I can understand there's no systemic risk now because, you know, these are the smartest people on the street that are putting these deals together. We talk with Lewinson, we talk with Lipschultz. You know, these are very intelligent dudes. But if the popularity of these products grows, right, the underperformance year to date notwithstanding, does that present a risk? You know, do regulators or does somebody have to step in and make sure that this market doesn't get so popular that they're lending money to everybody?
Right. So let's unpack that a little bit, right? So the risk that people will mostly talk about is on the wealth side. And that's probably what the regulators will be most concerned about. That space has been growing rapidly, but in the context, it's about $300 to $400 billion in assets as a whole. So in terms of the size of the market, the size of the kind of other invested product, it's actually still quite small, with the average allocation towards private strategies within wealth still running in kind of like a low single-digit rate, right? So in terms of the amount that's at risk, it's actually still quite manageable. The problem becomes when it comes to liquidity. And when you don't have liquidity in the system, and when you have a lot of withdrawals from these funds, that's where it becomes an issue. That really hasn't been the case, and obviously there's a 5% limit for a bunch of these funds. So unlike traditional funds, you can't get your money out as quickly.
Right. So, unless you have Apollo backstopping you.
Well, yeah, we'll talk more about that. But you know, the size of the drawdown you've seen this year, Apollo, KKR, Blackstone, all down 20% or more. What does that say about how investors feel about the assets that they hold? There's a lot of question, you heard it from John Lewinson at Diameter, about whether these marks are not keeping up to what you're seeing in the public markets.
Yeah.
If you're seeing this much pain, could it be possible that you're not seeing more pain in the private markets?
Yeah, I mean, listen, like, you will see more returns of compression in private markets if this continues, right? Obviously, these are not bulletproof strategies. There's always going to be a lot less volatility in the private strategy versus what you see in the public market. In the public market, you also have to deal with the dynamics of liquidity, right? Like, if you get a lot of withdrawals from even mutual funds or ETFs, that's going to put pressure at a time where the banks might not be intermediating as much as they used to. So there's a lot of technical things at play as well between what you're seeing on the screen and the returns of some of these products.
We have a minute left with you. You mentioned ETFs. I want to talk about the State Street Apollo Private Credit ETF. I'll actually be speaking with State Street's Anna Paglia at about 12 p.m. today about that. It's been live for just about 2 weeks. It's only taken in 2 days of net inflows, which is a little bit stunning to me, given that this product was so hyped.
Yeah.
Is there anything to extrapolate out about demand from the retail crowd, from the wealth crowd for private credit from that?
So to your point, still early days. I think the product is a little bit more complicated, a little more complex as well. It's the first kind of ETF and a private credit in one wrapper. So it's a bit early days. If we look at other strategies that have put up flows so far through the first kind of week and a half of March, they're still positive. So, you know, Blue Owl, obviously another really large player in wealth and retail, is kind of pulling back from private markets. The ETF obviously is new and it's a bit complex, so that's probably takes a bit of time.
Alex, awesome to have you here. I hope you come back and join us again. Alex Blostein there of Goldman Sachs. A couple of headlines here coming across the terminal. Number one, Oracle, according to the information, is the leading contender to help run TikTok, which is something that we were joking about only yesterday. And then the NASDAQ 100 falling now more than 1% to session lows. You can see markets are down across the board. When we come back, we're going to talk to Regina Mayer of KPMG. This is Bloomberg.
Bloomberg surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Michael Wallace. This hour's scheduled Senate confirmation hearing is off. CBS's Alexander Tin explains.
The White House has scrapped its pick to head the CDC, Dr. Dave Weldon, amid mounting questions over the former congressman's record criticizing vaccines and efforts to strip the CDC of its vaccine review authority. One official told CBS News that it was clear he did not have the votes in the Senate to be confirmed.
Police in Connecticut are holding a briefing on the 32-year-old man who was allegedly imprisoned by his stepmother for more than 2 decades. Waterbury Police Chief Fred Spagnolo.
There's some physical evidence that was seized from the house that does corroborate the fact that that room did have exterior locks on it and a number of different styles of exterior locks, as was explained during an interview with the victim throughout the years.
The man escaped by setting fire to his room. He told police his stepmother only gave him 2 cups of water a day. He weighs 68 pounds. Senior U.S. officials are in Moscow presenting the 30-day ceasefire proposal they worked on with Ukraine. But CBS's Vicky Barker says the deal may be dead on arrival.
President Vladimir Putin's foreign policy advisor Yuri Ushakov has just said any temporary ceasefire would just give Ukraine's military a chance to rearm. That echoes similar comments from his boss. Ushakov suggesting Moscow's only interested in a long-term settlement that, quote, takes into account Moscow's interests and concerns.
CBS's Ed O'Keefe reports a government shutdown is looking more likely.
With Congress facing a Friday midnight deadline to fund the government or risk a government shutdown, Senate's expected to vote on a stopgap 6-month spending plan on Friday, but Democrats are warning Republicans don't have the 60 votes necessary to break a potential filibuster and get it passed.
Heavy rain in burn-scarred areas of Southern California has some people evacuating. KNX reporter Craig Figner is there.
This storm brought heavy rain to Southern California, and it has created yet more problems along Pacific Coast Highway. PCH is closed at several intersections, and this has been the warning that any time there's bad weather like this, it renews the threat of mud and rock slides.
Some areas are getting an inch of rain per hour. Versace will no longer have a Versace at the helm.
How to bring Versace in the 21st century? How to keep Versace relevant?
Donatella Versace is resigning as chief creative officer after 3 decades. She'll take the honorary role of chief brand ambassador. Wall Street slide continues this morning at the open. Dow down 180 points, NASDAQ down 229, S&P down 40 points. President Trump threatening 200% tariffs on European wine and champagne as that tariff war continues. This is CBS News. A St. Louis father will be sentenced today for shooting a youth football coach over his son's playing time. More from KMOX's Michael Calhoun.
St. Louis Circuit Attorney Gabe Gore said this could have easily been a lethal encounter for the coach as well as for the children and family members present. That parent, 45-year-old Daryl Clemens, shot the volunteer coach, 34-year-old Shaquille Lattimore, near a practice field in a city park in 2023. He claimed the coach started the fight. A jury found him guilty last month. The state wants him sentenced to no more than 13 years.
The Justice Department has charged 3 people with trying to steal FEMA benefits after the Southern California wildfires. 2 Texas women each collected more than $25,000 after submitting forged leases and claiming their houses were destroyed in the Eaton fire. A California man tried to get benefits for an Altadena home he never owned, but he was caught when the home's actual owners applied for assistance. Each face up to 30 years in prison. Michael Wallace, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube as well. Alex Steele and Paul Sweeney here with you. Markets trending lower a little bit here. Got the S&P off about 0.5%. Coming up, we're going to get the latest out of the tariff story, this time from Europe. Albertina Torsoli, European Transport Industries reporter for Bloomberg News. She's going to join us in Paris. Talking about some tariffs, some significant tariffs on some European goods here, 200%. Nancy Dode, private wealth advisor at Ameriprise Financial and CEO of Opus, give us her thoughts on these markets here. Is it time to buy this sell-off here? Ira Jersey, Bloomberg Intelligence chief U.S. interest rate strategist, get his thoughts on some of the inflation data we got today and yesterday and what that means for the Federal Reserve. So we got a lot coming up in this hour. We've got some company earnings coming out of the tech sector as well, so we'll check in with Anurag Rana from Bloomberg Intelligence as well. So a lot happening here. We'll stay on top of it. Right now, let's go to John Tucker and get a Bloomberg Business Flash.
All right, this Bloomberg Business Flash being brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/around the clock. Stocks falling. Bond yields, they are higher right now with uncertainty running high around the economic impact of the trade war. You had 5 of the 11 major industry groups in the S&P 500 lower. Consumer discretionary, that was the worst performer. That's home to Tesla. Tesla shares, they are down over 5% right now. Most active, Intel, do this real quick, up 16.5% right now. Lip-Bu Tan named the CEO job. Not exactly a household name, but he's got a pretty solid reputation in the industry, and investors applauding the arrival despite the lack of a clear signal. He's going to take them in a new direction. Meantime, Lauren Goodwin at New York Live says, you know what, more than anything else, investors need policy certainty.
Good economic data, or at least a relief in economic data like we saw yesterday from the inflation report, that can give you a day or two of ballast. But we don't expect this broad theme to resolve itself until we see policy from the federal government, that uncertainty start to clear up.
Producer prices holding steady last month, the first month without an increase since last July. Right now, the S&P 500 is down just about 0.5%, down 25 points. 55.73. So since it's high, it is down, what, 9.5%. So I'm going to say it again, flirting with correction. The NASDAQ 100 right now, 172 points higher. That's down 0.9%. That is down over 12%. The Dow Jones Industrial Average, 119 points lower. That is down about 0.3%. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex, Paul.
Hey guys, happy Friday Eve.
Absolutely.
Yeah,
That's
look
where
at
we
that.
go.
We are moving to Friday.
Okay.
Alex Steele here alongside John Tucker and Paul Sweeney. This is Bloomberg Intelligence Radio. All right, let's take a look at some stocks on the move today. We're joined now by Bloomberg's Isabel Lee. What's the top stock you're watching?
Intel, you can't ignore it. Shares jumped as much as 18%. That's the biggest gain since March 2020. It really just is on the back of Lip Bhutan being the new CEO. So Lip is a Malaysian-born, Singaporean-raised executive. He will take the role on March 18. He will rejoin the board after stepping down. And what do we know? He's the former head of Cadence Design Systems, and he's really just tasked with restoring Intel, which has been once a pioneering chip maker that's now become an industry laggard. It's also been burdened with debt and recently slashed around 15,000 jobs. And Wall Street is cheering this. We have Bank of America upgrading shares to neutral. They're citing Tan's solid track record. Cantor also said Tan is a solid choice. Bloomberg Intelligence says strong track record as a CEO, so everyone seems to be really all in on this.
It's rare to see a stock
yes,
move
and to John's point, he's not a household name, but he seems to be very known.
Is he gonna split the foundry and the chip business?
Wouldn't you like to know?
I would like to know.
Yeah, wouldn't you like
Pat
to know?
Gelsinger wasn't going to do it, so we know what happened to him.
Yeah. He said he will continue it, but it remains to be seen what continues mean.
And also, you know, you have to look at like JVs, partners, like will that come into play? Also, the short interest was pretty high too, so I wonder how much of that is going to be some kind of short covering. What else do you have?
American Eagle. So I haven't shopped there in a while, if
Right,
ever.
because you're not 12.
But the retailer's forecast operating income missed estimates, so there is that. So it overshadowed the earnings beat. We have first quarter forecast. So get this, the operating income for first quarter they estimate is 20 million to 25 million. The estimates is 82 million. And capital expenditure for 2026, they're estimating 300 million. The consensus forecast is 230 million. Fourth quarter net revenue came in line, even EPS was higher, but really, they're just really bracing for margins to be impacted by tariffs. That's according to Bloomberg Intelligence. And around 17 to 19% of their goods are from China and 20% are from Vietnam. So I guess this is an example of how much tariffs will affect American companies.
I just got a couple pieces of new clothing in the last couple of days.
From American.
Oh, okay.
One
Talk to me.
was made in Malaysia, and one was made in Vietnam, not China.
Yeah, I'm seeing a lot more Vietnam. Thailand, too.
Yeah.
Oh, Vietnam is now it was the United States' biggest ally, strongest ally in that region.
Yeah.
But let me ask a question. How many manufacturing companies from China just moved to Vietnam versus like an
I do not
actual
have the answer to
U.S. company sourcing from a Vietnamese company?
Yeah, it's interesting stuff.
All right, what else?
Let's end on a good note. Dollar General up around 6.5%. So the discount retailers predicting sales to grow in a range that's top end of Wall Street estimates. So the company said comparable sales will gain as much as 2.2% this year. That's in the bag of analyst estimates, which is 1.8%. So this is interesting because Dollar General and other discount stores have been struggling. Big box retailers like Dick's Sporting Goods and Macy's have also been underwhelming investors. I haven't been to a physical store. I feel like I've been saying that because I just shop online. But they're still planning to open around 575 stores this year. And that's after topping 20,000 locations last year, which is hard to imagine.
I mean, they're good when you want to buy stuff for like your daughter's birthday party. You don't want to pay a lot.
Okay, fair.
Like it definitely, not that I've done that. I totally do that. All right, thanks so much, Isabel. Really appreciate it. Isabel Lee, a Bloomberg cross asset reporter. The news of the day that sort of wowed the market here is Trump is now vowing a 200% tariff on EU wine, escalating trade tensions. Full disclosure, I really like champagne, so I just want to like I have a horse in this race.
Is it a champagne versus Prosecco bias, or you can go either way?
I totally go either way.
Okay.
I usually go Prosecco first just because it's a little cheaper.
Okay.
But I do love my champagne, especially champagne rosé. That's really high on
Does
that
any
list.
of this surprise you? She's got
It really
champagne taste.
Yes, exactly.
Do you buy a discount?
I would, but good question. I used to when I drank more, that's for sure. All right, joining us now is Albertina Tersoli, a European transport and industrials reporter. Walk us through the reaction on the ground when all of this unfolded this morning.
Look, it's been an intense 10 days. It's about champagne, it's about wine, it's about retaliation measure, US, EU. I covered the automotive industry. I've covered the drinks, champagne, wine industry, cognac. You forgot cognac while you were talking earlier on. You know, it's a vicious circle here. Tariffs announced, retaliatory measures. I mean, we're still waiting to get a clear sense from France, because France here is clearly targeting targeted. And as soon as the U.S. president posted on social media about the 200% tariff on EU wines and champagne, you immediately saw a knee-jerk reaction in the market. LVMH, the owner of brands such as Louis Vuitton and Dior, but also the group also has a wine and spirits business. The shares declined. The same thing for cognac maker Rémy Cointreau, Campari. I'm sure you're well aware with the name Campari, Davide Campari, the company. Spirits maker Pernod Ricard. These are big names. I mean, it's interesting because the spirits industry has been at the focus of trade tensions before. They're never spared. What is a bit newer here is the attack, I would say, on the autos industry. The healthcare industry is wondering what's going to happen to them. It's quite intense, and retailers as well, of course, also wondering what the implications will be. So it's unlike previous trade tensions, I would say, linked to tariffs. The previous term of Trump, I think that the scope here is much bigger and really having widespread implications on various businesses and, of course, on markets.
Well, I don't know about you. When I get home today, I'm going to go over to the wine cellar and stock up on my Barbaresco before they slap
Oh, that's right. That's your jam.
That's my jam these days.
That would
That's
hurt.
what we've been
That would
drinking.
There's an American alternative to Côte-Rône, the French wine.
Yeah.
It's called Goats do Rome. I'm not making that up.
I don't think
That's actually awesome.
Albertina, I know you're based in our Paris bureau. I'd love to get your sense of kind of how people on the street are thinking about this. For example, in Canada, people are up in arms about this. You see it all across social media. This has gotten personal. How are the folks in Europe thinking about this brewing trade war here?
Look, I would say that in terms of the drinks, it's a bit early days to know what's happening on the street, but I can tell you that we've been tracking the automobile industry very closely. And it's not only linked to tariffs, but I'm sure that you've seen the same in the U.S., in California in particular. There's a lot of angst towards Tesla cars. Tesla, sales and registrations have gone down in Europe, in Paris and France as well. And there's been attacks on Tesla cars, actually, put on fire or destroyed Tesla cars. So there are implications. I don't know if we will see larger impacts against U.S. products. I think it's a bit early for that. But I can tell you that there's a lot of soul searching going on at C-suite level with CEOs who are trying to plan around how they can go about exactly doing some planning for these tariffs. How long will these tariffs last, and will they really be applied or not? Because I think that the main sense, but maybe among the public as well, was that during Trump 1, there was a lot of talk, but not a lot of action. And I think that even before Trump took office, there was a sense that it was just a negotiating strategy to, call for tariffs and threaten tariffs and then not apply them. I mean, 2 nights ago, we saw here in Europe the metal and aluminum tariffs taking effect. So it's not only talk this time around. And I think this still needs to sink in. And of course, then there's the observation of how are markets reacting, and will this hold back Trump a bit and his administration? But I think that there's more question marks than answers today.
All right, Albertina, thank you so much. We really appreciate it. Albertina Torsoli, European transport and industrials reporter for Bloomberg News, reporting in from our Paris studio. Trump vows 200% tariff on EU wine, escalating trade tensions. It's getting a little bit dicey out there. We'll have more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash being brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitment. Offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. Major stock averages all low right now. The S&P 500 appearing some of the earlier losses right now, down 12 points. That's down 0.2%. 55.86 on the index. The NASDAQ 100, that's down 0.5%, down 102 points. And the Dow Jones Industrial Average 48 points lower. A couple of economic reports. Inflation at the wholesale level last month, milder than economists expected. Separate reports said fewer U.S. workers applying for unemployment benefits last week. It is the latest signal the job market remains relatively solid. But overriding that, the trade war uncertainty. In the S&P 500, the laggards right now include Meta Platforms, that's down 2.5%. Amazon.com down 1.5%. Apple shares, they're down about 0.8%. NVIDIA actually the leader in the S&P 500 in terms of index point right now. That is up about 0.9%. And then Intel, hit that again right now, up 16.5%. in the early going after naming the new CEO. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, John Tucker. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. And Ira Jersey will be joining us in just a second to break down his call for U.S. interest rates. In the meantime, let's get to these markets. Is buy the dip something that is still in the cards? Nancy Daoud is private wealth advisor at Ameriprise Financial and CEO of Opus, and she joins Opus Advice First to join us now on the markets. Nancy, I know you might have a longer-term outlook, but what we haven't seen is a true buy the dip, a la what we've seen for the past, say, like 10 years at the end of the day. Do you think it comes back?
Oh, I think so. I think the investors are, focusing more on the trees and they're forgetting the forest. There's a lot of emotion out there. I mean, really extreme emotion. And it's almost like personal. There's a lot of noise about tariffs and in reality, nothing has really taken effect for us to even see the outcome yet. And we're undergoing an enormous transformation. There's so many changes happening and at dizzying speed. So there's a lot of emotional reaction. And when there's this much emotion, there's not a lot of rational thinking. However, I do think that this is a great opportunity to buy. And also, if you're an accumulator, there's an opportunity to dollar cost average. If you're a retiree, it's a fabulous opportunity to rebalance, but focus on the longer term because this is certainly not going to last.
So, Nancy, what are the conversations you're having with your clients right here? Do they feel like it is kind of a buy on the dip, or do they feel like, maybe something's fundamentally changing out there?
Well, I think it's both. There's definitely many things that are changing fundamentally. What we don't know, and this is what's creating so much uncertainty, is what will that change bring? Will it be a positive outcome? Will it be a negative outcome? And you've got very polarized opinions on this. You've got the one side saying, oh my God, this is great. This is going to be so positive and it's going to be a great outcome. And then the other side saying this is doom and gloom and the world is going to end and the sky is falling. And therefore, we really don't have the answers. But I think that, first of all, statistically, it's not unusual for the S&P to dip or to have a correction mid-year. Pretty much every year since 1990, that has happened. So this is not really unusual when you're investing in stocks. And I think we just have to wait and see what the outcome will be.
What's a good mix if we're looking at stocks, bonds, alternative assets, when we sort of have to manage this volatility?
So that's very personal. Obviously, it all depends on the time frame of your goals and also, what I call stomach lining and how much appetite for risk do you have. But the opportunities always lie with the sectors that have taken the biggest hit. And I would say financials, technology certainly have taken a very big hit in the last couple of weeks. So that would be an opportunity. Underweight healthcare, that's definitely not going to recover for a while. And broadly diversify. The good news in this market is that there's an opportunity to broaden the diversification a little bit. The S&P broader market is much more of an opportunity than just the 7 or 10 stocks that have led the market in the last couple of years.
Fixed income, Nancy, how does a fixed income component fit into maybe your average client's portfolio? How do you think about fixed income today?
So I think that today the opportunity lies most in longer term durations, where before that was, something you avoided like the plague. But now that's probably an opportunity. Mr. Powell said that he will likely cut interest rates at least twice this year. We have yet to see if that's going to be warranted or not, but that looks like an opportunity to lock in those yields.
All right, thanks so much. Really appreciate it, Nancy. Wonderful to get your perspective. Oh boy, Nancy Daoud, I got there. Private wealth advisor at Ameriprise Financial and CEO of Opus Advice First. So let's pivot right off of that and talk about the bond market with Ira Jersey, Bloomberg Intelligence chief U.S. interest rate strategist. So for the long term, are we in a place where that long end duration makes sense?
So I think that we'll probably see a lot more volatility, so that means you'll have a lot of mark-to-market risk. But depending on who you are as an investor, getting 4.5% Treasury yields for the next decade or 3 decades might fit your profile, at least for a portion of your portfolio. But nonetheless, remember those long duration assets. If we wind up seeing 5% Treasury yields again, which is not impossible, then you can wind up seeing the price of those bonds go down by 10, 15, even 20 points just because of the relationship between price and yield. So you have to be able to weather that kind of volatility if you're going to buy 30-year Treasury bonds.
Ira, we got some PPI data today, in line with to maybe a tad on the dovish side. Same thing yesterday with CPI. Do we put much into these data points on inflation, or do we recognize that they're backward looking and they don't really take into account some of this tariff talk?
Yeah, I think you're right, Paul, is that the tariffs are not in these data, right? So until we actually see some data with some of the tariff effects in them, I think that people are going to continue to look through them. But that being said, it is a bit positive, particularly the PPI data today. When you look at the ex-food and energy being down a little bit, it shows you that we're starting from a point where if it wasn't for tariffs, then you'd probably have some good prices that were still basically flat or down a little bit, which is positive for inflation. Now, you did see in the CPI report yesterday that goods did contribute positively for the 3rd month in a row. And that's a sign maybe that goods prices certainly are stabilizing. Interestingly, and I think this is even more important, something that's not reflected by tariffs and not affected by tariffs is that you have seen a downtrend in the pace of price growth in the services sector. Now, that is heavily reliant on and affected by the housing market, but even excluding housing, you haven't seen a significant shift in that dynamic where even services prices are not rising as quickly as they were a year ago or certainly 2 years ago. And I think that that's a positive from the Fed's perspective.
Which raises the question, when does this data start to count? In that, we heard from Howard Lutton, the Commerce Secretary, saying the 3rd quarter, the Trump administration will take ownership for the data, definitely in the 4th quarter. So if we're just kind of wait and seeing into how that works, what's the trigger that we're looking for? Then what's the data point we need to focus on when apparently we're not going to have clarity for months?
Well, it won't be one data point, right? And I think that the fear right now, and certainly some of the data that's come in, has been weaker than expected. And what's worrying me and concerning me a bit is the retail data. So some of the consumption data suggests that the consumer is slowing. And look, I came into this year reasonably optimistic that we'd avoid a recession, and maybe we will. But when you have consumption data in particular slipping, and consumption and the consumer were the thing that really propped up the market and the economies over in 2020. 2023 and 2024, when just about everyone in the economics community was saying that we were bound to have a recession. When you see that consumption start to slip, that is more concerning than anything else to me. And so I'll continue to watch things like retail sales and the personal consumption expenditures data, not necessarily the deflator, right? Not the inflation component, but the actual personal spending numbers and what people are spending money on. Because one of the issues too is that, which could be good, is that if food prices continue to come down, you saw egg prices come down today, by the way, just it's something that's been talked about a lot by investors in our chat.
Is that right?
Yeah, absolutely. Yeah, we have about 1,600 customers in a chat, the Rates and FX chat, and eggs were a big talking point. Yeah.
So you think I know you're not the eggs analyst, but is the feeling that eggs have peaked?
It seems that way, and part of that seems to be supply, right? Is that there was bird flu related things where there were a lot of flocks, I guess, culled, and now those are coming back online. But nonetheless, if people spend less on eggs, then that means they might spend more on other things, right? Like going out to eat or other services, maybe going, doing more experiences and the like, which has been really a bright spot of the economy. So I think there could be some substitution effects that might occur that could actually help the economy maybe in the second quarter. But again, that's the data that I'm really going to watch to Alex's question.
I feel like we reached peak egg because over the weekend I saw my two girlfriends. I hadn't seen them in like 6 months, and guess what we talked about?
Eggs.
Yeah, I mean, among other things, like we still did girly chats.
Chicken eggs?
But we talked about the price of eggs. And I was like, this has to be the top indicator now.
There is, for what it's worth, there is an egg index on the Bloomberg terminal, and it does show it is down 11% over the last probably a week or so off the peak.
There you go. So we're getting there. Oh, no. No egg puns. No, too bad. Ira, hey, the Fed next week, what's going to be the thing you look at?
Yeah, I'm going to watch the dots because even though there are some people who think that maybe the Fed's not going to change their dots, I do think that maybe they're going to get a little bit more dovish, just based mainly on the recent Fed speak, as well as the fact that our natural language processing model of the Beige Book showed that the Beige Book fell pretty dramatically in the latest reading. So and the Fed tends to overweight that particular survey measure. So I do think that it's going to be a little bit more dovish than last time, probably pretty incremental, though.
Ira, thanks so much. Appreciate it. Ira Jersey, Chief U.S. Interest Rate Strategist, Bloomberg Intelligence. The ticker for the USDA large egg prices paid to producers, Midwest U.S. EGG YLPMW. We're now down to $7.22 per dozen. It was as high as $8.24 per dozen. But going back before the world got crazy here, it's like $2 a dozen. So that's kind of where you need to get back to. So it's down 11% from the peak, but still way, way above where we were. So there you go. Your eggs analysis right there.
I'm not doing it. I'm not doing it fun. All right, coming up, Anurag Rana, Bloomberg Intelligence Technology Analyst. We'll talk about Adobe earnings, talk a little bit about Microsoft and the FTC. I thought maybe this administration will be different. It looks like it won't be. We'll break all that down. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Stocks falling, bond yields, they are higher right now, with uncertainty running high around the potential impact of the trade war. Almost evenly split between the gainers and losers in the S&P 500. And Intel, that is the best performing stock in the index. It's up over 16% with the new CEO. Adobe, the worst performer, that's down over 11%. The earnings, kind of a mixed bag there. The latest threat from the Trump administration, that 200% tariff on wine, champagne, and other alcoholic beverages from France and the European Union.
Do you really drink wine from France?
Yeah, no, I actually love it.
Okay.
Yeah. But
Keep going.
there are alternatives. Jeffrey Yu at BNY says investors are looking for safety and opportunity.
There's a lot of cash on the sidelines right now. Where will that go? Do I put it in Asia with the China theme, the AI theme, or do I go in the Euro reinvestment theme? But China's openly saying there is an inflation issue, a demand issue. So you've got to pick your sectors very, very carefully.
S&P 500 right now, 29 points lower. That's down 0.5%, 55.69 on the index. The Dow Jones Industrial Average, 152 points lower. That is down 0.4%. The NASDAQ 100 right now, 180 points lower, firmly in correction territory, down 0.9%. The 2-year, 3.99. The 10-year right now, that is up 2 basis points. That's at 4.33. So who's the largest retail chain in the U.S.? Anybody?
Walmart?
No. In terms of the number of stores, with 20,000 locations. Dollar General, ding, 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 ding. Forecasting sales to grow this year in a range with the top end higher than what Wall Street expected. Dollar General shares right now up close to 6%.
You know what the number one fast food chain is in the United States in terms of locations?
McDonald's, I guess, is too obvious.
Subway.
Really?
Yeah.
Where's Jersey Mike's and all that?
I don't know. They're Point Pleasant, New Jersey. That's all I know.
All right. We check the markets for you all day long right here on Bloomberg Radio. So full of useless information. Alex and Paul.
I love this random information that I find very useful. Thank you. All right. Alex,
do you
here
shop at
alongside
Dollar General?
Yeah, for my daughter's birthday and stuff. We're in Massachusetts. Absolutely.
But not for clothes.
No. Do they have clothes at Dollar? No, you crazy?
Yes, I bought a sweatshirt there.
Oh, boy. All right. Alex Steele, Paul Sweeney, John Tucker. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. So let's go right to Anurag Rana, Bloomberg Intelligence technology analyst. Adobe stock off almost 12%. Walk us through that tepid outlook.
Yeah, I'm a bit surprised about the reaction because, frankly speaking, they did reaffirm their full-year guidance, and you're not expecting in this market for them to beat the numbers and guide up. So I must say that I did not expect the stock to be down 12% after earnings yesterday.
All right, so talk to us about their business. What are they doing well? What are they not doing well? And what do you think the market is saying today with a 12% decline?
So Adobe right now is the most controversial stock in software land. If you look at their valuation, now it's, I think, somewhere around 20 times forward the earnings. There was a time this was more expensive than Microsoft for several years. The biggest issue that investors see right now is what is Adobe's future, the future of its most important product, which is Photoshop and other creative software products. If customers or if users out there can go out and get open source, AI chatbots that can do video generation for them, photo generation for them, and that remains the most controversial thing. Last night, they gave some indication that their own AI products are gaining traction, but that remains the single biggest argument between bulls and bears at this point.
What do you think is going to stabilize the stock here?
I think it will take some time, and what needs to happen is consistent execution from the management team over the next 12 to 24 months and show that their business is not being cannibalized by free AI tools. And if they are able to show that, I think that would help the stock or the valuation at this point.
So what is the broader implications for some of the application software companies you follow, Anurag, as it relates to AI in terms of AI being a threat to some of those applications in and of themselves?
That's probably, again, one of the most important questions in the application software land. We are on the fence, or in terms of we are on the side that application software industry would only strengthen with AI, because at the end of the day, you do need a system of record software. You can't just use a particular agent to get your work done. You need financial software, you need HR software, or sales automation software. We think the bigger companies that can implement some of these AI technologies in their core platform will make it more sticky, will have more ROI down the road. The problem the entire industry is facing right now is the end markets. The customers that they are serving are not hiring at that rate that they used to. And that's a problem because the entire industry is a seat-based model. So let's say, for the sake of example, was a company like Workday. This is a company that does HR software for almost all the, majority of the Fortune 500 companies. If the Fortune 500 companies don't go out and hire more people, that has an impact on Workday's core business, which is a seat-based driven model.
Right. So then the trickle down starts with that. Let's go to Microsoft for a moment as well. The U.S. Federal Trade Commission is moving ahead with an antitrust probe of Microsoft. That was opened just in the last days of the Biden administration. This was kind of a surprise, no?
Yeah, I think I'm absolutely right. This was surprised more so on the headline that, oh, are we going to see the same exact of scrutiny on large tech under the new administration too? We had early indications that that might not be the case. So we'll be watching this one closely, because depends on how aggressive they are with Microsoft and their AI relationship with OpenAI and things like that. So I think, again, from an impact to Microsoft, it's going to take several years before anything happens. But I think this is more of a broader message for the entire tech industry.
So what are you hearing from the Microsofts of the world, particularly as it relates to this Trump administration and kind of the regulatory oversight you think they might be able to expect?
I think they're all trying to lobby hard to make sure that they are not treated in the same manner that they have been in the last, I would say, not just 4, but about 6, 7 years. In terms of acquisitions. I mean, we saw, they refused Amazon to buy iRobot, and we know what exactly happened to iRobot in the last, few weeks. Same thing is the regulatory environment in EU, how they are targeting U.S. companies for more fines and, breakup threats, etc. I think the election campaign, there was a lot of talk about how the administration will defend these large tech companies, which is why the announcement of Microsoft was a bit of a surprise.
In terms of, will this represent a continued aggressive administration with tech? Do you think it's a Microsoft-specific issue that we could make an argument here, or do you think the big tech still needs to watch their backs?
I think if one of these companies announces even a small acquisition, then we'll find out whether this is more of specific to Microsoft or in broader, whether it's Apple, whether it's Google or Meta. These companies have not bought really anything relevant in the last several years because of this pressure. I'm curious to see what happens on that end, because that will give a signal as to which direction, we are going to see over the next 4 years.
Anurag, as you talk to your institutional investor clients, what's the AI narrative these days? What's the most recent arc of this AI story?
Yeah, and then that's, again, probably the most important question right now. And the biggest thing everybody was focusing on is what is the capital expenditure requirements? Somebody like a Microsoft is committed to $80 billion of AI-related expenditure this year. The question is, what's going to happen next year and the year after? Because at the end of the day, I mean, this has to come at this is going to impact margins. It's going to impact, return to the shareholders. But unless the investors see revenue on the other side, this is going to become, I think, the single biggest issue for the entire tech industry as to if you're going to spend, let's say $200-300 billion in total on new capital expenditures, where is the return of that? I think that is going to be the narrative for the rest of the year.
And then also, how quickly can you get that money up and running to then deliver returns, which brings me perfectly to my next guest. So, boy. Yeah, look at that. All right, Anurag, thanks a lot. Really appreciate Anurag Rana, Bloomberg Intelligence Senior Technology Analyst. And I'm speaking, of course, of my guest that I had at CERAWeek. It's a global S&P Global Energy Conference in Houston, Texas. And I talked to a lot of the power players. Now, if you're a data center, that's who you're talking to, are those power players, right? There's a narrative on a couple different fronts. One is that you have the hyperscalers are very worried about being too long power. that they spend too much money buying power that they eventually don't need. So there is a narrative that they're actually a little skittish on going out and getting these deals. The other narrative is that no, they're not. They're just getting them from certain companies that have already executed on these kind of power arrangements. But nonetheless, like, show me the money. Like, where are the deals, where the checks being signed? How do they work out, like a Microsoft and Constellation Energy? So to this exact point, I was able to speak with NRG Energy CEO Larry Coben. He's been in this industry for decades and decades and decades. It's one of the stocks, along with Constellation and Vistra, that moves like an AI stock because they're the ones that power the environment. And I asked him first if the rising power growth demand that we've seen has actually been driven by this power demand and AI.
No, I think it's a lot of things. It's also onshoring of manufacturing. For example, here in Texas, there's a 1 gig Samsung plant that's going to be opened in a couple of years. It's the Internet of Things. It's smart homes. People are just, it's electric cars. People are just using more electricity in ways that they never did before. And as a result of that, that's part of the demand cycle. Obviously, data centers are a big part of it, but data centers aside, all of the people who build data centers also are involved with cloud and a whole slew of other services, search, that we don't think about because we've had them for so long. But the growth for those is increasing every bit as much.
And you guys are one of the largest independent power producers in the United States, right? So you can really take advantage of this. Where is the biggest demand for what kind of power? Give me some insights into the conversations you're having right now.
Sure. I think, competitive markets, the two biggest ones would be Texas and PJM in the Northeast. Texas is a primary focus for us, though we do have a strong PJM presence. One of the things we like about Texas is it has a friendlier permitting environment, and it has one public utilities commission and one governor. ERCOT has 13 states in it, plus the District of Columbia. So that's 14 commissions, 14 governor-like people, and FERC, which doesn't have any jurisdiction here. So, but I think you're going to see data centers in all of these places and in other places where economic growth is going on. It's not going to be limited, but I think Texas is going to be first.
Do you think that the hyperscaler hype about how much they're going to spend on power demand is real? Or is it going to fall short?
I think yes. I mean,
it won't fall short, or
it will not fall short.
Okay.
It may even go up.
Okay.
And the reason I think that is, it's interesting. After DeepSeek, everybody was super concerned about that. And then 3 of the hyperscalers came out and essentially doubled their capital commitments. Now, if they actually, after looking at DeepSeek, decide it's going to be twice as much, then that gives me a great deal of comfort that the power demand is going to be there. And, I know everybody's talking about Jevons paradox because everyone has now Googled it for the first time. I'm actually old enough to remember what it was originally. But, I think people will start using this more and more. I already see it in our business. We are using enormous amounts of AI and customer service, and we're only just scratching the surface.
Speaking of, you're going to be developing 5.4 gigawatts by 2032. Right? How much of that is going to be fully contracted, and how much of that will be more merchant spot price?
We have 1.5 gigs that is shovel ready. That will probably go, most of that will go directly into the Texas market.
Okay.
Anything we build beyond that, I would anticipate would be fully contracted for, related either to a data center or another kind of large user along the way. We are not in the business of taking merchant risks. Some of the other folks are. We actually like to protect our downside and give ourselves a lot of optionality to the upside so that we don't have to care whether the growth is 2% or 10%. Both of those are ginormous for us.
So what kind of pricing are we talking about for a gas-fired plant, for renewable, for other power? Like what does it look like right now?
I mean, gas-fired plants, we think they're going to be done for $1,500 to $2,000 a kW installed. The ones that are shovel ready, because we started on them 5 years ago, will be much less. But if you're not in the business actively doing it, you're going to have a hard time hitting the top end of the range. Renewable pricing hasn't changed dramatically. It's just that the load curve is changing as people there's more 24/7 power use coming in, and, sun doesn't shine at night, wind doesn't always blow, but renewables aren't dead. They're going to...
Are you sure?
Yes, actually, I am sure.
Okay.
Because there's still a place for them when they're working in conjunction with gas plants. I mean, part of our portfolio now, we actually shut off our fossil fuel plants during the day when there's a lot of sun and wind in Texas. We buy from the grid their power and sell it to our customers, generating it ourselves. those options are still going to be available, at least in competitive markets.
Well, because speaking of, your renewable unit is 30% of your annual earnings, right? And it's 20% of the renewable market share here in the U.S. How much do you think that can grow for you?
Our renewable, we generally actually contract for renewables rather than own them. It's a strange thing because we own 2 coal plants. Everyone else gets cheaper renewable capital than we do, even though we're a big company and quite good at this. And as a result, what we generally do is contract for that power from other developers. Right now, we've got 2 gigs, and we're probably going to have a solicitation for more going forward. So I still see it as an integral part of our strategy. And a lot of it also will be driven by what the customers want. So at the end of the day, we are in the customer service business, not the electricity business. So it's our job to sell you the kind of electrons that you want in terms of, time, place, and fuel generation. So if you want green electrons, decarbonized electrons, we will have them and we will sell them to you.
Thank you. In terms of the actual agreements, how many agreements are you talking about that's like, hey, we're going to sign well, we like your electricity, we'll sign it, versus like firm demand, here's your paycheck?
We do this every day. We actually supply power already to every one of the hyperscalers. We have the 2nd largest commercial C&I electricity book in the country and the largest natural gas one. So we sign those kind of arrangements. Some of them are short-term, some of them are long-term. I think the new data center ones will all be at least 10 and probably closer to 20 years. A, because we won't want to dedicate our site to something that's less than that. B, we won't want to build a dedicated power plant for less than that. And see, if you're going to pay all that money for those chips and to build a data center, which actually costs more than a power plant, you're going to want that kind of stability for an extended period of time. So I think a lot of those are going to be fixed price deals off market with power scale. They will still be in front of the meter because people will want to be connected to the grid, but they will definitely be long-term fixed contracts.
How soon are you signing more of those?
Stay tuned.
Okay.
Fair question. My next earnings call is May. It will not be then.
Okay.
But, we're working on these as fast as we possibly can. They're complicated. People, think electricity is just like flicking a switch. It's super complicated, but we're making substantial progress towards some very interesting transactions, talking both to hyperscalers and to developers.
Before I let you go, though, what makes it complicated? Is it the pricing? Is it how to structure the deal? Like, is your power going to the grid and then selling back to the hyperscaler? Like, what makes it so hard?
You need an interconnection agreement. You need a construction agreement. You need a turbine agreement. Now, we have all of these in place generically, but they all need to be site specific. You need to decide how big a data center you want to put on the site. How fast are you going to grow that data center? So are you going to start at 200 megs and go up 200 a year, or do you want to start at a gig? So what makes it complicated is putting all of those pieces together. And what people forget is actually for this type of data center is new. Unlike existing data centers where people have done lots of them, there aren't a lot of AI data centers out there yet. But it's complicated, but so is general power plant development, all the permitting and those things. So it's nothing that we're worried about. It's something we actually think we're pretty good at. But
and hyperscalers are willing to put down that money.
Absolutely.
They're showing up, knocking on your door. They're there.
They're there.
Okay.
They're there. We're there. And, because of the agreements we announced last week, the turbines and the contractors are there.
That was Larry Coben, NRG CEO. A big part of that, though, too, is these guys are going to go through a big CapEx cycle because of this, right?
Okay.
So how those agreements are structured, which I was trying to understand, is very complicated, but also necessary. So they have the visibility to then spend that CapEx. So jury's still out to what those are really going to look like.
Yeah, but I mean, just listening to me seems bullish and bullish on the state of Texas. How about that? Yeah, I learned something new that John Tucker and we know that they have their own grid in Texas. They're not on part of any of the national grids.
They know that because they read the grid.
We read the grid.
Yeah.
But that exempts them from a lot of FERC oversight, Federal Energy Regulatory Commission. That's good for doing business.
Oh, yeah. So, why didn't they all go there?
Yeah. Energy. I'm looking at it here. It's good stock.
Yeah, it's done pretty well. All right, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on SiriusXM Channel 121. Access the world's only global audio business network coast to coast 24 hours a day. Bloomberg Radio on Sirius XM. Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, happy Friday. No, it's not. Happy Friday Eve.
Yep.
Darn it. Alex Steele.
Lisa Mateo did that earlier today. You guys are ready to just bail.
I mean, I feel like I just worked 2 weeks straight, so fair enough. Alex Steele here alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We bring you all the top news that you need to know. We are live from our Interactive Broker studio right here in Midtown Manhattan. Also check us out on YouTube. We got a great hour lined up for you. We're going to take some of the interview with the Commerce Secretary Howard Lutnick that played earlier on our air, which is quite interesting, and then go to Michael McKee, our economics and policy correspondent, and talk more about those tariffs and reciprocal tariffs. And then we get to Henrietta Trace, a managing partner and director of economic policy at Beta Partners, as we now inch closer to a government shutdown. Markets, though, blink that aside. And then we'll also talk to Barry Ritholtz, founder of Ritholtz Wealth Management and host of Masters in Business, because it's Thursday. And he always has fun opinions on stuff that we want to know about. But let's get you all caught up right now with the Bloomberg Business Flash with John Tucker.
All right, guys, the trade war continues to weigh on investor sentiment as the major indexes declined. S&P 500 close to correction. Adobe, worst performing stock in the S&P 500 after its earnings. Intel, best performing stock in the S&P 500, right now up over 16%. The new CEO injecting a new sense of optimism. Nora's going to be along with a smarter, in-depth look at that. Meantime, Tracy McMillan, Wells Fargo, says, you know what, recession fears aren't necessarily supported by the data.
This is not setting up like a typical recessionary period because it's being preceded by the weaker sentiment from consumers and not being preceded by weakness in fundamentals.
Right now, the S&P 500, 25 points lower. That is down 0.5% at 55.75. I'll say it again. It's flirting with correction, the index. Dow Jones Industrial Average down 168 points. The NASDAQ 100 now down 147 points. That is a decline of 0.75%. All right, put on your thinking caps. This is an easy one, so I'm going to, Paul, you can't answer this because you're of the same vintage. There is a headline service on Bloomberg. We call it, you know, when it comes out, a special headline that's really important. It's a hot headline because it's in red. What hot headline actually crashed Bloomberg in the early days when it came across? Because so many people hit on it at the same time.
Can you give us a little hint on this?
No.
Like a sector, a region, or?
All right. That brings me to the final story. Variety reports the Grateful Dead's 60th anniversary is going to be commemorated with the 60 CD box set of live shows, 60 hours of music for only $600. It was the death of Jerry Garcia.
Really?
Okay.
Yes.
Wow.
You know who
I
would have
was
known
here
that?
for
Michael McKee. He's a big
Michael
Dead
McKee
fan.
would have known that. Matt Miller would have known that.
Yeah, that's true. Where are they when you need them?
Yeah, exactly. All right, John Tucker, thank you so much. We appreciate that. We've got Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker studio, streaming live on YouTube as well. Head over to youtube.com, search Bloomberg Podcast Live. That's where you can find us. UVA lost in the first round of the ACC tournament. It just
I know you're excited to say this.
Terrible year for our Wahoos. I don't know what's going on down there in Charlottesville, but Nora Melinda, equities reporter, Bloomberg News, and a University of Virginia graduate. Maybe you can go down there and fix it, Nora. But in the meantime, what's going on in the stock market here?
Well, lots to keep an eye on, as John was just talking about. We are keeping an eye on Intel this morning. This is a really big, best performing stock right now. It jumped the most in 5 years. It's jumping as much as 19%. That's the most since March of 2020. And this is after news that the company will be bringing in a new CEO. This, of course, is really welcome news for Wall Street here. They're all rallying behind this guy, Lip Bhutan. He's tasked with, of course, restoring the company to its previous fortunes. Of course, we know it's really been an industry laggard, so all eyes are on what he's able to do coming out of this. But this has really stoked optimism for investors, and we're just going to have to see whether or not he's actually able to pull it off.
And we wonder what former glory actually looks like. Right. We know what the stock price that would look like, but for an actual...
And some of the research I read off the street says one of the reasons they like this person because, well, he's going to kind of continue the Gelsinger strategy. So how's that...
How does that make sense?
I don't know. The stock
We're
price
gonna have to
movement
see.
really surprised me here.
This all makes good sense. And then the next, so she puts in an email, right? Nor puts in an email, booze stocks.
Booze stocks.
Booze stocks, we're talking about alcohol.
Brown-Forman was the worst performing stock yesterday on the S&P.
Yeah, I mean, it's really been in focus as we're looking at Brown-Forman and a lot of its peers. So European drink makers actually fell. Of course, we know that Trump has really been putting a target on putting a 200% tariff on European wine and other alcoholic drinks. But we're also just having a bit of a battle back and forth here when we think about the idea of tariffs. And Trump is waiting to see whether or not Brussels will be following through with a tax on American whiskey imports. So very much so a tug of war here. We're trying to see who will come out with the biggest tax. It feels that way. But I mean, I'm keeping an eye on a lot of these names. Like LVMH, they own champagne houses like Moet and Chandon, obviously Remy as well. And then additionally, Brown-Forman. All these are really in focus right now as we're trying to see how this story plays out.
Well, I just typed into the Bloomberg terminal BOOZ, fully expecting to get a booze, alcohol, spirits ETF, and there is not one. So I'm thinking maybe I go out there and create an ETF for the spirits.
I've been
searching.
searching.
Like a lot of work, though.
Exactly.
It feels like a lot of work.
I like that ticker, though.
Just make Eric Balchunas do it.
Yes.
Yes, we'll get him to do it.
All right, last up, Adobe.
Yes, also keeping an eye on Adobe. This is the worst performing stock right now in the S&P 500 on a percentage basis. We're seeing shares of the software maker down. This is after it had a tepid outlook that really failed to excite the street. Evercore wrote that the report that they put out wasn't strong enough to change the narrative around the stock. I mean, we're seeing shares down as much as 12%. That's the lowest intraday level since 2023. And on a broader scale, we're seeing Adobe shares down 13% so far this year.
All right, Norma Linda, thank you so much. We appreciate that. Norma Linda, equities reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. Well, earlier today, U.S. Commerce Secretary Howard Lutnick sat down for a conversation with Bloomberg TV anchors John Farrow, Lisa Abramowitz, and Anne-Marie Horton. In this conversation, Lutnick praised the UK and Mexico for refraining from engaging in a tit-for-tat tariff hikes with the United States. And Lutnick was first asked how the president feels about recent retaliatory measures. Let's take a listen.
The president has made it crystal clear that he finds this tit-for-tat really abusive and aggravating. Right? His objective is steel and aluminum tariffs. Let him build his steel and aluminum business in America because that's important. And then, they say, okay, we're going to tax whiskey. And look, I find all this back and forth really off the topic. The key topic is rebalancing American trade. We're going to spend lots of time together, but the president was totally annoyed that the Europeans did this. And so you're going to hear back from someone who emotionally cares about America. He cares about America, and he wants to take care of Americans. And why are Europeans picking on Kentucky bourbon
Secretary
or
Lutnick,
Harley Davidson motorcycles?
Are you saying this is an emotional response?
It's disrespectful.
Are you saying this is an emotional response, or will we see 200% tariffs on wine, champagne, and alcoholic products before April 2nd, when the president says is the big one, and we're going to get the reciprocal rollout?
Well, the joy of my job is that Donald Trump makes the decisions, right? And the people around him, we talk to him and we advise him. April 2nd is when we do reciprocal tariffs. And he's called out these products. He wants these countries to respect him. And all this showed you is that Europe and Canada do not respect Donald Trump and do not respect America's ability to build its steel and aluminum industry, which is vital for national security, whereas you watched Mexico and you watched the UK be pragmatic and thoughtful, and the way we're going to deal with them is going to be better. So these are just black and white things. Why would you put against steel and aluminum, would you say Harley Davidson motorcycles and Kentucky bourbon. It's just illogical. I think the president is saying, look, I am going to respond always bigger and always stronger. We will talk together. You know, he wrote that tweet this morning. We will talk together. If that's what he wants to do, we will do that. But the answer is April 2nd, a thoughtful approach to reciprocity and national security of those products he's called out. We're going to increase our domestic production of those and have a reciprocal model. And hopefully when I talk to the Europeans, they'll realize that they should take these things down, cool these things out, and let's properly negotiate.
All right, that was U.S. Commerce Secretary Howard Lutnick speaking with Bloomberg TV anchors John Ferrer, Lisa Abramowitz, and Anne-Marie Hordern, talking about the tariffs and the retaliatory tariffs, and then the retaliatory tariffs against that again. So it's kind of back and forth, back and forth. But we had a European guest on, like I said, a day or so ago, and saying, hey, remember, these other countries, they have political issues as well. Their leaders have to answer to their electorate. If their electorate is upset about tariffs being placed upon them, they have to react. And so why would it be a surprise to anyone that when you lay a tariff on somebody that there's maybe potentially a retaliation tariff? And then I don't know. So we'll see. That's
and like how the off ramp then gets there. Like I think that during the interview they also talked about that, like where the off ramp is and how do you cool it all down, right? I don't know how we manage that at this point. All right, Michael McKee is Bloomberg economic and policy correspondent. He joins us now. Mike, the headlines to the soft data to the hard data. Where are we in connecting all of these dots?
Well, basically the PPI came in today lighter than anticipated, which was good news. You want to see that. We want to see progress. The important thing underneath is that the categories that go into the PCE, and we've talked about this before, how CPI and PPI have some of the data that goes into the PCE, those were in many cases a little bit higher. So it suggests that the PCE inflation will come in higher instead of lower, like the CPI and PPI. So it's not necessarily going to be good news for the Fed. It isn't going to be huge. I mean, we're talking about maybe 50 basis points or something like that. But it will suggest that there's still work to be done on the inflation front.
And what's going to be interesting tomorrow will be the University of Michigan data. I mean, talk about, I guess, kind of a soft data point vis-a-vis a hard data point like PPI or CPI. This is kind of sentiment, expectations of inflation. You think the markets could pay a little extra attention to the UMich stuff tomorrow?
Yeah, it's the calendar is a little bit unusual in the sense that there's no other indicators tomorrow other than Michigan. So it's going to be the thing. If you're going to trade on an economic data point, it's going to be the thing you trade on. And everybody's watching the inflation expectations numbers. And now we probably have a little bit also focus on the overall number in terms of people's confidence in the economy, since there's this undercurrent of are we going into recession. So all of that will get the trading desk's attention. Now, whether it actually ends up moving markets or not will depend on how it works out. If we get another big rise in inflation expectations, then you'll see maybe more money pile into the idea of Fed rate cuts. And same if we get some sort of failure in confidence overall and people think, oh, well, Americans are going to stop spending.
When we take a look at the data set and the timelines, Howard Lutnick was talking about how third quarter is when the Trump will start to own the data, right? And the fourth quarter will be purely reflective of President Trump. Literally, is that true in terms of when the data sets come in and what they kind of factor in?
Well, you can make that argument, and every administration does, but it's really only important to Howard Lutnick and Scott Bessent and the people who go on TV to talk about Donald Trump, because it's the voter who will decide who's the president when the news is good or bad. And generally, they don't really consider the fact that the data are delayed. And so it's Donald Trump's economy now. There's nothing he can do about that. He can say, oh, you know, Joe Biden, this or that. But people are going to say, well, when he was president, gas prices went up or egg prices went up, and especially since he promised to bring them down. And so it's kind of a neither here nor there argument. It isn't going to make any difference to anyone except a voter who's going to look back in time and say, well, who was president when I felt bad?
Yeah, and it seems like if you're the Federal Reserve, I mean, the hard data that we're seeing gives them plenty of confidence, I would think, to wait on doing anything. Is that kind of the expectation here?
They have been suggesting that right now, where the economy is, they're not worried about moving interest rates because we are still seeing inflation pressure, not a lot, but it's higher than they want for their target. So keeping rates where they are keeps some pressure on inflation and will hopefully continue to bring it down. Nobody's talking about raising rates at this point. And they won't cut rates unless they feel that it's not going to be contributing to additional inflation. In other words, if the economy is slowing, and for that they're probably going to be looking at things like the unemployment rate, then they might cut rates. Or if all of a sudden we see people's spending habits fall off a cliff, or businesses just totally stop investing.
And at jobless claims numbers today, in line, I mean, kind of what we've seen here.
Well, you know, I think that's going to change. Okay. Because of the delays, I mean, we already know that there are thousands of federal workers who are no longer federal workers, and we just don't have a good handle on how many. And some of them are getting severance, and some of them probably aren't. And even if they give you 2 weeks, you can't file until you're not getting severance anymore. So, so those numbers will go up. Now, federal workers are in their own separate category, and whether overall claims start to rise will depend on how many of the federal cutbacks lead to contractors being severed and then laying people off, and the support people in the business neighborhood, in the restaurants and things like that, how many of them lose their jobs. And certainly there will be a knock-on effect. We just don't know how much yet. And we're still waiting to see how many federal workers get laid off. There's a continuing claims index for federal workers, and I think that's going to be everybody's new favorite one, because it's going to be the way to count up how many are off the payrolls.
All right, 20 seconds. What's the chart you're sending me later?
Well, I was going to send you. I was going to send you that one, but I can also send you some really good charts on the McKinley tariffs.
And like, what about them in terms of how high they were or what they did to growth?
The president says that was when we were really doing well, but when they imposed the tariffs, inflation shot up. We went into recession, and unemployment rose significantly. So. Yeah,
not so much.
So there's that. And what if you don't know, by this time, Mike and I are really good friends, and he sends me nerdy stuff like all the time. And then he'll send me a chart, inevitably sometimes in the afternoon, being like, look at this cool thing, and then we'll talk about it. So that's my preview.
We have an exciting life around here.
We do, I know. I didn't make it sound
Paul
really cool.
is really jealous.
Yeah, as he's drinking his beer by the beach. Okay, Mike, thanks a lot. Mike McKee, Bloomberg Economics and Policy Correspondent, joining us here in the studio. All right, coming up, Henrietta Treyas, Managing Partner and Director of Economic Policy at Beta Partners, will be joining us. It looks like we could be heading towards a government shutdown. It doesn't really feel like the markets are going to blink on that. And Tony Halpin is team leader for Russia Economy and Government Coverage. What are global investors doing in Russian investments right now?
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash, and we are being brought to you by Oracle. Attention growing businesses, Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. Offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. Uncertainty running high around the potential economic impacts of the trade war. There's more deterioration we're seeing in the markets this morning. 9 of the 11 major industry groups in the S&P 500 are now lower. Consumer discretionary, that's the worst performing group. That is, of course, home to Tesla. Tesla shares right now, they are down 4.5%. The most actively traded stock in the index, Intel. Lip-Bu Tan named the CEO. Investors applaud his arrival despite the lack of a clear signal he's going to take Intel in any new direction. Shares of Intel right now, they are up close to 15%. Overall, the Dow Jones Industrial Average now down 301 points. That is a decline of 0.7%. The S&P 500, 44 points lower, down 0.8%. We're at 5,555 and down 9.6% from the peak. The NASDAQ 100, 243 points lower. That is down 1.25%. World Liberty Financial, one of the Trump family's crypto ventures, they've discussed doing business with Binance Holdings. Binance's founder, you might remember, pleaded guilty to failing to take required measure to prevent terrorists, child abusers, and entities in sanctioned nations from using his service. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us here. As John Tucker is just reporting, the S&P off about 9.6%. I'll round that, say 10%, and that's kind of in that correction territory. What do you make of that? I don't know. Barry Ritholtz joins us, host of Masters in Business on Bloomberg Radio. He's a founder of Ritholtz Wealth Management. You can download the Masters in Business podcast now at Bloomberg.com or wherever you get your podcast, and catch the show every Saturday at 10 a.m. Wall Street time on Bloomberg Radio. So, Barry, you got an S&P that's basically just, hovering right around correction territory. Is that a healthy move in an otherwise positive market longer term, or could it be something else? How are you guys thinking about it?
So the yin and yang of this is anytime you get back-to-back plus 25% years, we should all lower our expectations going forward from that. So had nothing else intervened, perhaps there'd be a little less volatility, but the gains wouldn't have been as strong as we've seen in the previous 2 years. So into that environment comes these tariffs that are, if it's Thursday, or does that mean the tariffs are off? It's on Monday, off Tuesday, on Wednesday. Is this a negotiating tactic? No, he seems to be serious about it this time. The uncertainty, a meme I really hate, but the just lack of clarity and lack of consistent message or reason, or, why are we putting tariffs on Canada? Nobody can really wrap their head around this, is causing some people to hold back on what they would ordinarily spend. They're not booking travel. They're not making CapEx investments. They're holding off on hiring. And so it's not unusual in a market priced for perfection to say, hey, this could whack profits 5, 10, 15%. Maybe we need to ratchet back where we think the odds of the market going are, and that is now being digested into market prices.
And I guess one of the concerns could be, why would this change? Why would the backdrop change? Why would the policymaking stance of this administration change? Why would we expect fewer tweets? And if the answer is maybe we shouldn't expect anything to change, then that suggests maybe a longer-term headwinds for these markets.
So it's a fair question. I'm very much a fan of Ed Yardeni, and Ed said, quote, "The stock market vigilantes have spoken. They don't like tariffs. They don't like mass firings of federal workers. That's because they don't like stagflation, and his concern is Trump 2.0 could increase the odds of a recession and could increase inflation. We got very benign numbers the past couple of days, which you would have thought we would have seen a more sustained rally than just yesterday's pop. The NASDAQ has already given back half of that or more. And so I grew up in an era of bond vigilantes. Yardini is talking about the stock vigilantes. I think and knowing how much Trump pays attention to the stock market, I think if the market keeps selling off, there's a really good chance he may have to throttle back on his tariffs.
It feels like Trump and his secretaries have made it clear he doesn't care about the stock market right now.
Yeah, that's minus 9%. He doesn't care. Talk to me again at minus 15 or 20% when the rank and file Republican members of the House are screaming when they can't get a budget done, when they're saying, hey, I used to be concerned about getting primaried from the right, but you're going to get me fired from the left. And so we have to, the stock market ultimately disciplines everybody. What was James Carville's line? If I'm reincarnated, I want to come back as the bond market. Well, I think the modern version of that is some of us want to come back reincarnated as the stock market. I can't imagine that this goes much worse and they shrug it off. Because at a certain point, I still have a very vivid recollection of October 2008 when legislation was introduced to fund some of the things that were going to manage the financial crisis. And Congress voted it down. The market took a giant leg lower that week. And by Friday, it was passed practically unanimously. So at a certain point, the market will, if the market says, hey, it's not just that we don't like this, this has now become reckless and dangerous, and we're going to discipline everybody, that's when it'll change. But minus 9% isn't the line in the sand. Let's have this conversation again at minus 15 or 20 or 25%. I think everybody's tunes changes, or there's some resolution to tariffs in a way that works for everybody. But those seem to be the binary choices we're facing.
So Barry, just about a minute or so left here. What's the conversation you're having with your clients? I know you really preach long-term investing. Would this being a buying opportunity, add to positions that you like, that maybe you're underweight? What's the conversation you're having?
So when you see down 5 to 10%, it's noisy. It's not quote unquote a buying opportunity.
Right.
Down 20%, you get a little excited if you're a longer term investor. So the first lesson is look past the next 4 years, look out 5 or 10 years, and minus 7, minus 9, minus 12. Hey, that happens. Hey, if we get to the point where it's minus 20, you rebalance a little away from your bonds, a little into your equities, and heaven forbid if we get down to minus 30, that's when you start becoming much more aggressive and think long terms. But separate what's just normal trading noise from, hey, this is a fantastic opportunity.
Yep.
We're not quite there yet.
All right, Barry, thank you so much for joining us. Always appreciate getting a few minutes of your time, Barry. Ritholtz Wealth Management joining us here. The big take story on the Bloomberg terminal really gets your attention today. You think about what's happening with President Trump seemingly embracing to some degree President Putin in Russia. Ask the question, what are investors doing? Are investors warming up to Russia? And that is the story, our big take story today. Tony Halpin joins us, team leader for Russia economy and government coverage at Bloomberg News. He is in London. Tony, are investors saying, hey, I think it might be a decent time to invest in Russia? Are we at that point?
We're not quite at that point, I think, but it's certainly the case that investment houses and traders are seeing a spike in interest from clients in Russian assets that have been pretty much untouchable for the last 3 years, and that people are asking how they can position themselves and get into Russian assets if and when sanctions are eased. So there's an expectation that President Trump will find some way to bring the war to an end. That may open up a Russian market that has just been off limits for the last 3 years.
What do you think the level of confidence will be to move money, into the market? How sensitive could that be?
Yeah, let's be clear. I mean, it is a very big geopolitical gamble, right? I mean, Russia as a country has changed an awful lot in the last 3 years. It's not necessarily as welcoming as it was to foreign direct investment before the war. And there are huge risks in entering Russia in a situation where even if the war comes to an end, there'll still be a very unstable front line, the risks of war flaring again, the risks of sanctions being reimposed. I mean, you'd have to have some nerve and some courage, I think, to decide that you're going to stake a big bet on Russia and hope it all works out well in the long term. In the short term, there are an awful lot of risks, and there's an awful lot of events that need to happen before Russia really comes in from the cold here and becomes a part of the global economy again. Not least in Russia itself, they're looking for some kind of easing of trading in dollars, because that's been a really huge obstacle for Russian companies in getting paid, in selling their goods, in buying products. And before something like that happens, I think it's difficult to see how people move forward.
Tony, just give us a sense of how the Russian economy is today, how it's changed since the beginning of the war.
Yes, I mean, it's changed an awful lot. I mean, firstly, a lot of Western multinationals simply fled the country at the start of the war. A lot had to take heavy haircuts in order to do that. Russia itself has thrown huge amounts of government money at supporting the domestic economy, at supporting businesses that were affected by sanctions, at spending on defense and defense-related industries. Something like 40% of this year's budget is going to go on defense and domestic security. So you can see that there's a war economy that has developed, and very much that maybe at the expense of consumer economy. And it's not clear, in fact, how they can reel that back and begin to rein in some of that spending.
This might be a very silly question, but as an investor, an overseas investor, what's the easiest way to get exposure to the Russian economy if things resolve itself in Ukraine?
Well, for example, there's been interest in dollar-denominated bonds issued by Gazprom. Gazprom itself is not under sanctions. It's difficult to get access to those bonds, but just the interest in those kind of bonds, in dollar and euro-denominated Russian bonds, has already pushed down yields by something like 5 percentage points in February. So you can see that people are positioning for safer securities, as they see it, ways that they can expose themselves to Russia, perhaps through Russian state-owned companies connected to energy. And that seems to be one of the transactions that's getting a lot of attention.
Tony, thank you. Tony, thank you so much for joining us. Really appreciate it. Tony Halpin, team leader for Russia economy and government coverage for Bloomberg News, based in London. Business school friend of mine runs a multinational company. And back during the good days, the Glasnost days, they made an acquisition in Russia, and it was working out great. And they had they employed about 120 people, fairly technologically driven company. They literally just had to walk away from it. You know, just those people lost their jobs. They had to write down the entirety of the investment. And that's the risk of investing in those types of countries where the rule of law isn't as strong as it is in the West.
Which, funnily enough, is why a lot of CEOs like investing in the U.S., despite the fact that the headlines and the whippiness can be crazy, because there is a rule of law. And there are rules. They can change, but there are rules, maybe being the difference. All right, Henrietta Tres, Managing Partner and Director of Economic Policy over at Beta Partners, will be joining us next. Her take on a potential government shutdown. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. Uncertainty around the potential impacts of the trade war running high. Despite some attempts to snap up discounted shares, the S&P 500 actually hasn't notched 2 straight days of gains since the peak back in February. By the time I stop talking, I'm guessing that the S&P 500 will officially be in correction to right now down 9.93% from its peak. Meta, Apple, Amazon, Tesla, Microsoft are the laggards in terms of index points. Intel, that remains most active stock. That was up right now just about 15% with confidence around the new CEO, Lip-Bu Tan. In the meantime, John Stolfus said Oppenheimer sees more tariff-inspired volatility ahead of us.
We're going to be affected very much by an increase in volatility that's quite natural. We think the way to weather it is with prudent diversification that meets the needs, objectives, and tolerance to volatility for an investor or an institution's mandate.
Right now, the S&P 500, 65 points lower. That is down 1.2%, 55.34 on the index. The Dow Jones Industrial Average is down 438 points. That's down 1%. The NASDAQ 100, 331 points lower. So that gets deeper into correction. That is down 1.7%. Yields at the same time, they're lower. The 2-year yield, 2 basis points lower, 395. The 10-year is down 1 basis point. That is at 429. Sony Music, they're in court. They have filed a federal lawsuit against the University of Southern California, USC. They say USC blatantly infringed music copyrights in hundreds of social media posts promoting their sports team. They posted music videos on Instagram and TikTok of the athletic teams using Sony-owned songs without a license. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Always get a license.
Yeah.
Alex and Paul.
Yeah. My husband handles licensing for plays, so he would not appreciate that.
My sister was at ASCAP, or BMI for a long time, so
okay.
she did all of that. Basically going around the world collecting, okay, Italy, you owe us this much. Germany, you owe us this much.
Yeah, I don't think people realize that, like, in a bar, if a bar has a TV, there's somebody from ASCAP or BMI that goes in and counts it, and then they have some sort of formula where the bar is going to have to pay a licensing fee based on, you know, how many TVs or a jukebox that they have.
Yeah. All right.
Yeah.
The things you know. All right, John Tucker, thanks a lot. Alex Steele, Paul Sweeney, this is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance and politics, particularly as it relates to the economy. The latest headline was Senate Democratic leader Chuck Schumer and his party would block a Republican spending bill to avert a government shutdown on Saturday and urge the GOP to accept a Democratic plan to provide funding through April 11th instead. The markets are absolutely no stranger to these headlines and shutdowns, the blame game, the whole thing. And rarely does the equity market truly move. But we are seeing potentially a Treasury options wager that's looking for 4.7% 10-year yield by the end of next week. That does incorporate shutdown fears. Henrietta Triss, managing partner and director of economic policy at Beta Partners, joins us. Henrietta, what are your odds of a shutdown?
My odds of a shutdown are still pretty low. With 25% odds, I think that they could wander into a shutdown here. But I think Senator Schumer has devised an off-ramp that's going to work for his conference. I think a lot of this was just showing that Democrats were willing to put up a fight as the Trump administration continues to have power over the House, the Senate, and the White House. And there's not a lot that they can do. But I think at least having this fight for the last 24 hours is part of the calculus here for Senator Schumer.
So I guess I'm surprised at the total lack of power by the Democrats here. I thought, given the razor-thin margins in both the House and the Senate, that the Democrats, if they wanted to, could put up more of a fight on more issues, whether it be confirmations or whether it be, I don't know, the budget.
You know, I think that we all need to update our thinking and our whip counts around the House Freedom Caucus. There are 30-plus members of the House who have never voted for a CR, have never voted for a debt ceiling hike, have never voted for any of these patches, and have ousted numerous speakers, including most recently Kevin McCarthy. But President Trump and Speaker Johnson have been putting the squeeze on them to the point where our old whips, where we assume that there's going to be holdouts beyond just the Kentucky Congressman Thomas Massie, is, effectively outdated now. And so we have to operate under the assumption that the House Republicans will march in lockstep. But if that's true, then there's not a whole lot Democrats can do to move the needle, especially with the 12-day recess breathing down their necks.
Okay, so how does it all play out? Best guess.
I think that at this point, there's still a possibility we get a time agreement from Leader Schumer, Minority Leader Schumer and Majority Leader Thune to take a vote as early as this evening. But otherwise, they'll be in session tomorrow. They'll take a vote on a Senate patch that would be a short-term spending bill. They're hopeful that there will be some Republicans who will cross the aisle. And then we'll vote on the House budget resolution, continuing resolution, which will fund the government through the end of September. And we will take this shutdown risk away for the time being.
If the government remains open, which would be good news for everyone, what's on the to-do list for Congress then?
No shortage of things to do. Obviously, we still do not have a budget resolution from the Republican conference. So today, Senate Republicans, who have a totally different plan for how to move forward on the president's legislative agenda, are going to meet with the president and other members of the White House, probably Treasury Secretary Bessent, Commerce Secretary Lutnick, et cetera. They're going to have a lot of words about the president's tariffs, but they're mostly going to be concentrated on getting a budget resolution through the Senate that reflects this one big, beautiful bill. The odds of that have dropped down to 60% in my odds tracker because of so many disagreements between the House and the Senate just within the Republican conference. So we have to fight about whether to blow out the deficit by $5 trillion, which is what the Senate Republican conference would like to do using the magic of a current policy baseline. They have to deal with the debt ceiling. They have to pass $342 billion worth of aid to the military and the immigration officials. So there's a laundry list of things to do. We haven't even started yet.
What do you think the tariff situation winds up being? Howard Lutnick was very clear that the tariff is going to be a tit for tat, not backing off. Do you think that President Trump backs off if we see a 15 to 20% decline in the S&P, or do you think that we're just going to have to roll with these headlines until we get tax cuts?
I think that the House gave us a really good indicator yesterday that these are going to be in perpetuity for at least the remainder of this year. During the negotiations over the continuing resolution, they voted to strip Congress and their authority or ability to put any kind of stop on the president's tariffs, even though the retaliation from China, from Canada, from Mexico, from the EU are all hitting their voters. The House Republicans said for the rest of this year, the president gets to do whatever he wants on tariffs. I think that the tariffs are going to escalate perpetually in fits and starts. The next inflection points will be, what the president is tweeting. Obviously, we got yesterday's developments. And then on April 1st, when all these reports are due to the president, we're going to see a series of fits and starts on tariffs and escalation on EU automobiles, EU agriculture. It's going to expand out to China, pulling the U.S. out of the phase 1 trade agreement with China, launching Section 232 tariffs on copper, on lumber, 301 tariffs on shipbuilding. The list is really endless, and I think that will be a feature of the landscape for, at a minimum, the remainder of this year, if not the next 4 years. And one thing to be mindful of is that trade negotiations take entire presidential terms. That's what we saw in the president's first term, and that's what investors should expect this time around as well.
All right, Henrietta, thanks a lot. We really appreciate it. Henrietta Trey's managing partner and founder over at Veda Partners. Wrapping up all my interviews at CERAWeek, again, that is S&P Global's energy conference. It's once a year. It's in Houston, Texas. All the energy industry players and CEOs come, they talk, they schmooze, they meet with shareholders, maybe they make deals, they talk behind closed doors. And obviously, in the middle of all of this, we're getting tariff headlines right and left. So I was able to sit down and speak with Greg Abel. He is CEO of Enbridge Energy. It's a Canadian midstream oil and gas company. Now, I say Canadian, but it's maybe North America. They have pipelines that range from oil, natural gas, LNG transport all across the U.S. and Canada. So he's a really good read on all of this. And I asked him straight up, I was like, how hard is your life right now?
Well, 43 states, 8 provinces, 5 countries. It's just another day.
It's just another day.
You've got to focus on fundamentals. What do we know? Energy is going to flow. It has to flow. It's the lifeblood of everybody's economy. Consumers want cheap prices. That means provide as much supply as economically possible and try to stay out of the way of policy and politicians in the short term and focus on the long term. And so we're continuing to do that. We've got $27 billion of projects that we're going to execute through 2027.
And any of that question marked, on hold, put on the sidelines, on pause because of the turmoil in the market and because of the headlines on tariffs?
No. And here's why. Well, they're already signed up contracts. People need that energy. It takes multiple years to build that infrastructure. Most of the product that we need for those is orders are already in. You know, say steel, for example, largely domestically produced in the United States or in Canada for projects there. So you do need to think 3 or 4 steps ahead. But when you've been around better part of a century in your long-term energy infrastructure, I'm paid to do that every day, and so are our people.
But does that building and all that CapEx get more expensive if the material gets more expensive?
It could. So we have to be, again, you try to lock that in as soon as possible. One of the benefits of running a large pipeline system, largely regulated, economic regulation beyond just, you can pass through some costs if they're reasonable. So again, big buyer, as you said, largest pipeline operator in North America. We buy a lot of stuff, and I think we've got a certain amount of power to be able to get the best deals possible. And then from a competitive perspective, if some prices have to be passed through, fine. But generally speaking, we lock those in.
Have you seen any change in oil flows as of yet?
No, quite the contrary. So January, February flows out of Canada have been close to record highs. We'll see if that continues, but I think people may be getting ahead of those. Exports out of the Gulf Coast, we're the largest exporter of oil out of the United States. That continues to be very robust as allies and customers overseas want to continue to get there. And it was a pretty cold winter, so natural gas was used predominantly to keep people warm and electricity going and industry flowing. So start to the year has been pretty good.
If we do see continued tariffs on Canadian oil, do you think the price then discounts and then producers respond in kind?
So our pipeline is exactly built for that. So it's been a long time been a discounting Canada, right? Lots of production, trying to get down to lots of demand here in the United States. So the more we can build pipelines, the less there are discounts. But we'll have to see how that shakes out. It's early days. I keep saying everybody needs to take a breath. Everybody needs to be focused on the long term and recall that our people, our economy, the two countries need each other and they need energy.
No, we're media. We want answers now. But what it does seem to highlight, though, is Canada's need for other export partners.
Yep.
And I'm wondering what the stomach is to build up pipelines to Western Canada.
I'm cautiously hopeful. I didn't say optimistic, but hopeful for several reasons. One, going to be a change in government in Canada. You know, one way or the other, there's going to be a new prime minister here in the next little while, maybe 2. We'll have to see. I'm not the politician here. And I think Canadians are united that, you know, it's a challenge to be so tied to a single economy, even if it is the best economy in the world. And therefore, there's opportunities to move off at least the West Coast and maybe the East Coast. Canada did have an opportunity 10 years ago to be the leader in LNG and tripped over itself not to be able to get there. I think many Canadians probably regret that. I hope policymakers regret that. But, you know, you make a mistake once, hopefully you don't make it twice, and that'll create an opportunity. And still, will be the largest provider of oil and natural gas in the United States, too.
There have been things floated, like maybe the government could tax exports, and that would then pay for a pipeline, particularly maybe from east to west, that the government could just help pay for these kind of pipelines. Is that in the zeitgeist at all from where you are?
Yeah, I don't think that's not a logical way to go, right? I mean, the government had to step into a pipeline, the one that does go to the West Coast, ended up being a multiple of what it would have cost in the private sector, one. And then 2, you would really be asking for a real burden to be placed on Western Canada as the largest producer of, almost the sole producer of oil out of Canada. I don't think a Canadian politician that's thinking about national unity would want to impose one tariff on one part of the country just to benefit another part of the country.
So what would incite the private sector to want to do something like that?
Well, new permitting rules, just like here in the United States and Canada.
Which is worse?
Well, they're both challenging. I don't know which is worse. I think momentum is towards regulatory simplicity here in the United States, and I hope we get the same in Canada. Again, I have to make decisions every day. Am I investing in Canada and the United States? So permitting is a big issue. Speed of permitting is a big issue. Support for proper taxation regimes, et cetera. Those are all decisions I have to make. Both capital markets are excellent, but I would say the permitting and regulatory regime is quite problematic in Canada.
The other sort of non-related tariff demand driver potentially is AI and data centers, right? How do you play in that?
Multiple ways. So we, again, being such a large producer or large shipper of natural gas, probably the best way in which those data centers will be fueled is natural gas-fired generation. So we are building pipelines now for great companies like Duke, TVA, et cetera, here in the United States. And those will be for new gigawatt plus power plants. Some of those electrons, I'm quite certain, will go to meet this demand on the AI front. We serve 90% of the gas-fired generation, say, in a province like Ontario. They're trying to track more and more AI. So we will build the infrastructure, the storage, the transportation, et cetera, to fuel those plants, which will then allow the data centers to be connected. Something like, the vast majority of data centers are within 50 miles of our pipeline. That's a pretty attractive, right across North America, for us to be able to utilize. So I'm excited about that. I mean, we'll have to see how it all shakes out, but, steady growth. And we also have a renewable power business, and some of those data centers want to use renewable power. So we've signed up new customers like Amazon and Meta and Toyota and Pepsi. So you'll see a lot of those players that are looking for power. We're going to need it all, man.
What was it like to have those conversations with like Toyota and Amazon? Like, what did they contract long power purchase agreements?
Yes.
And what was that like to come to a price?
So the price is largely set by natural gas, even if you're buying renewables, right? So the price is out there, and then you're trying to create a little bit of an escalator. They see the need for stable 6 nines reliability power, but they also want to meet some of their sustainability goals. So
even now in a different environment?
Absolutely.
Okay.
That means they will get a mix of gas, and they will get a mix of renewables as well, right? So we need it all. I think that's probably the message that comes out. North America to be Fortress America, North America to be energy superiority, we're going to need it all. We're going to need all the oil, we're going to need all the gas, we're going to need cooperation, we're going to need permitting reform, and that, first and foremost, is going to serve the consumer. Consumers are voters, and I think that wins.
Before we let you go, there's obviously a lot of concern about recession, fears among tariff fears, etc. Are you noticing any slowdown in demand?
So I am starting to see some impacts vis-a-vis housing. What's going to happen with interest rates, recessions, et cetera. If you're not quite certain about being able to afford a house or your job, et cetera, then, as many houses as we might need, they're maybe not getting built. But that's about it today. I mean, I think we have to realize there's been a lot of talk of tariffs yet, but we've yet to see a month or two of tariffs. I think when that kicks in, you may see some impacts, which is the benefit of our model. Our model largely regulated, steady as she goes, dividend payer. We've increased the dividend for 30 years in a row, and that financial guidance for 19 years in a row. Recessions, no recessions, one type of government or another. So, yeah, we often see the stuff first, but fortunately the structures we have still allow us to perform.
That was Greg Abel. He is Enbridge CEO, joining me from CERAWeek. So clearly all the CEOs are going to say how they're well insulated, they have the right structure for any kind of economic downturn, yada, yada. But the point is that if you move stuff between Canada and the U.S. and that relationship is fractured, and even if it's not permanent, it feels like the move towards, hey guys, we need to find a different export market wouldn't be insane at this point.
No, it wouldn't. He said it's amazing how where they're located. 48 states, 10 provinces, 5 countries. So I mean, they are exposed in a big way. Just looking at their stock, it's kind of flat year to date, but it's up 25% on a trailing 12-month basis, as are a lot of those midstream stocks, all performing pretty well.
Yep, because you need it, you got to move it, and at the end of the day, you can have all the power that you want, all the commodities you want. If you can't move it, doesn't matter. And that's where these guys come into play. Well, that wraps it up for Paul and myself on this Thursday, or Friday Eve, as I like to call it. Taking a look at the market, the sell-off is deepening a little bit here as those trade war headlines continue to heat up. The S&P is on the precipice of a 10% correction, shedding about $5 trillion in value since that February peak. Investors are betting officials are going to stay put until June and July on those tariff question marks. Balance of Power with Joe Matthew is up next after this global news update.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Steve Kathan. It seems the White House is ready to try to rev up its deportation plans. CBS's Vicki Barker.
The Trump administration is reportedly poised to invoke the Alien Enemies Act of 1798 to speed up the mass deportations of migrants. CNN is reporting that the sweeping authority meant to be invoked in wartime has been under discussion at multiple agencies, and an announcement could come as early as tomorrow.
The Transportation Department says it's launching an investigation into DEI hiring allegations at the FAA. American envoy Steve Witkoff is in Moscow for talks on the ceasefire plan the U.S. worked out with Ukraine. CBS's Ed O'Keefe.
The fact that Witkoff is back in Moscow, this time meeting with more senior Russian officials, is a sign that they're at least willing to take that meeting and that the Trump administration remains quite serious about making it happen. Remember, Witkoff, while he is the Mideast envoy, he is first and foremost a longtime close friend and associate of the president. So sending someone who is so personally close to the president should signal to Russia how serious the president is about making some kind of deal happen.
The CBS's Olivia Rinaldi says former Congressman Dave Weldon's plan to be the next CDC director ended abruptly this morning.
The White House pulled his nomination. Someone familiar with it told us it was clear he didn't have the votes in the Senate. He was supposed to appear this morning at a hearing in front of the Senate Health Committee.
New tariff threat today from President Trump, 200% on wine and liquor from the European Union. Senate Democrats say they can't get behind the Republican spending plan that cleared the House and is designed to head off a government shutdown. Senate GOP leader John Thune.
I'm not sure how long the Democrat leader thinks we should drag out the funding process for fiscal year 2025. Until fiscal year 2026, beyond?
Thousands have been told to leave their homes, millions at risk as a storm system with heavy rain and wind invades Southern California, officials fearing mudslides in areas hit by wildfires. The lawyer for a Connecticut woman accused of holding her stepson captive denies abuse accusations. WFSB TV reporter Robert Susanna.
He claims that starting at the age of 11, he was imprisoned essentially in a 9-foot by 8-foot room by his stepmother, and that he was kept in that room for at least 22 hours a day. He was rarely allowed to leave, only to do chores, and he was given very little food and water. In fact, he claims that some days he was only given 2 glasses of water in a single day, and that they actually came straight from the toilet.
The Dow is down 460. This is CBS News. On the Health Watch today, CBS's Michael George looks at hunger and the role it could play in heart disease.
Young adults who experience food insecurity could develop heart problems later in life. A study by Northwestern University found people experiencing hunger or a lack of healthy food have a 41% greater chance of developing heart disease in midlife. The study's authors say addressing hunger now could make a big difference in healthcare in years to come. Food insecurity affects 1 in 8 U.S. households.
The former pastor of a Texas megachurch has been indicted in Oklahoma on child sexual abuse charges. 63-year-old Robert Morris is accused of 4 years of abuse that began in 1982 when the child was 12. Morris was a traveling evangelist at the time who stayed with her family. He resigned from the megachurch he founded in 2000 outside Dallas last year. Steve Kathan, CBS News.
From From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Time to stock up on the Chianti. Welcome to the fastest show in politics as President Trump threatens new tariffs. 200% tariffs on wine, champagne, and other libations from Europe. As the tariff threats escalate here and the president meets today with NATO's Secretary General, we are joined ahead by Jenny Welch at Bloomberg Economics, and we'll consider the impact of the Doge cuts and the prospect of a possible government shutdown, which suddenly seems more likely in Washington, with Tazra Mitchell from the D.C. Fiscal Policy Institute. That's all coming up straight ahead. We'll have analysis this hour from our political panel as we wait to hear from Donald Trump and the Secretary General in the Oval. Bloomberg Politics contributor, Democratic analyst Jeannie Shanzano is with us, alongside Republican strategist Lester Munson from BGR Group. So let's get started, as always, by setting the baseline on Wall Street. PPI Day, Charlie Pellet at the helm right now in New York. Charlie, how's it looking?
And good day, Joe Matthew. Indeed, another move lower for the U.S. equity market with the Dow, the S&P, NASDAQ, all declining again. S&P on the precipice of a 10% correction. S&P right now just about lows of the day, down 64 now, down 1.1%. We've got the Dow down 463 points on the Dow, a decline of 1.1%. And NASDAQ right now down 287 points for the NASDAQ Composite Index, a drop now of 1.6%. The 10-year 4.30%, the 2 years currently yielding 3.97%. Gold down $43 the ounce, actually up $41 the ounce right now, up 1.5% on the precious metal, $29.78 where we stand. And West Texas Intermediate crude is down 66.87 a barrel, down now by 1.2%. All major S&P 500 groups are trading lower. Certainly tariff developments creating a lot of uncertainty for markets, but what about consumers who account for about 2/3 of the economy? Megan Horniman is Chief Investment Officer at Verdens Capital Advisors.
I do think that the tariffs have impacted consumer confidence to a degree, but primarily because it's really created a lot of uncertainty around inflation expectations. And we've seen that in consumer data. You can look at the University of Michigan expectations for inflation. These have shot up significantly.
European spirits and drink makers are dropping after President Trump threatened to retaliate with tariffs on some European alcoholic products. The story will have a lot more on coming up on Balance of Power. LVMH, whose brands include Dom Perignon and Hennessy, trading lower right now. The ADR is down by 1.2%. And Diageo, its brands include Johnnie Walker, Bailey's, and Guinness. Diageo right now unchanged on the day. So again, recapping here, S&P lower by 1%. The selling continues. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, cheers, Charlie Pellet. Great to see you, Charlie, the voice of Wall Street and the New York subway, with us every day on the fastest show in politics. I'm Joe Matthew in Washington. Thanks for coming along. The Thursday edition. Yeah, you made it to Little Friday. We have a lot of wood to chop here, or should I say a lot of wine to drink. The big development this morning as we wait for more news on tariffs, Donald Trump going after the wine, the champagne, and the other alcoholic beverages from Europe. As you heard Charlie Pellet mentioning, it's moving the stocks. And boy, what a time to pick this, right? I thought we all stopped drinking because of the GLP-1s. Now this? You're going to take my Brunello di Montalcino away. As the president writes, the U.S. will shortly place a 200% tariff on all wines, champagnes, and alcoholic products coming out of France and other EU-represented countries. Yes, your Chateauneuf de Pape could double in price. He says this would be great for the wine and champagne businesses in the U.S. Okay, so we're drinking California starting pretty soon, but you can't get champagne here in the U.S. And he knows that because, well, Donald Trump has his name on sparkling wine in Virginia, right? So Howard Lutnick making the rounds this morning because it's Thursday. Every cabinet secretary is on TV somewhere. In this case, the Commerce Secretary on Bloomberg TV talking about EU tariffs. Here's what he said.
The EU has just so many years treated us so harshly. They just can't stop. Look, their tariffs are way up here and our tariffs are down here. How about relax? Let us balance it. We are your largest, most important trading partner. treat us with respect and let's get a little balance. And Donald Trump is out there saying balance, balance, balance. April 2nd, he's going to describe his balance. We're going to do it together.
April 2nd, of course, that's the date the reciprocal tariffs take effect. Howard Lutnick on Bloomberg Surveillance, making the case, beating the drum, as we now turn to Jenny Welch. Imagine at this moment being the chief geoeconomics analyst at Bloomberg Economics. What a time to have your business card. Great to see you. Thank you for coming in. This is happening as the president sits down with the NATO Secretary General, which I'll ask you about. We might even get a taste of their conversation a little bit later on this hour. But boy, this really gets back to the noise. And this hits home for people, right? My wine's going to double in price? That's sort of different than steel and aluminum, right?
Absolutely. I think this is also an interesting reminiscence of the previous trade war with Europe back in Trump's first term, where he also threatened French wine. At that point in time, they backed down from it. So maybe there is a chance that they'll back down from this as well, and we can avoid paying more at the liquor store.
This is a direct response, I guess, to the bourbon levies that we got from Europe. Yesterday, they went after Kentucky bourbon, blue jeans, Harley Davidsons. These are pretty narrow, though, right? And so is wine. I mean, are we tinkering around the edges here? When you talk about aluminum and steel, that's big business.
That's big business, and really what happened here is that Europe had snapback tariffs from that previous trade war. They just let them come back into play, and they're intentionally targeting these politically salient industries in the United States in counties that voted for Trump, right? It's a tactic that we've seen other players use, like China with agricultural tariffs as well. The intent is to get him to back off. Obviously, this might lead to more of an escalation. And to your point, we were expecting April 2nd to be the main showdown with the reciprocal tariffs. We're already having an escalation just based off of the steel and aluminum. And I think that really highlights the volatility of this moment.
Well, he says soon, right? Shortly, he said, we'll place a 200% tariff on the wines, et cetera. I believe it was Jonathan Farrow who asked Howard Lutnick this morning, what's the timeline here? Didn't really seem to answer it. So again, are we just riffing, or maybe that is part of the April 2nd reciprocal, or we have no idea?
Well, part of it, too, is waiting for the EU to make their full response. There's the snapback tariffs that have to come into place, but there's additional tariffs that the EU is going to be voting on later this month on top of those snapback tariffs from before. So maybe part of this is just the negotiation in public to try and walk the EU back before they have some of those internal conversations.
Look at this, just as we're talking, producer James puts the headline here in front of me. EU Trade Commissioner to have call with U.S. counterpart on Friday. So we're drinking wine this weekend. Is that the European wine, maybe?
I would say buy it now, just in case.
Okay.
Stockpile.
Boy, what a moment we're in here. And now you're a geoeconomics analyst, and we frequently align you with geopolitics, not, trade wars over alcohol. Does this actually move the needle in your space?
I think everything that President Trump has been doing to date has been moving the needle in terms of how we think about economic coercion and economic statecraft toolkits, right? His willingness to use tariffs not just as an instrument of trade policy, but of all foreign policy.
So let's talk about geopolitics a little bit here, because this is a very serious meeting actually today at the White House. The Secretary General of NATO probably doesn't have household name recognition like, say, Emmanuel Macron or President Zelensky. But this is going to get to the heart of some real tension between the U.S. and Europe. As you've pointed out, a couple of things that we're going to be looking at here. It's going to involve trade, certainly, the tariff conversation we're having. But really, it's going to be about Ukraine and the U.S. commitment to NATO, which is a much bigger question when you think of it here.
Yeah, absolutely. This visit is taking place at a pretty stark time for Europe, where they're facing a trade war with the United States and also facing this pivot, essentially, that President Trump has undertaken over the last month of rapprochement with Moscow, putting a lot more pressure on Ukraine. Now there's been a successful meeting, it looks like, between U.S. and Ukrainian officials earlier this week that maybe has walked some of that pressure back. But I think Europe is still reeling from that pivot and thinking about what it means now for it to have to stand up for itself and uphold its own security without being able to rely on the U.S.
They're going to be in the Oval Office, at least by the schedule, 5 minutes from now, and things may well run a little bit late here. Much of this will have to do with the spending commitments, right, that NATO members make. Also, the veracity of Article 5. Donald Trump has recently questioned this again, suggesting that we may not defend allies who don't pay the full freight. He wants 5%. Is that the going rate now?
5% is above and beyond what most NATO members can reach. Poland is the country that's closest to it. Even the U.S. is well below 5%. And frankly, it would break the bank for a lot of European NATO members. That being said, they have raised defense spending over time, including since Trump put this pressure on them in his first term. But the challenge is really going to be how they do that while managing debt, how they do that with a defense industry that's much smaller than the United States. I mean, the prospect of Europe having to stand up for itself, that's not a 1 year or a couple months effort. It's something that will take many years to build up that capacity.
Yeah, this is quite remarkable. He was asked about this by NBC News. It would not protect NATO members who fail to meet these spending demands. Quote, it's common sense, right? If they don't pay, I'm not going to defend them, unquote. If you're the NATO Secretary General, how are you getting to this today in the Oval Office?
So I think one upside for the Secretary General is that he has also been urging European NATO members to spend more on defense and has echoed some of the higher numbers that President Trump has thrown out there. I think the other way he could potentially frame this as is the amount of benefits that NATO and NATO allies present to the United States in terms of cost cutting, right? The U.S. has bases in Europe that provide for U.S. security back at home. You're closer to Russian missile silos, for example. Second, those NATO members are kind of your front line. They're providing, sure, maybe not as much as you would like them to in terms of troops and weapons, but they are covering some of those costs for you. And third, just the prospect of NATO as an alliance and the deterrence value that creates with Russia, with China, with Iran is unmatched elsewhere in the world. No one else has that many allies that they can draw upon.
Right, how about that? In our remaining moment, I suspect that the Secretary General will make the case to Donald Trump that if Ukraine falls, it is more dangerous, it is more expensive to exist as NATO.
That would be the argument I would certainly make. And I think in particular, when you think about it from Russia's perspective, if Ukraine falls, what are its next targets? It's probably the Baltics.
Poland's on the front door. Baltics are standing right there waiting for you. Estonia is listening closely to this conversation today, isn't it?
Yeah, Estonia, Lithuania, Poland, Latvia, they're all going to be watching very closely.
There's a lot on the line here. Stakes are high, and that's usually when we bring in Jenny Welch. Thank you so much, Jenny. It's a great conversation, as always. Bloomberg Economics. Find Jenny's byline on the terminal and online, of course, at Bloomberg.com. I'm Joe Matthew in Washington. We thank you for being with us here on the Thursday edition as we plow ahead with what's happening on the other end of Pennsylvania Avenue. We will bring you into the Oval for that conversation when it happens later on. But, of course, we've got to talk about a government shutdown potentially now in 2 days after Chuck Schumer said Democrats will not play along in the upper chamber. Do we believe them? We'll talk about this and what the economic impact could be with Tazra Mitchell coming up next right here on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. The stock sell-off is deepening as trade war fears heat up. Dow on track for its fourth straight loss. S&P down in 3 of the last 4. Right to the numbers here with the S&P currently trading down by 62 points at 55.36. That is a drop right now of just about 1.1%. We've got the Dow down 456, down 1.1%. NASDAQ down 287 now. For NASDAQ, the composite index down 1.6%. The NASDAQ 100 index lower now by 1.5%. 10-year 4.30%. The 2-year 3.97%. Spot gold is trading higher. Gold hitting a record today, up 44, up 1.5%. 29.78 right now on spot gold. We got West Texas Intermediate crude down 1.1%, 66.96 a barrel on WTI, and Bitcoin down another 2.4%, back to just over $81,000 on Bitcoin. Intel shares are surging. Intel up now by 16% after naming Lip Bhutan as its next CEO, entrusting a former board member and semiconductor veteran with one of the toughest jobs in the chip industry. By the way, he is the former head of Cadence Design Systems. Again, Intel right now up by 16%. After earnings, Adobe, it reported last night, stock now down by 12.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And Balance of Power continues right now. Back we go to Washington. Once again, your host. Here he is, Joe Matthew.
All right, Charlie, Thursday edition. Thank you, Charlie Pellet. Thank you for being with us here on Bloomberg Radio, on the satellite radio channel 121, and on YouTube. Search Bloomberg Business News Live. That's the drill. Find our live stream. Just keep it up running there all day. You can listen, you can watch, you can back it up. And we always welcome you, saving you a seat here in the studio in Washington. I'm Joe Matthew. It's good to have you along here as we try to follow the bouncing ball on Capitol Hill, all the while keeping tabs on the White House. The president today meeting with the NATO Secretary General in the Oval. It could get chippy. We'll bring you in there when they get in there. But, you know, not a lot of things in Washington happen on time. That could be the case, by the way, for a vote on a bill to avoid a government shutdown. Are they going to get this done? Maybe not. Things have become a lot more complicated over the past 24 hours here. John Thune did file cloture, the Senate Majority Leader, on this House-passed CR, the one we've been talking about. Last night, that means a cloture vote Friday. But wait, you say, government's supposed to shut down Friday night. It gets a little complicated when Chuck Schumer says Democrats are not going to vote yes for this thing, and that may not be the case in the end. But we've got a roadblock right now on the Democratic side. So a time agreement would be necessary to avoid at least a shutdown over the weekend, which might not be that big of a deal. The problem is, as Democrats watch the DOGE do its work, there's a big question about what would happen if the government actually was allowed to shut down. What would reopen? Maybe entire agencies would remain shut down. Certainly during the span of the closure, Donald Trump would be able to make those decisions. And we've talked about this before on the air with a lot of people who know a lot more about this than I do. The fact of the matter is presidents enjoy broad powers in spending discretion during a government shutdown. Right? We've talked about this with Mick Mulvaney along with a lot of other people. The Office of Management and Budget is in charge at that point, and they start using the money they have to operate the agencies they have. So park that right here as Democrats think about maybe voting no on this, and then consider what's about to happen to D.C., the District of Columbia, the federal city. You come here, you hang around, go to the Smithsonian and enjoy time with your family, look at the cherry blossoms every spring. Well, real people actually live here. And of course, they do not get a vote in Congress. That's where things get complicated, because this budget plan, this stopgap, the way it's written, basically turns D.C. into a federal agency and dramatically cuts spending to the tune of like $1 billion, which is why we're already hearing threats by the mayor, not threats, warnings, that, hey, we may need to start firing teachers and police officers if this goes through. This is one of the reasons why Democrats say they want to vote no. Nobody put a finer point on this than Brad Howard, the Democratic strategist you hear about a lot here, hear from a lot on Balance of Power. He was on the late edition from Corcoran Street Group. Here's what he said.
The this money, they can't be used, this money, to calculate savings. This money can't be used for the federal government. It is our money. Essentially what it does is it gets diverted away from us for 6 months, and then they figure out later what happened. So it doesn't even calculate savings. So we're trying to figure out what happened here, why. It just seems, hopefully it's not just a mean-spirited attempt to thumb our nose at a Democratic jurisdiction, but I don't know how else to read it.
So wait a minute. This money is from people who live in the District of Columbia, and it's going to go somewhere else? That's what Brad is saying, and that's the prospect we're looking at. If you're listening to us right now on 99.1 in Washington, D.C., you probably know this. And what they're saying is, hey, make that happen. You get an instant recession in D.C. and right around the whole DMV. Yes, the DMV. District, Maryland, Virginia, said to be recession-proof. This is what Tazra Mitchell's been working on. She's Chief Policy and Strategy Officer at the D.C. Fiscal Policy Institute, where, Tazra, I'm guessing the house is on fire. Is this really about to happen?
Well, we hope that the Senate Democrats will ensure that D.C. gets to spend its own money. This extreme act of federal interference will negatively impact basic government services that we all rely on, from childcare to 911, touching every D.C. resident. And we are really leaning on them to prevent this from going into place.
What can be done other than Democrats voting no?
So, unfortunately, D.C. lacks the power of statehood. We should have it, but we do not. So we are subject to congressional review of all of our legislation, including our own budget. D.C. has had a balanced budget for 28 consecutive years with clean audits. Unlike the federal government, we have to balance our budget. We have these $1 billion in revenues, and all we really need is for Congress to let us spend our money the way that we see fit and give us the same autonomy that localities across the country have. So what we're asking them to do is to ensure that whatever continuing resolution that goes through allows DC to spend its own resources as we see fit, including sticking with 2025 current budget levels, because if they fail to do that, we're going to see layoffs of police, layoffs of firefighters, teachers, all of our workers that help run our city and keep us safe, which I think should be a top priority for both Republicans and Senate Democrats.
So it's important what you just said here. This is money that is actually raised from people who live in the districts of Columbia, it's not coming from Kansas, California, or Connecticut is the point here, right? So if it's money from the city, you're saying it should stay in the city. The problem is D.C. doesn't have a vote, which is why since the year 2000, if you ever look at the license plate in Washington, D.C., it says taxation without representation. It brings up the whole argument over home rule here, Tazra, and this could end up being a pretty difficult period for the district. Would it cause a recession?
It could very well cause we're already actually projected to face a mild recession in the district because of Trump's federal layoffs. Our own chief financial officer is already saying that our revenues are going to plummet by $1 billion over the next 4 years just because of federal layoffs alone. And now we have this additional $1 billion problem that would harm our economy, small businesses, and make it harder for everyday district residents to make ends meet. And as you said earlier in the clip, this will have ripple effects on the entire region. So Maryland and Virginia residents will also be harmed by this reckless and dramatic escalation among Republicans in Congress. And it's unnecessary.
So how will the city function?
Yep.
That's right. How does the city function if you fire teachers, police, you can't have 911 and the rest of it? We're going to live in Mad Max for the next couple of years?
Well, this is unprecedented. I think the mayor would have really hard choices to make that are forced upon her, something that she does not want to do. She said that we would have to cut $1 billion through September. That is about a 16% cut in our budget. That means probably thousands of fewer government workers that are keeping our streets clean, that are educating our children, that are making it safe for tourists to come and visit our great city. Just so many ripple effects. And, there are also looming federal cuts that may also be coming our way that would make it harder to put food on the table, care for children, just afford to live in the district. And again, this is unnecessary. We have the revenue in the bank. We are not projected to face a deficit. This is just reckless. This is an overreach. And again, just an attack on DC residents' rights as Americans in this nation.
Well, there's a bit to that, Tazra, and I'm sure that you can speak to the kind of resentment. Maybe we'll start with the misunderstanding that people have around the country of what DC is, who lives here, who's from here. They picture this massive bureaucracy, a bunch of guys with white shirts and skinny ties. They're not aware that there is, in fact, a Native community here in this city, that things other than the federal government take place here. But there's some truth to this resentment that people have to DC, or sort of a lack of caring. I think some people actually enjoy watching this. Do you?
I think that DC has a rich culture. Go-Go was born here. We have great food. We have great community. And it's just like anywhere else in the nation. We raise our children here. We look out for one another. And we're doing our best to get by. And the last thing that we need is the congressional delegation, who really probably don't even know DC all that well and explore the beauty of our culture, coming in and making demands without having an ounce of understanding about how we run the district, or how we like what our finances are used for. Again, 28 years in a row, we've had clean audits. And for over 20 years, Congress has made the agreement with DC to let us spend our money as we see fit and protect us during shutdowns and protect us during continuing resolutions. It cost them $0 to continue that promise as they pass this continuing resolution. And just today and yesterday, you're seeing hundreds of residents going down to the Senate building and making their voices heard. And we hope that Senate Democrats are listening to them, as well as other Senate Republicans. Again, it will not save them a single penny. It will not cost them anything. They just have to understand the suffering that they are going to be causing on their neighboring residents in the district. And again, for no real reason.
Yeah. As Brad Howard pointed out last night, a lot of the D.C. population is made up of congressional staffers, the people who work for the lawmakers who are going to be voting on this thing. Lawmakers may fly back to another state on the weekends, but these people live here. They're chiefs of staff, right on down to the pages on Capitol Hill. So this actually hits pretty close to home to the families that they have in their own offices. And I'd be deeply curious to hear what some of those conversations are like. Tazra, I'm really glad you could join us, and I appreciate your insights today. Tazra Mitchell, Chief Policy Strategy Officer at the DC Fiscal Policy Institute. Yeah, we're in the bubble here, but this has repercussions, certainly regionally. If we talk about the beginnings of a recession nationally, could it be rooted here in Washington? It's a different story than we've probably told in the past. They've started their conversation in the Oval Office, and as usual, you know the drill around here. We'll bring you in for the conversation a bit later between President Trump and NATO Secretary General Ruda. I also want to mention an important conversation we're going to bring you right here on Balance of Power. Half an hour from right now, the former Treasury Secretary Steve Mnuchin sitting down with our own Saleha Mohsen here on Bloomberg. We'll set up our panel next. Their insights on everything we're talking about. Jeannie Shanzano and Lester Munson are on the way in, right here on Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. A bounce off the bottom for the U.S. equity market with the S&P still down 49, lower by 0.9%, 55.50 where we stand right now. We have got the Dow lower by 358 at 40,989, down 0.8%. And NASDAQ now down 224, a decline there of 1.3%. Stocks lowers trade war concerns and inflation worries send investors to safe haven assets like treasuries. The 10-year at 4.30% with the 2-year 3.97%. Spot gold up $48 the ounce, $29.83 on the precious metal, up 1.6%. West Texas Intermediate crude down 1.3%, $66.81 now for a barrel of WTI. A sell-off for Bitcoin down 2.4% now at 81,150 on a Bitcoin. So a down day today for the Dow, the S&P, and NASDAQ. There was another dose of somewhat encouraging news on inflation this morning following February's rather tame report on consumer prices. And with that story, here's Bloomberg's Vinny Del Giudice.
We are not out of the clutches of big bad inflation. U.S. producer prices held steady last month, the first month without an increase since last July. Yet prospects for the Federal Reserve's preferred inflation gauge look less favorable. The cost of health care, for example. Moreover, U.S. tariffs are on tap. The latest White House threat, a 200% tariff on French champagne and wine. Vinny Del Giudice, Bloomberg Radio.
Dollar General shares higher after earnings. It forecasts sales to grow this year in a range with the top end higher than what Wall Street was expecting. Dollar General up 5.3% right now. Rival Dollar Tree down by just about 3%. Analysts say big box rivals such as Walmart are taking market share. Walmart lower now by 0.6%. So again, recapping, we've got ourselves a Thursday sell-off underway with the S&P down 51 right now, a drop of 0.9%. Balance of power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie Pellet, thank you, sir. Watching Wall Street for us here on the fastest show in politics. Thank you for joining here on the Thursday edition. Yeah, it's Little Friday, and we've got our arms stretched around Washington here with activity on both ends of Pennsylvania Avenue that require your attention here. As Charlie mentioned, we're going to have to start warming up to the California Pinot and Cab all over again because the wine from the other side of the Atlantic may be about to get a lot more expensive. 200% tariffs, says the president. On your Chianti, your Brunello di Montalcino, your Vaqueras, Gigonda, and Chateauneuf de Pape. So, hey, look at the bright side. There's a meeting tomorrow, as we just heard. Trump White House meeting with the EU Trade Commissioner magically on Friday, knowing that reciprocal tariffs are set to take effect on April 2nd. This is all going to be part of a special conversation that we have coming up for you in about 20 minutes' time with the former Treasury Secretary Steve Mnuchin. You'll hear it live right here on Bloomberg TV and radio. In the meantime, we're watching the process unfold on Capitol Hill that, well, we have been told on a daily basis would not result in a government shutdown. Now we're told the odds are rising on a shutdown. We're going to have to bump into Nathan Dean and see where BI is on this because things got a lot more complicated late yesterday. Chuck Schumer says Democrats are not playing ball, and a lot of it has to do with the conversation that we just had with Tazra Mitchell, the cuts that are happening here in Washington, D.C., the District of Columbia, as well as the DOGE cuts at large. In many cases, the White House not spending money that was allocated and passed by Congress. So Chuck Schumer says Democrats have had it. Here he is from last night.
Funding the government should be a bipartisan effort, but Republicans chose a partisan path, drafting their continuing resolution without any input from congressional Democrats. Because of that, Republicans do not have the votes in the Senate to invoke cloture on the House CR.
Yeah, the math is tough. John Thune, who filed for cloture last night and has an actual cloture vote scheduled for tomorrow, needs at least 7 Democrats to make this work. We're watching you, Rand Paul, as well as our panel. Jeannie Shanzano is with us right now, our Democratic strategist, of course, Bloomberg Politics contributor and senior democracy fellow for the Center of the Study of the Presidency and Congress. And great to have Lester back. He's been around the world since we've last spoke. Lester Munson, principal of the international practice at BGR Group, our Republican strategist. Great to see both of you here. Jeannie, is this real? Democrats going to sit on their hands this weekend?
I don't know. I have to say, I hope not. I mean, this is the Hobson's choice of all time for the Democrats. There is no good option. So I am empathetic to the position they find themselves in. They feel strongly that this is a chance to push back on what is happening with Doge. And you just talked about this, what the president is doing and all of that. And obviously they're out of power, so they don't get a lot of opportunities. But that said, I'm hoping they resist the temptation, because shutting down the government now would be a political win for Donald Trump and a disaster for Democrats, because there's nothing at the back end for them, particularly this ridiculousness of a 30-day CR. So I hope they resist the temptation. I'm not sure they're going to be able to do that because they are so frustrated.
As usual, Jeannie reaches for the news. This is what's going on here. Democrats are going to put up an amendment, their own CR proposal, that would extend government funding through April 11th. That'd be the 1 month CR here. Lester, I know that you have a sense of humor. Is this a joke here, or are we talking about a government shutdown?
I don't think it's a joke, although Jeannie's comments, wow. I think the 30-day extension is not a joke. It's an interesting option for Democrats, and you know what I'm hearing from my sources up on the Hill, particularly with that crowd, is they want to not give Trump a win here, but when push comes to shove on the actual vote, they don't want to be the ones who are closing the government. And so I think I'm right where Jeannie is. I think what you could see here is an interesting sequencing of the votes for Democrats. One of the things Republicans could do for them is, all right, we'll give you a little vote here to show that you don't really want the full year. You can vote on a 30-day, but then after that, we're going to vote on the full extension of the CR for the rest of the fiscal year, and we're going to need you to vote, at least a few of you to vote yes on that. And that might be a nice way out of the wilderness here for everybody.
Did you just put up a countdown clock, James? If you're with us on YouTube, Jeannie, there's a countdown clock in front of you now. Are we the first to get the countdown clock? You know what that means? We're really going to have to get odds on this thing, Jeannie. Look at this right now. They're counting down to a government shutdown. If it happens over the weekend, it's not real, right? If this is like a 2-day thing and they get it back together by Monday, what qualifies as a shutdown? And I ask you that knowing that a lot of Democrats believe if the government shuts down, many agencies will never reopen as long as Elon Musk is in town.
Well, that's right. First of all, how great it is when producer James is in New York and he can put up countdown clocks and all these cool things. Love it. There is a chance we do see, and we've always talked about this, a very minimal short-term shutdown. Now, obviously, it has impact. It's not quite as broad as if we saw a huge one. The reality, though, is this is why this is a Hobson's choice for Democrats. If they shut down the government, and I'm not just talking politically, of course, they'll be blamed by the Trump administration, what's new, but the reality is they're giving Doge exactly what they want. And this is one of the things we heard from Hickenlooper and others saying, and you just talked about this, Joe, then he gets to do what he wants to do. He's going to decide what's essential. And so, which really means Elon Musk will be doing it with him. So from so many perspectives, this is not good strategy, it is not good governing, it is not good politics. And boy, oh boy, it's so fun to be on with Lester, but can he please agree with me that that vote he just described is the epitome of political nonsense theater? We're going to give you a vote, and we all know it's not going to pass, wink, wink, wink. Then you give us this, and then we go off for vacation. I mean, that is what is probably not going to satisfy anybody, including the Democratic base. So I don't know why they would do that, but they may very well do just what Lester said.
Pull us in off the ledge, Lester.
Jeannie, yeah, I I don't know if you've noticed this or not, but there's a lot of theater happening in politics lately, and I think it's about time Democrats started to embrace the concept and fight on the same kind of battlefield that Trump is on, where he's really running away with it. They need to figure out how to get up there and do the same kind of razzmatazz. And maybe this is a really nerdy thing to get out of this, but they need some sort of fig leaf, some way to show, hey, we're not really with this guy, but also we don't want to shut down the government. That, I think, people will understand a little bit. And if you need to do a little, two-step on the floor of the Senate, that's okay with me.
All right, we can do the Texas two-step. We do have a little bit of breaking news I need to mention here. Jeannie, this is important, and it will be a big story as this develops later on in the day, something you're going to hear a lot about. Federal agencies must rehire the probationary workers who were fired by the DOJ. This is coming from a federal judge in San Francisco ordering the Trump administration, Bloomberg Law is the first to get to it, to rehire thousands of the government's newest employees terminated in early February. Jeannie, these are the same people who were, in many cases, locked out of their computers, fired by email or voicemail, not allowed back in the building. This requires the VA, Department of Energy, Interior, Agriculture, Treasury to rehire the fired employees. Once again, Jeannie, the court is the check on the administration.
That's absolutely right. And this has been the story of what we've seen so far with DOJ is they have just, gone with this chainsaw through cutting the people that they could as easily as they could with the probationary workers, unfortunately. And then you have the court stepping in and saying that is, unconstitutional, illegal, they must be hired back. Imagine if DOJ had been well prepared to do what we all needs to be done, which is to make smart cuts to these agencies and to do it in a way that it increased efficiency, it increased responsiveness, it saved money. Instead, to go and just cut people because they were the last hired makes no sense. I mean, all of us know it's not usually the last person who was hired who's not being effective. Sometimes it's the person who's been there for 40 years who's not being effective. So that is no mark of getting rid of people who are inefficient. So from every perspective, this is such important news. And of course, to your point, the third branch stepping up to do what it needs to do, which is to hold the administration's feet to the fire when it comes to respecting the laws and the Constitution of the United States in doing its work.
Lester, weigh in on the ruling to the extent that you want to, but I'm kind of curious your reaction that we're seeing in the financial markets to all of the activities of the DOJ combined with the confusion over tariffs. We're selling off again here. The S&P is down another 1%. The NASDAQ is down 1.5%. We're getting closer to 5,500 on the S&P 500. I mean, we're beyond round tripping, as you know, to before Election Day. What do you make of this visceral reaction to the rhetoric out of Washington?
Well, I think we're seeing that little Trump bubble from late January, early February popping, and just after the election, so that's gone. I think this is largely about the tariffs and the confusion and the back and forth and the uncertainty. It's hard for businesses to plan. I mean, it's a crazy situation. I think to the DOJ spending cuts issue, I have a different take here, I think, than Jeannie. I think this is, and I do hope, I think like she does, that in the long run there is an intelligent process here that is thought out and thinks about the things that we actually need to do and how we can do them in a more cost-effective way, and that's good. That needs to happen. That's probably going to be led by OMB and Congress going forward rather than DOJ, although DOJ can play a role. But I think for the last few weeks, what the DOJ process has done has enabled the president to get the CR through the House. It's distracted the Freedom Caucus, the real fiscal conservatives, from the actual situation with respect to the budget. The DOJ cuts don't actually result in any taxpayer savings. The money is still there. The CR that's going through basically keeps funding at a level, at a straight line going into for the rest of the year. And even these budget resolutions that Congress is about to consider with the reconciliation process show discretionary spending not going down over time. So there's like the real risk for Trump here is the fiscal conservatives, that they're going to bail out on his program. And he's using the Doge cuts to kind of keep them on side. It's a little bit of a magic act where he's doing the Doge as kind of the distraction while you're not looking on the other side, he's passing all these things through the Hill and getting Freedom Caucus to vote for him.
Yeah. We're going to keep doing the Doge with Lester Munson and Jeannie Shanzano. Our panel will stay with us in our second hour, and as I mentioned, we'll bring you a conversation about all of this with the former Treasury Secretary, Stephen Mnuchin, is going to be sitting down with Bloomberg's Saleha Mohsen right here in our studios in Washington. So stay with us as we welcome our global television audience to the conversation coming up as well here on the fastest show in politics. Big thanks to Jeannie and Lester. They're back with more. I'm Joe Matthew in Washington. This is Bloomberg.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Your Chianti may come next. Welcome to the fastest show in politics as President Trump threatens new tariffs, 200% tariffs on wine, champagne, and other alcoholic beverages from Europe. I'm Joe Matthew alongside Kaylee Lyons in Washington. Thanks for being with us here on the early edition of Balance of Power on this Thursday. Kaylee, this is happening ahead of reciprocal tariffs set to take effect on April 2nd, and it's coming alongside a meeting today between President Trump and NATO's Secretary General at the White House.
Yeah, that meeting ongoing as we speak in the Oval Office, where trade is a topic of conversation. The president, when asked by a journalist, said he will not be bending on metals tariffs or those April 2nd tariffs you were referring to, Joe, but no surprise, given who is in the room with him, the NATO Secretary General. There's also a lot of discussion about the war in Ukraine, or more specifically, negotiations to end it, as well as the idea of increased defense spending by other NATO allies.
That's right. We're going to keep tabs on the conversation that's taking place in the Oval Office, and we hope to hear a portion of that conversation a bit later on this hour. First, we have a very important conversation for you right here in our Washington studios. Kaylee, the former Treasury Secretary Mnuchin is with us straight ahead.
Yep, that'll begin in just a few minutes. But first, we want to check on the markets, because with all of this tariff back and forth, we are around the lows of the session. Charlie Pellet has the latest for us. Hey, Charlie.
Absolutely right about that, Kaylee Lyons. Right now, we have got the S&P right to the numbers, down 68, 55.31, where we stand right now on the S&P 500 index. That is a drop of just about 1.2%. Dow Industrials now down 463, declining by 1.1%. A NASDAQ lower by 309 now, down by 1.7%. The stock sell-off is deepening as trade war fears heat up. The 10-year, 4.28%. The 2-year, 3.96%. Spot gold up $44 the ounce, $29.79, up 1.5%. West Texas Intermediate crude selling off, down 1.4%, $67.70 right now. And Bitcoin now down by 2.9%, back with an $80,000 handle. Right now we have got Bitcoin at 80,733, Bitcoin down 2.9%. European spirits and drinks makers are lower after President Trump threatened to retaliate with tariffs on some European alcoholic products. LVMH, whose brands include Dom Perignon and Hennessy, trading lower. Down now, the ADRs are dropping 2%. And Diageo, whose brands include Johnny Walker, Bailey's, and Guinness, also lower now, down by about 0.2%. So again, we have got stocks selling off, trade concerns, the culprit. S&P down 68, drop there of 1.2%. Balance of Power continues right now. Lots going on. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
Lots going on indeed. Charlie Pellet, thank you so much. We'll be checking in with Charlie and the market action throughout this hour, and we'll, of course, bring you any new headlines out of the Oval Office. But first, here on Bloomberg TV and radio, we bring you an important conversation, as here in Washington, D.C., the former U.S. Treasury Secretary Steve Mnuchin is sitting down with our colleague, Saleha Mohsen. Saleha?
Thanks, Kaylee. We have Treasury Secretary Stephen Mnuchin with us here. Thank you so much for joining.
Thank you. It's great to be here with you.
You have a unique insight into this administration because you served all 4 years during the first term for President Trump. I wonder what you make of a difference that we're seeing with Trump this time around. He is a little less concerned about day-to-day market swings. We've seen big tariff talk, 200% tariffs, 25% tariffs, 10% across the board. And the S&P 500 has wiped out $5 trillion in part because of this. What do you make in the shift in Trump's thinking about markets?
I think the execution is slightly different, but I think the fundamental economic policies are actually the same. And this goes back to what the president campaigned on in 2016, tax cuts, regulatory relief, and trade. And those are the same things you're hearing about today. I would say it's critically important that the tax cuts are extended, and I know President Trump wants to add additional tax cuts. He's always been very focused on trade. I think that you're seeing a more aggressive trade policy in this administration, and I think one of the questions is, does the president want to use this to negotiate, or does he want to use this to raise tariff revenue, which he's talked about significantly, which if he's going to do that and use that to create tax cuts or pay down debt, is an interesting strategy for effectively creating a consumption tax on foreign goods.
Do you think that some of the tariff threats, pulling things back, bringing them back up, do you think that's a good policy?
Well, I think the market is adjusting to his negotiating, which I think in the beginning, the market thought that he wasn't serious about tariffs, despite the fact that I think, and I've been saying, he's very serious about tariffs. So I've suggested that if he wants to raise revenue, a 10% tariff across the board on everything would be very effective. They could score that as part of reconciliation, probably raise about $2.5 trillion, and that would be very effective in terms of creating tax cuts and paying down debt.
It's been a lot, though, for investors and business leaders and CEOs to absorb. What would your advice be to some of this constituency as they try to deal with and they get worried about all the stock market gyrations from these tariff threats?
Well, my first advice would be don't overreact. I know there's some talk about, are we going to go into a recession? I don't see us at all going into a recession. I think we could have a little bit of a slowdown in the economy as we pull back on government spending, but I don't think investors should be concerned about a recession. The second thing I would say is we came in with the market being fully priced. So I think a 5 to 10% correction on the S&P or the NASDAQ actually makes sense. The market's been really fueled by massive amounts of tech spending, particularly around AI. So some of this is a natural correction in the market, and some of this is the market worrying about tariffs and the impact on tariffs.
We're talking a lot about tariffs. You mentioned taxes as well. What do you make of Trump's strategy to do tariffs before tax cuts this year?
Well, I think it's just a timing issue. I think they're actually moving on what seems like an incredibly fast agenda, which is encouraging, that Speaker Johnson says he's going to get a bill to the floor before Easter, which, if that's the case, that includes both tax cuts and border. That's a very impressive timing. I mean, my concern about this one big, beautiful bill was it was going to take too long, and that the president could get a quick, easy win on the border. And the tax issues, as you know, Soleil, are quite complicated. So these things have to be thought through carefully and balanced.
You, as Treasury Secretary in 2017, were the face of the administration's efforts to get that tax bill through Congress. Based on that experience and what you know and see now of Washington, what do you think the chances are that there will be a successful extension of the tax cuts that Trump seeks?
Oh, I definitely think there'll be a successful extension. I think it just depends what it includes. And look, we're very proud of the work we did in the first administration. And obviously, the Tax Cuts and Jobs Act was sweeping reform. I mean, it took all year because it impacted almost every single part of the economy. It dealt with domestic taxes, it lowered corporate taxes, it lowered individual taxes, it had business tax credits. Right now, they're dealing with a much smaller segment. The most important priority is, in my mind, extending the tax cuts, which from an operational standpoint is actually quite easy to do. And then they have to consider some of these other ideas that the president has thrown out and figure out how they could pay for them as well.
Do you think that the SALT cap is something that needs to be part of the bill?
Well, it only needs to be part of the bill if that's what you need to do to get Republican votes to get the bill over the finish line. So there's no question that, putting a cap on SALT was a fundamental issue that we thought of fairness, treating all the states similarly. Having said that, I recognize there's a small majority in the House, and this clearly impacts places like New York disproportionately, and I understand why the New York members want to see that raised.
So far, it seems like that might be one of the sticking points. Are there any other sticking points that you see bubbling up as this tax bill comes together?
I think the bigger issue is the pay-fors. So you have some people who say this should be scored against current policy and it doesn't cost anything. The traditional way of scoring this is against what's the current law. After with the reduction of the tax cuts, and that would be over $4 trillion. So obviously, if you score it that way, the pay-fors are very significant. I am concerned, and you've heard Treasury Secretary Bessent and others talk about the deficit. I think the deficit is our number one problem today. So I think that whatever tax cuts are passed, at least some of them have to be paid for.
That's one of the larger differences between 2017 when you worked on this and now that the deficit is just so big. How much harder does that make Bessent's job?
I think it's quite significant. And, if you put this in context, when we did this, the entire tax bill cost $1.5 trillion. There was about $500 billion that we thought that was the difference between dynamic and scoring, and there was another $500 billion of things that were extenders. So we thought the true cost was closer to $500 billion, and that we could easily grow the economy to pay for that. You're now talking about an economy that's much bigger. The numbers are much bigger. So the personal side alone is over $4 trillion. So the pay-fars are much more significant. We also have a much bigger budget deficit. We had much more fiscal room in 2017, and we had lower interest rates. So the interest on the debt wasn't as big of a problem. So you add all those things up, and yes, it's more difficult today, but it's also simpler in that the tax cuts themselves are much simpler.
You know this so well. In 2017, you were a key negotiator. You were the face of the administration's efforts, like I said. How important do you think it is for the Treasury Secretary to lead the charge on tax bill creation and negotiations?
I think it's very important because it's the president's signature achievement, and extending it is critically important for the administration.
We got to know each other during those 4 years when you were in office, but one area that we never talked about that was never a big deal when you were there was the payments system. With your 4 years of experience, you know how sensitive and significant the work at the Bureau of Fiscal Service is. Are you concerned at all about DOGE's access to the payment system?
Well, let's step back and just talk about the payment system. And you're right, we didn't talk about it much. Treasury is a gigantic payment processor for the federal government. So this is an important part of Treasury, but Treasury's role, as you can think of, is the bank. So what Treasury does is it takes in files from other parts of the government. The other departments certify those files. Treasury makes sure that it's in the proper form, that it can execute them, and it executes them. So it's not Treasury's job to determine whether those payments are good payments or bad payments. You know, I'm very comfortable with what I understand Treasury Secretary has said in regards to the controls over the payment system. That's the most important issue. I think some of the things that Elon has said make a lot of sense. I mean, does it make sense that you put a category payment around the payment? Of course. Now, those are things that should be easily added. You know, I will say what we did work on was the transparency issues associated with this, that, you know, we put up on the internet a system where you could see most of the government payments. So, you know, I think a lot of this topic today makes a lot of sense, but I'm comfortable today the system appears to be very safe.
Do you think that investors should be worried about the U.S.'s ability to fulfill its debt obligations, considering how much activity there is around the payment system right now with DOGE in there?
Again, I know there were some concerns about DOGE in the beginning. That seems to be taken care of and not an issue. Obviously, the bigger problem with the payments is going to be the government debt and the debt ceiling.
One thing I've noticed that Secretary Besson is doing that's a little bit different than years past is putting a focus on lowering long-term bond yields instead of looking to the Federal Reserve to lower interest rates. I'm curious what you make of this strategy.
Well, I think he's right in the sense of a large part of the economy is tied to longer-term rates. So whether it's mortgages or other things, and whether it's the 5-year or the 10-year, there's a large part of the economy. For a long time, we had a very flat yield curve. Ultimately, what the Fed does will have an impact on long-term rates. I think if you actually look at the market today and you look at the dot plot, you know, the Fed is telling you basically their expectation is that they will lower rates down to 3.5%. It's just a question of when they get there. Right now, that's projected next year. And I think the 10-year Treasury already has that priced in. So I think it's built into the market today.
In the last couple of weeks, we have seen yields drop due to recession fears. Do you think that Besson might be getting what he wanted, but for the wrong reasons?
Well, I think he wants long-term treasuries to come down, and I think part of that is around creating, as there's less government spending, there's no question, and they can convince the market that they're going to cut the deficit. That will help long-term rates. But, I'd say, look, the 10-year's been bouncing around in a 20 basis point range, which I consider to be a market range.
One of my favorite things to ask current and former Treasury Secretaries is about currency policy, something that we've spoken about as well. We're expecting, at least in the next couple of weeks, the first foreign exchange policy report coming out of the Treasury Department. When you were in office, you labeled China a currency manipulator. I wonder if you think that that is an effective tag to apply.
I think it's one of the effective tags to apply. It's not the only effective tag, but I think it was one of the tools in the toolbox. And now it's more fun talking about currencies because I think, as you know, kind of like Treasury Secretary 101 is everybody's supposed to just say, oh, strong dollar, strong dollar. As you remember, when I was at Davos, I made for the first time a comment more on a stable dollar and the benefits of a strong dollar and the problems with a strong dollar, and the market reacted accordingly. But I really do think the policy should be a stable dollar policy. That's what's good for the U.S. That's what's good for the world. I think the dollar will be the reserve currency for the foreseeable future. But you don't want a dollar that's too strong that hurts us from an economic standpoint.
You can speak much more freely about currency policy now. Thank you so much for joining. Kaylee, back to you.
All right, Saleha Mohsen with the former U.S. Treasury Secretary Steven Mnuchin live here on Bloomberg TV and radio. Fascinating conversation, especially in light of the developments, Joe Matthew, that we have gotten on trade just within the last, 6 hours as President Trump is now threatening to retaliate for Europe's retaliation to his original steel and aluminum tariffs. We're now talking about a potential 200% levy on things like wine coming from European nations, in addition, of course, to all of the other economic elements that factor into the president's agenda, tax policy well included in that.
That's true, and it's, of course, happening against the backdrop of a meeting today with NATO's Secretary General. Kaylee, they are still in the Oval Office, and this has been going on now for well over a half an hour, and it's a conversation that is keying off tariffs to some extent. The president made clear in advance this would not just be a NATO conversation, a Ukraine conversation, but one about trade. And we're watching, of course, headlines pass by on the terminal here. We'll bring you into the Oval Office in a short time for this conversation. But based on what we've seen, these can go on for some time. One thing that we do know is he is still promising reciprocal tariffs on April 2nd. And this threat now, it's hard to tell what the timeline is. Howard Lutnick was asked earlier on Bloomberg Surveillance. He said shortly in his tweet about, or his truth about these tariffs on wine and other spirits from Europe. Would that come April 2nd? We don't know.
Yeah, there's a lot we don't know, but we will hopefully be bringing you more insight from the president himself in his own words, along with Mark Rutte, the Secretary General of NATO, when we do get that tape played back. I would also point out that the president hasn't been able to avoid questions about a potential government shutdown that could be as soon as midnight tomorrow. That's the deadline, as Senate Democrats are promising to block the Republicans' plan, or at the very least not provide the requisite votes to get over the procedural hurdles that would make sure the lights don't turn off. The president says if he's needed, he'll engage in those conversations, but he also said it'll be the Democrats' fault, in his view, if the government shuts down.
That's Chuck Schumer says they're in lockstep on this, not a single Democratic vote as of yet. We'll see if that changes. Of course, a cloture vote is set for now tomorrow in the Senate with a midnight deadline on government funding. We'll assemble our panel next as we wait to hear from the president at the White House. Alongside Kaylee Lyons, I'm Joe Matthew. This is Bloomberg.
5:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are just about at the lows of the session as this 3-week sell-off continues. The Dow, the S&P, NASDAQ, all in the red right now, with the S&P right on the edge of that 10% correction. Right to the numbers here with the S&P down 83, 55.16 where we stand right now. That is a drop of 1.5%. The Dow now down 558 points, a decline there of 1.3%. And NASDAQ down 382, a decline of 2.1%. 10-year, 4.27% with the 2-year, 3.94%. Gold is rallying 1.5%, 29.78 on the precious metal, while West Texas Intermediate crude now slumping 1.6%, 66.60 on WTI. Bitcoin now down by 3.2%, 80,420 on Bitcoin. Former Treasury Secretary Steven Mnuchin says markets are adjusting to Trump trade negotiating, and in a conversation that aired moments ago here on Bloomberg Radio and Television, Mnuchin also said he does not see the U.S. at all going into a recession. Briefly after earnings, Dollar General up 3.7%. Its rival, Dollar Tree, down 3.8%. Walmart taking market share from both. Walmart lower now by 1.1%. Balance of power continues right now. Back we go to Washington. Once again, your hosts, Joe Matthew and Daily Lives.
All right, Charlie Pellet in New York, thank you so much, as the markets today are keying off the headlines around trade and tariffs, which we got more of from the Oval Office just moments ago as President Trump met with the NATO Secretary General Mark Rutte for a conversation that was supposed to be primarily about Ukraine and negotiations to end the war with Russia, as well as defense spending on the part of the alliance. And they did touch on that, but trade, of course, came up as well, as the president, when pressed by a journalist, said that he will not be bending on metals tariffs that have already been implemented or the tariffs yet to come on April 2nd.
We're not allowed to sell cars there, as Donald Trump has said before, Kaylee. We sell no cars to Europe. The European Union is very nasty. He even refers to lawsuits against Google and Facebook. We'll be hearing this conversation coming up here on Bloomberg, talking about wine and spirits today. A 200% tariff on wine, champagne, and other libations from Europe, which would mean a pretty significant increase in prices here. And he says that'll play great for American winemakers. By the way, he has his name on a sparkling wine and some others out of Northern Virginia.
A good point. Yeah, he specifically said good for U.S. wine and champagne, but I thought you couldn't even call it champagne unless it came from the Champagne region in France, right?
Funny how that works. Yes, you can't get champagne unless you go to Champagne. I don't know where our panel is on this, if they're stocking up on Chianti right now, but let's bring them in. Jeannie Shanzano is with us, Bloomberg Politics contributor, senior democracy fellow with the Center of the Presidency and Congress, our Democratic analyst, along with Republican strategist Lester Munson at BGR Group. Lester, are you taking this seriously? Is it time to start ordering wine, maybe buy your European car that you always dreamed of? Or we're going to hear that this was just a threat by the end of the day tomorrow, as the U.S. trade, the EU trade minister, I should say, meets with the administration. Is this as good as done?
Joe, I'm a little more worried for your lifestyle than mine, as long as we're not
I understand.
Pabst Blue. Yeah, as long as they're not hitting Pabst Blue Ribbon, I'm going to be okay. I do get a little concerned about these tariffs, and I think the market is concerned as well. The back and forth, the up and down, the inconstancy of the whole thing is distressing. I do think the president is not interested in imposing tariffs across the board for months and months and months at a time. I think he wants to use this as leverage to get certain policy outcomes. But the problem, I think, for the president is that it has this negotiating tactic has a diminishing effectiveness over time. He had a great episode with Colombia about a month ago, maybe a month and a half ago, with respect to these migration flights going back to Colombia. But I think it's going to be less effective in dealing with our allies in Europe. So I think it'd be better if he thought of a different point of leverage.
Yeah, Colombia, how quickly we forget the shortest trade war of all time. Jeannie, as we consider the remarks on tariffs here that he was making, mind you, at least the ones pledging to stick with it on April 2nd in the metals tariffs in front of someone who was a European leader of the Netherlands, now leading the NATO alliance, Mark Rutte, who was there to talk about specifically the war in Ukraine. Some of the headlines we've gotten from Trump around that is that he got word that things are going okay so far in talks with Russia, though Vladimir Putin seems to be sending some different signals about willingness at this time to agree to a ceasefire. What ultimately looks like success for Donald Trump in these negotiations, leaving the trade-oriented ones aside for now?
Yeah. I think, so many of us watched Vladimir Putin go out in his army fatigues yesterday. And now today we are hearing that he is open to a ceasefire. If Donald Trump and the Trump administration was able to reach a ceasefire between Ukraine and Russia, that would be an enormous accomplishment for Donald Trump and the administration. So there's no question about that. Now, we have to take a wait and see attitude. We don't know what the specifics would be, either of a 30-day ceasefire, really, or a longer term ceasefire. And that's why this meeting he's having with the Secretary General is so important, or the meeting that just concluded is so important. And, one thing we're hearing out of those readouts, and you guys were just mentioning this, is one thing that Donald Trump really agrees with Vladimir Putin on, and they describe the EU, I think he said today, is nasty. Before, he has said it was founded in order to, quote unquote, screw the United States. So this is something that he agrees with Russia on, and I'm curious to see if they do get a ceasefire and if they do get a peace agreement, which we all hope for. What does that mean for our relationship with our close allies in Europe and, of course, NATO overall?
Lester, is Article 5 actually being debated here, or is this a case of taking Donald Trump seriously versus literally here? He said it's common sense. If they don't pay, I'm not going to defend them, when asked about just the concept of Article 5 against the backdrop, of course, of the money that each NATO member is paying. They're not going to get near 5%. Do they need to start looking out for themselves?
I don't think so, Joe. I think it's a provocative statement, to be sure, but that's what President Trump is good at. He can make the pithy one-liner that gets everyone to focus on something that they might not have otherwise been focused on. And I think there was a more of a bubble of concern 2 weeks ago after the Oval Office meeting with Zelensky. I think things have calmed down a little bit. I think there's less worry that the U.S. is abandoning NATO and abandoning these decades-long commitments that have been so effective for the United States as well as Europe. But if he can use he'll use any little discrepancy in the relationship to kind of drive Europe to spend more on defense. I think that's a good thing in the grand scheme of things. Mm-hmm. I may not choose those particular tactics, but if the effort is to get Europeans to ramp up their defense spending, it is still badly needed. It's going to take a long time to do. That actually strengthens the alliance in 5 to 10 years. And so to Jeannie's earlier point, and boy, Jeannie's leaning a little bit more pro-Trump than I am currently, but to her earlier point about if Trump is successful at negotiating an end to the Ukraine war, if he's successful in strengthening NATO 5 to 10 years out and the alliance remains intact and a going concern, then people will have to look back and say, hey, this actually was a good thing he was doing back in 2025.
All right, Lester Munson and Jeannie Shanzano, our political panel today. Thank you so much. And to Lester's point on pledges on more defense spending, we did hear from Mark Rutte about that in the Oval Office earlier, and we're getting that tape back now of his meeting with President Trump. Let's listen on Bloomberg TV and radio.
Discussing what's happening with respect to Ukraine and Russia. At this moment, we have people talking in Russia. We have representatives over there, Steve Witkoff and others. And they're in very serious discussions. As you know, Ukraine has agreed, subject to this, what's happening today, to a complete ceasefire, and we hope Russia will do the same. Thousands of people are being killed, young people, usually, mostly young people. We were just talking about it. Thousands of young people are being killed a week, and we want to see that stop. And they're not Americans, and they're not from the Netherlands for the most part. They're from Russia, and they're from Ukraine, but they're people, and I think everybody feels the same way. We want it to stop. It's also a tremendous cost to the United States and to other countries. And it's something that would have never happened if I were president, and it makes me very angry to see that it did happen. But it happened, and we have to stop it. And Mark has done some really good work over the last week. We've been working together, and he's done some really good work, so I'm very happy about that. We'll also be talking about trade and various other things, and I think we'll have a very strong day. We're going to have lunch afterwards. That'll go, and then we'll see you all later. But Mark, would you like to say something?
Yeah. First of all, thank you so much, Mr. President, dear Donald, again for hosting me, and but also for taking time in Florida a couple of weeks after you were re-elected.
That's right.
And of course, our phone call a couple of weeks ago, and I must say, Trump 45, you originated the fact that in Europe we are now spending, when you take it to aggregate, 700 billion more on defense than when you came in office in 2016, 2017. But that was Trump 45. But when you look at Trump 47,
it's going to be hard to tell.
What happened the last couple of weeks is really staggering. The Europeans committing to a package of 800 billion defense spending. The Germans now, potentially up to $500 billion extra in defense spending. And then, of course, you had Keir Starmer here, the British Prime Minister, and others, all committing to much higher defense spending. We're not there. We need to do more. But I really want to work together with you in a run-up to the The Hague Summit to make sure that we will have a NATO which is really reinvigorated under your leadership. And we are getting there. We also discuss defense production because we need to produce more weaponry. We are not doing enough. Not in the US, not in Europe, and we are lacking behind when you compare to the Russians and the Chinese. And you have a huge defense industrial base. Europeans buying 4 times more here than the other way around, which is good because you have a strong defense industry, but we need to do more there to make sure that we ramp up the production and kill the red tape. So I would love to work with you on that. And finally, Ukraine. You broke the deadlock. As you said, all the killing, the young people dying, cities getting destroyed. The fact that you did that you started the dialogue with the Russians, and the successful talks in Saudi Arabia now with the Ukrainians. I really want to commend you for this. So, The Hague is my hometown. I love to host you there in the summer and work together to make sure that that will be a splash, a real success, projecting American power on the world stage.
What Mark is saying is when I first went to NATO, my first meeting, I noticed that very few people were paying. And if they were, they weren't paying their fair share. There were only 7 countries that were paying what they were supposed to be paying, which was,
it's even worse.
Could be even worse. But there were just very few countries that were paying, and even the paying, it was at 2%, which is too low. It should be higher. It should be quite a bit higher. But you had Poland, and I remember Poland was actually paying a little bit more than they were supposed to, which I was very impressed with. They've been actually terrific, and some of the others, but most of them weren't paying, or they were paying very little. And I didn't think it was appropriate to bring it up there, but I said it's going to be brought up at my next meeting. And my next meeting, the first meeting, you want to give them a little break. The second meeting, it began, and I was able to raise hundreds of billions of dollars. I just said, we're not going to be involved with you if you're not going to pay. And the money started pouring in, and NATO became much stronger because of my actions and working along with a lot of people, including Mark, but they would not pay for other presidents, and I don't think other presidents even knew that they weren't paid. I asked, first question, has everybody paid up? And literally, I mean, they told me 7. You could be right, it could be 3, but that makes it even worse, but they just weren't paying. And I said, no, I won't protect if you're not paying. If you're delinquent or if the money isn't paid, why would we do that? And as soon as I said that, you got a little hit from the press because they said, oh, gee, that's not very nice. But if you said the other, nobody would have paid. And the money started coming in by the billions. And, hundreds of billions of dollars flowed into NATO, and NATO became strong. Yeah. And you remember that. Your predecessor, who I thought was a very good man.
Absolutely. Yes, Stoltenberg. He sends his best greetings.
He was terrific. Stoltenberg, Secretary General. And he made the statement that when Trump came in, the money started coming in like we never saw before. Hundreds of billions, actually probably close to $600 billion came in. and NATO became strong from that standpoint. And now we have to use it wisely, and we have to get this war over with, and you'll be back to a normal, much more normal life. And maybe we're close. We're getting words that things are going okay in Russia, and it doesn't mean anything until we hear what the final outcome is. But they have very serious discussions going on right now with President Putin and others, and hopefully they all want to end this nightmare. It's a nightmare. It's a horrible thing when you look. I get pictures every week. They give me the pictures of the battlefield, which I almost don't want to see. It's so horrible to see young people laying arms and legs and heads laying all over the field. It's the most terrible thing that you'll ever see. And it's got to stop. These are young people with mothers and fathers and sisters and brothers and friends. And it's got to stop. So we hopefully are going to be in a good position sometime today to have a good idea. We'll have, we know where we are with Ukraine, and we are getting good signals outside of Russia as to where we are with Russia. And hopefully they'll do the right thing. It's really humanity. We're talking about humanity. We're not talking about the money. But then you add the money to it, and, you know, hundreds of billions of dollars is being spent and really wasted so unnecessarily. It should have never happened. So it's an honor to have you here. They picked a great gentleman. I'll tell you, I was so happy to hear, because you had somebody, Stoltenberg was really good, and you have somebody that's going to do an incredible job. And I was so much in favor of you. You have no idea. They had another person that I did not like. I was not happy. And I think I kept him from, you know what I'm talking about. I said, this is the right man to do it. And he really did. He was a great prime minister of the Netherlands. He did a great job. And that's what he's doing right now. So thank you, everybody, for being here. And it's a very great honor to have you. And we even have some of our great energy people here today, right? We have the governor, and we have Chris, you know Chris. He's supposed to be the most talented man in the world of energy, according to the governor. So I don't know if he's right. And we have General, you've been fantastic. Thank you very much. And we have a lot of good people that won't be so much involved with this, but they wanted to see what was happening. It's become a little bit of a show, but they wanted to see what was happening, and I think a lot of good things are happening. So with that, if anybody would have a question.
Mr. President, on Russia.
Please, go ahead.
Sorry.
It was Steve Witkoff's trip to Moscow. You spoke about it. What sort of agreement do you hope he comes away from this with?
Well, we'd like to see a ceasefire from Russia, and we have, you know, not been working in the dark. We've been discussing with Ukraine land and pieces of land that would be kept and lost, and all of the other elements of a final agreement. There's a power plant involved, you know, a very big power plant involved. Who's going to get the power plant, and who's going to get this and that? And so, you know, it's not an easy process. But phase one is the ceasefire. A lot of the individual subjects have been discussed, though. You know, we've been discussing concepts of land, because you don't want to waste time with a ceasefire if it's not going to mean anything. So we're saying, look, this is what you can get, this is what you can't get. They discussed NATO and being in NATO, and everybody knows what the answer to that is. They've known that answer for 40 years, in all fairness. So a lot of the details of a final agreement have actually been discussed. Now we're going to see whether or not Russia's there, and if they're not, it'll be a very disappointing moment for the world. Yeah.
Vladimir Putin just said he is open to a ceasefire, but he does still have some concerns. He suggested that you two should speak directly. Do you have plans to speak to him soon? If so, when are you confident you can get this across the table?
Sure. He did say that today. It was a very promising statement, because other people are saying different things, and you don't know if they have anything to really, if they have any meaning, or I don't know. I think some of them were making statements. I don't think they have anything to do with it. No, he put out a very promising statement, but it wasn't complete. And yeah, I'd love to meet with him or talk to him. But we have to get it over with fast. You know, every day people are being killed. It's not like, as we sit here, 2 people will be killed. Think of it. 2 people are going to be killed during this little period of time. Thousands of people a week are dying. So we really don't have very much time. We have to make this fast. It shouldn't be very complicated.
Mr. President, a representative of Canada, the finance minister, are in town and will meet members of your administration during the day. Any chances that you will ban on the tariffs on aluminum and the ones that are planned for April 2nd?
No.
You are not going to change your mind?
No, not. Look, we've been ripped off for years, and we're not going to be ripped off anymore. No, I'm not going to bend at all. Aluminum or steel or cars, we're not going to bend. We've been ripped off as a country for many, many years. We've been subjected to costs that we shouldn't be subjected to. In the case of Canada, we're spending $200 billion a year to subsidize Canada. I love Canada. I love the people of Canada. I have many friends in Canada. The great one, Wayne Gretzky, the great. Hey, how good is Wayne Gretzky? He's the great one. But we have, I know many people from Canada that are good friends of mine. But, you know, the United States can't subsidize a country for $200 billion a year. We don't need their cars. We don't need their energy. We don't need their lumber. We don't need anything that they give. We do it because we want to be helpful, but it comes a point when you just can't do that. You have to run your own country. And to be honest with you, Canada only works as a state. It doesn't. We don't need anything they have. As a state, it would be one of the great states anyway. This would be the most incredible country visually. If you look at a map, they drew an artificial line right through it between Canada and the U.S., just a straight artificial line. Somebody did it a long time ago, many, many decades ago, and makes no sense. It's so perfect as a great and cherished state. Keeping "O Canada," the national anthem. I love it. I think it's great. Keep it. But it'll be for the state, one of our greatest states. Maybe our greatest state. But why should we subsidize another country for $200 billion? It costs us $200 billion a year. And again, we don't need their lumber. We don't need their energy. We have more than they do. We don't need anything. We don't need their cars. I'd much rather make the cars here. And there's not a thing that we need. Now, there'll be a little disruption, but it won't be very long. But they need us. We really don't need them. And we have to do this. I'm sorry. We have to do this. Yes.
Mr. President,
yeah.
You have made it very clear that NATO needs to step up, although great progress has been made in your first mandate. How do you envision this new transatlantic?
Are you talking about NATO stepping up? Well, NATO is stepping up through this man. This man is a man that only knows how to step up. And we have the same goal in mind. We want the war ended. And he's doing his job. He only knows how to do a good job. That's one thing. That's why I fought for him to get that job. Because they had some other candidates that I'll tell you would not have done a very good job.
I need this part of the move for my family.
So we'll get you a clip. We're going to get him a clip of that little last statement. The rest of the statements he doesn't care.
Sir, how does this new transatlantic cooperation, how do you envision it?
Well, we have, that's one thing. I mean, you know, we're on the other side of the ocean. And they're right there. And yet, we're in for $350 billion because of Biden, and they're in for $100 billion. So it's a big difference. And it's unfair. And I said, you have to equalize. They should equalize. They should have. It should have never happened where Biden just gave this money away. Now, as you know, we have an agreement with Ukraine on the rare earths and other things, and that'll get us something back, a lot back. It'll get us our money back. We're not doing it for that, though. I'm just doing this to get the war stopped. I'm doing it really to save lives. But at the same time, we were treated very unfairly, as we always are by every country. And we're in for very substantially more than the European nations are in for. And that shouldn't be. You know, they're much more affected by it than we are, because we do have an ocean in between. But I don't know. I think good things are going to happen. I really do. I think good things are going to happen. I do say, we were talking before, and Mark was very nice. He said, if you would get involved, there would be nothing. You'd just be going on. This thing would have gone on for a long time.
Breaking a deadlock. It was crucial.
Yeah, we broke a deadlock. We did break a deadlock. I hope it's meaningful. Yes, did you have one? Yeah.
Yes, sir. Thank you, Mr. President. Amanda Head with Just the News. On the southern border, you've got DHS and ICE who are reporting that there was a little bit of fudging of numbers during the Biden administration on both the catch and the release side with respect to reporting the number of illegals coming into the country.
They cheated on the numbers. The numbers were. I love that question. Who are you with?
Just the News, Amanda Head.
Very nice. That's good. That's
Do
good.
you know how many of those are criminal illegal aliens? And
Many of them.
Biden's out of office, Alejandro Mayorkas, who gets
No,
held
Biden
accountable?
fudged the numbers. The numbers were totally fake. And he gave fake numbers. I knew they were fake. Everybody knew they were fake. But now it came out. And terrible what they did. That administration was a horror show for this country.
Can you hold anyone accountable?
Well, I don't know. They gave phony numbers. And phony numbers are a very bad thing to give. But I'm not sure about that. I don't know how it would play. We want to get it straightened out. We're after many, many bad people that were let into our country, and Kristi Noem and my friend Homan. How good is Tom Homan doing, right? And they're after him, and you see they're taking him out in record numbers. Gang members, gang leaders, drug dealers. There's a problem the Netherlands does not have. The Netherlands never had this problem. If you'd like to take it, I could deliver some people. I could deliver some nice people to the Netherlands if you'd like.
I'm not sure.
No, what he did to this country, letting 21 million people flow through an open border. Many of those people were hard criminals from prisons and jails, from mental institutions, and I always say insane asylums because they were seriously deranged. And they're here from, not South America, from all over the world. From South America, but from all over the world. And it's so sad. You'd say, why would anybody do this? Why? Yeah, go ahead.
And one more, there's some new internal Democrat polling that doesn't look great for Democrats, but it also has 54% unfavorability for Republicans in swing states and battlegrounds for the midterms. Do you consider those voters capturable for Republicans?
Yeah, well, we did. I won every swing state, as you know, by a lot. And I won the popular vote by a lot. And we won the counties. If you look at the counties and district plan, we had 2,725, and they had 501. That's why the map is all red. So we had a great thing. Yeah, I think winning from the Democrats, if you look the other night, I made a speech, and I introduced two young ladies who were killed, viciously, violently killed. Young, unbelievable, both outstanding people. They were killed by illegal aliens. And the Democrats wouldn't get up and applaud. The mothers were, inconsolable. They were crying, and everybody was crying. The Democrats sat there with stone faces. They didn't clap. They didn't stand. They didn't do anything. We had a young man with very serious cancer. His dream is to be with the police department someday. And he was introduced. They didn't even clap. They were disgusting, frankly. They were disgusting. There's something wrong with them. They're deranged. They're deranged, like Jack Smith. They're deranged people. And I never saw anything like it. I'm standing up, and I introduced the mother and the parents of these two young girls that were just recently essentially killed, violently killed. And the Democrats are like this. It's so sad. And I saw this morning where one of them is pretty well known, one is fighting like crazy over men being able to play in women's sports. I said, I thought that was tried. I thought that was about I think it's a 95% issue. But in a way, I want them to keep doing it because I don't think they can win a race. And I tell the Republicans, I said, don't bring that subject up because there's no election right now. But about a week before the election, bring it up because you can't lose. And everything's transgender this, transgender that. They have bad politics, but one thing, they stick together. I wish, and the Republicans stick together mostly, but we have a couple that are grandstanders. You always have grandstanders in life. But the Democrats, they have grandstanders, but when it comes to a vote, they do stick together, right?
It seems like they'll stick together on the shutdown. Will that hurt Democrats going into midterms?
Well, if they do a shutdown, and ultimately that might lead to very, very high taxes, because we're talking about a shutdown, we're talking about getting to work immediately on the greatest tax bill ever passed. That was the one we did. It was a renewal, and it's an addition to it. And we're going to cut people's taxes. And if we don't open, the Democrats are stopping all of these good things that we're providing. We're providing the greatest package of benefits that this country's ever provided. The biggest part of that's going to be tax cuts for the middle class and for businesses, small businesses, employers, people that hire people in jobs. And if it's shut down, it's only going to be, if there's a shutdown, it's only because of the Democrats. And they would really be taking away a lot from our country and from the people of our country.
Mr. President, on tariffs, you made clear you're not backing down from this, but many American small business owners say they are concerned that these tariffs are going to hurt them. What's your message to them?
They're going to be so much richer than they are right now. And we have many. Yesterday, General Motors was in. They want to invest $60 billion. The people from Facebook were in yesterday. They're going to invest $60 billion by the end of the year. Other people are talking about numbers. Apple, as you know, a few days ago announced $500 billion investment. They're going to build their plants in the United States, which, as you know, almost all of their plants are in China. Now they're building in the United States. Look, the reason is two things. Number one, the election, November 5th, and the other thing is tariffs. I think probably in that order. But Tim Cook came in and he announced 500, think of it, 500 billion, not million. 500 million's a lot when you think about it, right? But I would have been happy with 500 million, but it's $500 billion investment by Apple in the United States. And that's because of the election result, and it's because of the tariffs and the tax incentives too, tariffs and tax incentives. And I've never seen anything like it. We have plants going up now in Indiana. We have plants going up in Michigan. A lot of plants going to be planned from. I'm trying to steer them to Michigan because Michigan got so badly beaten by, what happened with Europe. If you look at Europe, take a look at the EU. We're not allowed to sell cars there. It's prohibitive because of their policies and also their non-monetary tariffs. They put obstacles in your way that you can do nothing about. But if you take a look at what happens, so we sell no cars to Europe. I mean, virtually no cars. And they sell millions of cars to us. They don't take our agriculture, we take their agriculture. It's like a one-way street with them. The European Union is very, very nasty. They sue our companies. Apple was forced to pay $16 billion on a case that, very much like my cases that I won. They shouldn't have been even cases, but we felt they had no case, and they ended up having an extremely favorable judge and decision. But they're suing Google, they're suing Facebook, they're suing all of these companies, and they're taking billions of dollars out of American companies, many more than the ones I just mentioned. And I guess they're using it to run Europe or something. I don't know what they're using it for, but they treat us very badly. China obviously treats us very badly. Almost everybody does, and I blame past presidents, to be honest, because when I was president, we received so far about $700 billion from China over the years on the tariffs that I put in. No other president got 10 cents from China. And that was only beginning, except for COVID. I would have been able to finish the process, but we had to fight the COVID thing, and we did really well with it, but we had to fight. And then we had actually, as you remember, Mark, we actually handed over the stock market. It was higher than just previous to COVID coming in, which was sort of a miracle, frankly. We did a good job. But the tariffs are very important. And I think the psychology, there's great spirit. When Mark came in, he said, congratulations, there's a whole new spirit, there's a whole new light over this country, and really over the world. Because you have somebody that, a whole group of people, really, because I talk about this whole group, that we know what we're doing, and a lot of great things are happening. But I've never seen investment like this. Trillions of dollars is being invested in the United States now that would have never, our country could have failed. Another 4 years of this, what happened in the last 4 years, our country would have been a crime-ridden mess. And I don't know if you noticed, little thing they call it, but it's not a little thing if you like eggs and you don't have a lot of money. Eggs have gone down 25% in the last couple of weeks. We inherited that problem, eggs. Groceries have gone down a little bit. Energy's gone down. Do you want to speak to that for a second, Governor? Would you just say a couple of words, you and Chris, about energy, what's happened?
Well, happy to, but I think that Chris and I just came from CERAWeek, which is the largest conference in the world, so global leaders, people from the EU, officials from all the energy-producing countries, all there, and all the global nationals, all the U.S. The spirit of that group is through the roof because now they realize that in the United States that President Trump's policies are pro-developing more energy, as opposed to we're trying to shut down energy, and that pro-growth, pro-business, pro-energy approach is giving people the optimism. So then the markets are reacting to that, and energy prices on the futures market are going to go down because people know we're not going to be killing off the energy we need for prosperity in all of our countries, but also for peace. Because people have used energy to fuel these wars that President Trump is working so hard to end, and we know that high energy prices were driving the inflation that he talked about. So it accomplishes two goals for us, which is prosperity for the world, peace for the world, when we have smart energy policies, and President Trump has brought common sense back to how we think about energy.
And it's brought down now $65 a barrel, I saw this morning. That's phenomenal news, and that's what brought it up. The energy they took our beautiful energy policies and they just messed them up. And then they went immediately back to them but by that time they lost it. They lost that Bronco, as the expression goes. Chris, do you have something to say?
Oh, I think Doug said it well, but you just can't overstate how important the return of common sense, the return of knowledge about energy and pro-American consumers, pro-investment in our country. I think globally that was welcomed. It means capital flows, it means more sobriety and lower energy prices, more economic opportunity for Americans. So yeah, it was elated atmosphere at a global energy conference.
Well, we're working on one project. It should be very easy. It's a pipeline going through a small section of New York. New York's held it up for years, actually, for years. They wanted to do it for years and years, and it will reduce the most expensive energy almost in the world is in New England, because they have no way of getting it there because it's been held up by New York. And the whole of New England and Connecticut and New York, the energy prices are through the roof. And this one pipeline will save per family $2,500 just on heating and another $2,500 on everything else. So the energy, by just a simple pipeline going through an area that wants it, an area that's not a rich area. It's actually a very poor area. We create jobs and everything else. And it's going to be way underground. Nobody's going to see it. Once they fill it up, nobody's going to see it. Nobody's going to know it's there. And families in New York and Connecticut and New England are going to save $5,000 a family. Think of that. Because right now they have the highest energy prices maybe in the world. They say New England is a disaster. So we're working on that. In fact, the governor's coming in, Governor of New York, Kathy Hochul, who's a very nice woman. She's coming in tomorrow morning at 9 o'clock. To meet me on that and other things. Not only that, but other things. So I hope we don't have to use the extraordinary powers of the federal government to get it done. But if we have to, we will. But I don't think we'll have to. I can tell you Connecticut wants it and all of New England wants it. And who wouldn't want it? And it's also jobs on top of everything else. So that's going to be very exciting. So we're meeting with the governor tomorrow morning.
Mr. President, question. Thank you, Mr. President. Greenland. What is your vision for the potential annexation of Greenland and getting them potentially to
Well, I think it'll happen, and I'm just thinking, I didn't give it much thought before, but I'm sitting with a man that could be very instrumental. You know, Mark, we need that for international security, not just security, international. We have a lot of our favorite players, cruising around the coast, and we have to be careful. And we'll be talking to you. It's a very appropriate, really a very appropriate question.
It's an issue in the high north, so the Arctic. So what you did, so when it comes to Greenland, yes or not joining the US, I would leave that outside for me, this discussion, because I don't want to drag NATO in that. But when it comes to the high north and the Arctic, you are totally right. The Chinese are now using these routes. We know that the Russians are rearming. We know we have a lack of icebreakers. So the fact that the outside Russia, there are 7 Arctic countries working together on this under U.S. leadership is very important to make sure that that region, that part of the world stays safe. And we know things are changing there, and we have to be there.
Well, we just had an election there the other day. Do you see a referendum, a plebiscite, where the people of Greenland would be in a position to decide if they want to become part of the United States.
Yeah, it was a good election for us, as you know. It was not a referendum. It wouldn't be called that. It was an individual election. But the person that did the best is a very good person, as far as we're concerned. And so we'll be talking about it, and it's very important. Mark mentioned the word icebreaker. So we've ordered, we're in the process of ordering 48 icebreakers. And Canada wants to know if they could use them. I said, well, you know, you got to pay for them. Think of it, Canada. We pay for their military. You know, Canada pays very little for their military because they think we're going to protect them. But even with the icebreakers, so we're going to order 48, and Canada wants to be part of the deal. I say, you got to get your own icebreakers. I mean, if you're a state, you can be part of the deal. But if you're a separate country, you've got to get your own icebreakers. Russia, as you know, has about 40 of them, and we have one big icebreaker. But that whole area is becoming very important, and for a lot of reasons, the routes are, you know, very direct to Asia, to Russia, and you have ships all over the place, and we have to have protection. So we're going to have to make a deal on that, and Denmark is not able to do that. You know, Denmark's very far away and really has nothing to do. What happens? A boat landed there 200 years ago or something, and they say they have rights to it. I don't know if that's true. I don't think it is, actually. But we've been dealing with Denmark, we've been dealing with Greenland, and we have to do it. We really need it for national security. I think that's why NATO might have to get involved in a way, because we really need Greenland for national security. It's very important. You know, we have a couple of bases on Greenland already, and we have quite a few soldiers, and maybe you'll see more and more soldiers go there. I don't know. What do you think about that, Pete? So, don't answer that, Pete. Don't answer that question. But we have bases, and we have quite a few soldiers on Greenland.
Mr. President, some question your commitment to NATO. Will anything change? Your commitment to NATO. Will anything change? Same amount of money?
Well, I think they made a great step by putting Mark in charge. I think, to me, that's a great step, because he and I have seen eye to eye on everything for a long time. We've been doing this a long time now.
9 years now.
And so that's a great step. You have to keep NATO strong. You have to keep it relevant. But the biggest thing we have to worry about right now is what's going on right now. I think the rest is going to take care of itself. I don't see this happening. This was a fluke. This was something that, if we had a competent president, it would not have happened. The man was grossly incompetent. All you have to do is take a look at, he signs by AutoPen. Who was signing all this stuff by AutoPen? Who would think you signed important documents by AutoPen? You know, these are major documents you're signing. You're proud to sign them. You have your signature on something. In 300 years, they say, oh, look, can you imagine? Everything was signed by AutoPen, almost everything. Nobody's ever heard of such a thing. So, should have never happened.
Tomorrow with the Justice Department about law and order. Could you tell us a little bit about that?
Yeah, we're going to be with the Justice Department. We have a great Justice Department. Pam Bondi is so fantastic, and Todd Blanche, and Emil, you got to know him a little bit. He was acting for a little while. And some other people are incredible in the Justice Department, and I consider the FBI to be a part of it in a sense, and Cash is going to be fantastic, and all the people. Dan Bongino, I love that. I mean, I love that. I think Dan is great. I think we have unbelievable people. And all I'm going to do is set out my vision. It's going to be their vision, really, but it's my ideas. And basically, we don't want to have crime in the streets. We don't want to have people pushed into subways and killed, and then the person that did the pushing ends up in a 15-year trial and gets off scot-free. We want to have justice, and we want to have safety in our cities as well as our communities. And we'll be talking about immigration. We'll be talking about a lot of things, the complete gamut. So I look forward to that. That'll be tomorrow at the Justice Department.
Mr. President, you are a man of peace. You said it several times, and you made it very clear. A man of peace dealing with belligerent people. And I'm thinking, we saw how you handled Zelensky in this very own room. What is your leverage on Putin? Are you thinking sanctions? What if he refuses to?
Well, I do have leverage, but I don't want to talk about leverage now, because right now we're talking to him, and based on the statements he made today, they were pretty positive, I think. So I don't want to talk about that. I hope Russia's going to make the deal too. And I think once that deal happens, you're never going to be in a process. I don't think they're going back to shooting again. I really believe if we had if we get a peace treaty, a ceasefire treaty, I think that leads to peace. That's going to really lead to peace. I don't think anyone wants to go back. They've been doing this for a long time, and it's vicious and violent. And I think if President Putin agrees and does a ceasefire, I think we're going to be in very good shape to get it done. We want to get it over with. That's why it was very important what I instructed everybody, including Steve, what we're looking for, to discuss concepts of land, concepts of power plants, because it's complicated. You know, you have you're sort of creating the edge of a country. The sad part is that country, if this didn't happen, and it wouldn't have happened, I don't know if they would have to give anything back. I guess Crimea, you know, I said it last time, Crimea was given by Obama. Biden gave him the whole thing, and Bush gave him Georgia. And Trump didn't give him anything. I gave him, you know what I gave him? I gave them javelins. And the javelins were very effective, as you know. I gave them nothing.
2019.
And then also, if you take a look, I was the one that stopped the pipeline going into Europe. It was totally stopped. Nord Stream 2, nobody ever heard of Nord Stream 2 before I came along. But I got along very well with President Putin. I got along with most of them. I get along great with President Xi. I got along great with Kim Jong-un. I got along great with all of them. And we had no wars. We had no problems. We wiped out ISIS in record time. General Raisin Kane. And he wiped him out, and he was going to be our new chief, right? He's going to be the head of Joint Chiefs of Staff. And he's a highly respected man. He's going to be great. Pete's going to be fantastic. I have no doubt about it. We have a great team, really great team. Yeah, please. Go ahead, please.
Mr. President, some of our allies have said that they're worried that they could be the next to be attacked by Russia. You've spoken directly with the Russian president. Yeah. Do you think those fears are justified?
No, I don't. I think when this gets done, it's done. They're going to all want to go home and rest. I don't see it happening. Nope, I don't see that happening. And we'll make sure it doesn't happen. Not going to happen, but we'll make sure it doesn't happen. Yeah, go ahead, please.
Leaders from Russia and Iran are heading to Beijing tomorrow to discuss nuclear programs. What do you hope to get out of that?
Well, maybe they're going to talk about non-nuclear programs. Maybe they're going to be talking about the de-escalation of nuclear weapons, because, you know, I was talking about that with President Putin very strongly, and we could have done something had that election not been rigged. We would have had something. I think I would have made a deal with Putin on de-escalation, denuclearization, as they say, but we would have de-escalated nuclear weapons, because the power of nuclear weapons is so great and so devastating. And right now, Russia and us have by far the most, but China will catch us within 5 years. China doesn't have, but they're in the process of building, and they build. And within 4 or 5 years, they'll probably have the same.
And by the way, this is a Republican tradition. Ronald Reagan, when he negotiated with Gorbachev in the 1980s about bringing down the number of nuclear weapons, it's what you have been doing your first term, and it is important.
It would be a great achievement if we could bring down the number. We have so many weapons, and the power is so great. And number one, you don't need them to that extent. And then we'd have to get others, because, as you know, in a smaller way, Kim Jong-un has a lot of nuclear weapons, by the way, a lot. And others do also. You have India, you have Pakistan, you have others that have them. And we'd get them involved. But we started off with Russia and us. We have by far the most. And we were going to denuclearize. And that was going to happen. And then we were going to China. And I spoke to China. I spoke to President Xi about it. And he really liked the idea. You know, he'd like not to spend trillions of dollars building weapons that hopefully he's never going to have to use. And because they are very expensive also. So That would have been great. Okay, one or two more.
There's been tension in the...
Thank you. We're looking at an impending government shutdown Friday at midnight.
Yeah.
Democrats for 30 years straight have said if there's a shutdown, bad things happen. Do you anticipate direct negotiations yourself with conference leader of the Democrats, Chuck Schumer?
If they need me, I'm there 100%. It's right now. It's 2 or 3 people. If it shuts down, it's not the Republicans' fault. You know, we passed a bill where we had an incredible Republican vote. We only had 1 negative vote, a grandstander. You know, 1 grandstander. There's always a grandstander in the lot. But it was amazing. People were amazed that the Republicans were able to vote in unison like that, so strongly. If there's a shutdown, even the Democrats admit it'll be their fault. And I'm hearing a lot of Democrats are going to vote for it, and I hope they do. This is an extension. But ultimately, we want to vote for one big, beautiful bill where we put the taxes in, we put everything in. We're going to have big tax cuts. We're going to have tremendous incentives for companies coming into our country and employing lots of people. It'll be, I called it, in a rare moment, one big, beautiful bill. That's what I like, and it seems to be that's where they're heading. And we'll have to take care of something to do with Los Angeles. A place called Los Angeles almost burned to the ground. By the way, I broke into Los Angeles. Can you believe it? I had a break-in. I invaded Los Angeles, and we opened up the water, and the water is now flowing down. They have so much water, they don't know what to do. They were sending it out to the Pacific for environmental reasons. Okay, can you believe it? And in the meantime, they lost 25,000 houses. They lost, and nobody's ever seen anything like it. But we have the water. I'd love to show you a picture. You've seen the picture. The water is flowing through the half pipes. You know, we have the big half pipes that go down. 25 years ago, they used to have plenty of water, but they turned it off for environmental reasons. Well, I turned it on for environmental reasons and also fire reasons. But and I've been asking them to do that during my first term. I said, do it. I didn't think anything like could happen like this, but they didn't have enough water. Now the farmers are going to have water for their land, and the water is in there. But I actually had to break in. We broke in to do it because we had people that were afraid to give water. They were, in particular, they were trying to protect a certain little fish. And I said, how do you protect the fish if you don't have water? They didn't have any water, so they're protecting a fish. And that didn't work out too well, by the way. So they have a lot of water going down throughout California, all coming out from the Pacific Northwest, even some from Canada. Thank you, Canada, very much. I appreciate it. Next thing you know, they'll want to turn the water off. They want to charge us for the water. But it comes up from the Pacific Northwest, and it's a beautiful thing to see. I mean, it is brimming with water. Now, if they would have had that done, you wouldn't have had the damage because the fire would have been put out. The fire hydrants would have been loaded. The sprinklers in people's living rooms and bedrooms would have been loaded up with water. They had no water. The government makes them put sprinklers, and they had no water in the sprinklers because they had no water. So the water is flowing, and we're going to have to give a lot of money to Los Angeles to help them. And the Democrats are going to want to do that. So that's the one thing different. And frankly, I think that makes it a lot easier. But one of the big thing is we have the big, beautiful bill. We got to get that done. And that will put our country in a position like it's never been. It's a reduction of taxes. It's tremendous incentives for companies to come from all over the world into our country. It's great environmentally. But it's not this environmental scam that we went through, that we all went through. It provides for everything. It's a big, beautiful bill, and I hope we can get it approved, and that'll be next. But in the meantime, we have the continuing resolution, and the Republicans have approved it, and now the Democrats have to approve it, and I hope they will. And I think a lot of them, I can tell you, they want to. I've spoken to some of them. They really want to. Their leadership may not want them to. And if it closes, it's purely on the Democrats. One more?
On Korea, sir, we've seen tension increasing in the peninsula. You've talked about Kim Jong-un. Do you have any plans of re-establishing the relationship you had during the first mandate?
Well, I would. I had a great relationship with Kim Jong-un, North Korea. If I wasn't elected, if Hillary got in, you would have had a nuclear war with North Korea. He expected it. He expected it. And they said, oh, thousands of people. No, millions of people would have been killed. But I got in. We went to Singapore, we met. We went to Vietnam, we met. We got along really good. We had a very good relationship, and we still do. We still do. You don't have that threat that you had. I mean, look, when I was running the first time, it looked like there was going to be a war with North Korea. You know that better than
Tensions were
anybody.
high.
Yeah, and
everybody
it started
was startled that you invited him for talks, but you did.
It started off very rough, and he wouldn't meet with Obama, wouldn't take his calls. I said, how many times did you call? They called a lot. He wouldn't take their call. He told me I wouldn't take his call. But with me, it did start off rough, if you remember. Very rough, actually, very nasty.
There was a Singapore.
And yeah, but then, no, before that, then it stopped. The rhetoric was extremely tough. It was.
You had a speech in the UN, I remember.
Yeah, that's right. It was a little bit dangerous. And then we met. They asked for a meeting, and we met. And the meeting caused the Olympics, which was in South Korea, to become a tremendous success. Nobody was buying tickets for the Olympics because they didn't want to be nuked. And I met, and not only did the Olympics become successful, but North Korea participated in the Olympics.
His sister visited.
It was an amazing thing. And that was something that was an achievement of the Trump administration, great achievement. And so I have a great relationship with Kim Jong-un. And we'll see what happens, but certainly he's a nuclear power. Okay? Thank you very much, everybody. Thank you. Thank you very much. Thank you very much.
All right, everybody, you have been listening to President Trump in the Oval Office with NATO Secretary General Mark Rutte, commenting on a lot of things, everything from Greenland, Canada, tariffs, North Korea. We're going to talk about that. A very good afternoon. I'm Carol Master. Tim Stanovic is on assignment. Today with me is Matt Miller, co-host of Open Interest on Bloomberg TV.
Yeah, fascinating, as they are every day. Fascinating press conference out of the White House. A lot of interesting comments. You don't notice the press pushing back at all. You know, when he says stuff like there would have been a nuclear war, for sure millions of people would have died, or when he says that he opened the water and let it flow down to LA. You know, even if that's not true, nobody in the room says anything. When he says the U.S. Has given Ukraine $350 billion, even though that's
Nobody's
off
correcting.
the mark by over $200 billion, nobody asks him where he gets these figures or corrects him. So it looks like they have an entirely Republican press corps.
Well, I will say, and there's been a lot of reporting on this about what's going on in terms of who is in that press corps at this point and limitations. And we know that when there are times that we see members of the press speak out, that they are not able to continue having the access, perhaps. So this is why you read Bloomberg and you go to Bloomberg.com, because we try to debunk a lot of this stuff. A very good afternoon, everybody. As you know, Carol Master, Matt Miller here at New York headquarters of Bloomberg. We want to start, though, with some of what Matt just talked about. A lot of things were said by the president there in the Oval Office. With us on the White House lawn is Tyler Kendall. She's Bloomberg News reporter. Tyler, you know, as typical when President Trump, often in these daily press events, talks about a variety of things, day of news and just some bigger, broader topics. What was newsy, if anything, in what we just got from President Trump?
Yeah, hey, Carol. Well, one thing is President Trump says that he would love to speak with Vladimir Putin, something that we know the Kremlin would like to see as these negotiations move forward. He also confirmed that his special envoy, Steve Witkoff, is in Russia engaging directly with Putin. And this really is a consequential meeting here today at the White House as our NATO allies scramble to get to the negotiating table when it comes to Ukraine, as the U.S. continues what has been a reversal in policy by engaging directly with Russia. And importantly, the NATO Secretary General saying that NATO allies are ready to boost their defense spending, make those commitments that President Trump has been looking for. We know President Trump, for example, has called for those allies to boost defense spending to 5% of GDP, considered to be a pretty lofty goal. But just yesterday in the Oval Office, President Trump had reiterated his threat that he might pull the U.S. out of NATO if our allies don't pay their bills, as he says. But he seemed to applaud the NATO Secretary General today, saying that he does feel that allies are stepping up to the plate. That could be a significant development here, particularly as this meeting goes on, and we know something that might be discussed behind those closed doors as their private meeting starts right now is whether or not the U.S. will commit to security guarantees, considering we know that was one of those hot topic points when that now infamous Oval Office meeting devolved a few weeks ago with Ukrainian President Zelensky.
Yeah, I was going to ask about that as well, Tyler. I mean, this, I think, it could be one of those things that goes in the win column for President Trump. He's at least convinced our NATO allies to spend more money. That's been his aim since the first Munich Defense Conference when he was president in 2017. But will they actually be putting boots on the ground in Ukraine? Will they be putting weapons in the Ukrainians' hand, more weapons in the Ukrainians' hands? Is this truce going to allow for that?
Right. Well, that's the big question going forward. What are those actual tangible things that we could see come out of it? We do know that Ukraine earlier this week did agree to that U.S.-backed 30-day ceasefire in exchange for that halt on U.S. military assistance as well as intelligence being lifted. When it comes to peacekeepers on the ground, boots on the ground, that's something that our European allies have floated. They've floated a framework led by the U.K. and France to get peacekeepers on the ground, but they have suggested that the U.S., they would like the U.S. to underwrite that effort, and it's something that President Trump has refused to engage on, instead saying that he wants to see a peace deal in place before he talks about those security guarantees. That's why this keeps coming back to that economic cooperation agreement that ended up not being signed when Zelensky was here, because this White House's position has been that they would like to have a vested economic interest in the country in order to provide those implicit security guarantees instead of outright giving the money, giving the weaponry. So we'll have to see how it goes from here. But today's meeting, it appeared pretty cordial between the two of them, although of course President Trump did needle the NATO Secretary General about defense spending, but he did say that he was pleased with the commitments that he's seen so far.
All right, good stuff. Tyler, thank you so much. Really appreciate it. Tyler Kendall, Bloomberg News reporter out there on the lawn of the White House, just coming off of that meeting at the White House with the president and the NATO Secretary General. All right, everybody. Carol Massar, Tim Stanovic is off.
No, yeah. I'm wearing glasses. I'm looking a little bit nerdy, but Tim is clean shaven.
And has hair.
And he has hair, a beautiful head of hair.
It is Matt Miller, of course, one of the co-hosts of Open Interest on Bloomberg TV. Listen, we're going to get into the trade today because, Matt, while we're coming off our lows of the session, we've really seen stocks come down a bunch over the last 3 weeks.
Yeah, absolutely. I mean, it has been difficult as Wall Street strategist after strategist come in and lower forecasts. I do think it's interesting that even when you see someone like Mike Wilson at Morgan Stanley or when you see JP Morgan lowering their forecasts, they still have gains in the year end, right? But they bring it down. So Mike Wilson says, we'll go down to 5,500 in the first quarter, but we're still going to get back to 60, I think he has 6,400 at the end of the year. Or JP Morgan will go down to maybe even 5,200 in the first
rally from here.
First half, but we'll still go to 6,500. Yeah, it's still a big rally penciled in, but they're all expecting bigger and bigger drops. Now, and we've seen, a 5-6% pullback so far year to date in the S&P.
All right, folks, we're going to talk about that. We're going to talk about the inflation prints. We're going to talk about what global investors are up to. But first up, let's get you caught up on today's trade. Let's turn things over to Charlie.
All right, I thank you very much indeed. We are off the bottom, and to put those year-end calls in perspective, 55.31 where we stand right now on the S&P 500 index. Yes, another down day for the Dow. The S&P and NASDAQ now lower by 67 points on the S&P, down 1.2%. The S&P, by the way, has not notched 2 straight days of gains since its February peak. The Dow now down 498, down 1.2%. NASDAQ is down 283, down 1.6%, extending its year-to-date loss now to 10.1%. 10-year, 4.27% with a 2-year, 3.94%. Gold up $44 the ounce, a gain of 1.5%. West Texas Intermediate crude now down 1.6%, 66.58 a barrel. And Bitcoin now down 2.8%, below 81,000 at 80,800 on Bitcoin. European spirits and drinks makers are lower after President Trump threatened to retaliate with tariffs on some European alcoholic products. LVMH, whose brands include Dom Perignon, Hennessy trading lower now. ADRs down by 2.1%. And Diageo, its ADRs trading down now by 0.6%. Its brands include Johnny Walker, Bailey's, and Guinness. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. Carol Master along with Matt Miller. Hey, we did get another inflation print this morning. U.S. wholesale inflation for the month of February stagnating thanks to a sharp decline in trade margins. We wanted to get into that with our own Michael McKee, Bloomberg News International Economics and Policy Correspondent. It is our second read on U.S. inflation. So, Mike, second one. On inflation, I don't know, how do you put this together with the CPI report today? And is this kind of what the Fed is looking for?
Well, this is a little bit better in terms of the overall numbers for the Fed. However, you said the decline of the flatness was thanks to the trade numbers in there. It don't refer to international trade. It refers to the margins for wholesalers and retailers. And if their margins are going down, that's not good for profits. And Matt was talking when we were off the air about profit analysts marking down profit forecasts. So that's a little bit of bad news in there. Other than that, the parts of the PPI that get folded into the PCE, which is the Fed's inflation indicator, were stronger in most cases than anticipated. So it looks like between the CPI and the PPI that the PCE is actually going to rise this month.
This is what I think is fascinating because I've been noticing lately that you and other economists, when you get CPI and PPI, you can start to put together the PCE number. And that's what the Fed cares about, right? And last time we saw it was much weaker, but now this seems to be showing that maybe prices will firm up in the PCE?
Yes, not that much, maybe 50 basis points, not a huge rise, but what it does is tell the Fed they have more work to do, and it ratifies, if doesn't necessarily encourage them to keep rates at unchanged. Now, we know they're not going to change rates next week, but this just gives them more runway to say, we don't know what's going on in the economy, so let's just sit here, and inflation gives us the reason.
What do we need to know about the weekly jobless claims number?
Jobs claims is still a surprise that it stays so low. A lot of talk about the economy maybe slowing down, but we're not seeing any evidence in terms of layoffs. Federal initial claims went up, but not even as much as last week. So we're not getting a clean read on that yet, and it'll be a while until we do, probably because of the back and forth on whether you're fired or not if you work for the federal government. But the number you want to watch, and we'll be putting this out on Bloomberg a lot over the coming weeks, is the continuing claims for federal workers, because that'll be the adding them all up, and we'll get a better idea. We don't have any idea right now exactly how many people have been fired or let go.
Yeah, I thought it was interesting when we were talking this morning. Mike was on my television show, Bloomberg Open Interest, every day from 9 to 11. And
greatest show on.
It's the best show in the history of television. Nobody's made a better show, in fact. No,
Stop that.
We were talking about whether or not this economy really belongs to President Trump, or whether or not we're still seeing the after effects of the Biden economy. I guess that's debatable, but it seems to me that you will start to see the inflation from the trade concerns come in the next slew of reports, or that you'll start to see the effects of the federal government firings in the next slew of labor reports. Is that right?
It'll take a little while for all these numbers to get in there, especially the inflation ones that go through middlemen, like the steel and aluminum tariffs. Now, in this month's PPI, we saw prices rise a lot for steel and for aluminum. And it clearly the companies were anticipating these tariffs and raised prices ahead of it. So we may see that, but then the stuff gets used and put into other things, cars being a big example, and it'll take a while for prices to go up because of that. And
motorcycles.
People have. Or motorcycles.
I'm buying a Harley Davidson this month.
Surprise.
And yeah, they use a lot of steel.
Yeah. So yeah, you could say we'll notice it in a while. It doesn't really matter whose economy it was. It's funny, the administration's been saying this is Biden's economy, except yesterday and today when inflation was lower and they said, oh, CPI, PPI, this is Trump's economy. But It's the voters who make the decision.
Really quickly, 20 seconds. Do the tariffs have to roll back in order for there to be a strong U.S. economy later this year? With the Commerce Secretary, Howard Lutnick, seemed to say to Bloomberg Surveillance this morning, do we have to see the tariffs roll back, though, in order to get there?
I would guess so, but we don't know what the tariffs are going to be yet. Exactly. So it's hard to make a definitive prediction.
All right, good stuff. Mike, thank you so much. Bloomberg News International Economics and Policy Correspondent, Michael McKee. All right, we want to get to the Everything Risk newsletter because Bloomberg Ed Harrison writes American exceptionalism is probably dead. He is not talking about tech innovation and the like. Nope, something much simpler and yet pretty powerful. We're talking about earnings growth. Ed is Bloomberg News senior editor, and he's with us from Washington, D.C. So, Ed, walk us through what you're thinking about, because it does feel like for months, certainly coming into the new year, everybody was talking about American exceptionalism. You know, investors were going to continue to put money here because it made more sense versus everything else. But right now we see European markets certainly outpacing what we're seeing in the U.S.
Yes, Carol, definitely. I think that the secret weapon to the U.S.'s exceptionalism was deficits, if you will, government deficits, that they've been much larger than they have been in other countries, particularly during the pandemic, and that has fed directly into corporate profits. What we've seen now is a concerted effort from the Trump administration, especially with Scott Bessent, who's the Secretary of Treasury, to say this economic model doesn't work. We don't want this economic model. We want to move away from government-led growth, and we're going to actually reduce the deficit as much as to 3%. And at the same time that that's happening, we see in Europe a completely different story where they had been, very fiscally prudent, and now they see a need to introduce massive stimulus for defense spending and infrastructure in particular, in part because of the global changes that we've seen as a result of the Trump administration's coming into being.
It's important to clarify what you mean by American exceptionalism, because and I was getting a lot of messages on my television program this morning from viewers who were angry about the idea that we would even say American exceptionalism is probably dead. You're not talking about, the entrepreneurial spirit or even the American dream, are you?
No, not at all. The things that make America great, which has driven the Magnificent Seven to be profit engines that has attracted capital from all over the world, aren't going to go away. What is going to go away is the ability for the United States to deliver, earnings growth that completely outpaces those of other markets, and as a result drives the stock market. For instance, if you take a look at the DAX versus the S&P 500, they pretty much traded in line from 2008, 2009 to 2018. At around 2018, there was a complete divergence to the point where we've massively outperformed in the S&P over the DAX. But that's been completely reversed this year, particularly from mid-February when the tariffs came into play and people started to realize that this paradigm that Scott Bessent is talking about will involve some pain. I think that those are the words that Bessent and also President Trump have used, that there's going to be an adjustment period, and that means lower growth, and it also means lower profits as well.
And yet, the Commerce Secretary this morning telling Bloomberg Surveillance, when they was trying to distinguish what was the Biden economy, what's the Trump economy, he said, the president is going to dig us out, build this up, and by the fourth quarter, you're going to see growth rates because you've got all these companies committing to build in America. So could the narrative shift back once again in terms of American dominance?
Well, that's the gambit. Now, I mean, in terms of the gambit, let's call this the largest experiment that we've ever seen in terms of the economic model, especially because of the tariffs. I mean, we're talking about a step change in tariffs that we've never seen in like 70 or 80 years.
Smoot Hawley.
So the gambit is that we're going to go through some pain. It's going to be a growth recession, and then by the end of this year, the beginning of next year, in enough time to be able to tout it for the midterms, the American economy will be back on its feet. But we don't really know what the answer is going to be. We don't know, how much this is actually going to dampen growth in the near term. We don't know how much it's going to increase inflation as well. So there are a lot of variables, and it's really a big experiment. But in the meantime, the Europeans are going to be taking advantage of that experiment, and you're going to see a lot of capital going to Europe. And I think that that outperformance that we've seen at the beginning of the year is going to last for some time.
Ed, we love having you here. I love to read your stories, and you studied economics at Dartmouth and then went on to get your master's at Columbia. So you're Ivy League educated economist and business scholar. We hear so much about the tax cuts that we're going to get, but really an extension of the TCJA, which isn't locked in, isn't a tax cut from here, is it?
No, like if you look at, we're talking about something in the order of $4 trillion over the next 10 years in terms of the differential. That is in the order of some of the largest tax differentials that we could see in the recent past, meaning that if the TCJA does not get extended, then you're going to see an incremental $4 trillion of revenue to the government. That's a decrease of the deficit, which incongruously to a certain degree, the Trump administration doesn't want to see happen. So how they thread the needle with the TCJA is very important to understand. Whether or not we're actually going to get a recession as a result of this big experiment in terms of the tariffs and the economic policy.
Yeah, it's pretty wild to see like a liquidity shift, out of the United States. You wonder how big it will be, how long it will last, and what ultimately will be the impact. Hey, Ed, thank you so much.
And let me just say one last thing, Carol, and that is that I think that it's the sequencing that has a lot of people worried on Wall Street and also in businesses. That is, the sequencing has been all about the anti-growth stuff first, before you actually get any tax cuts, which is the exact opposite of what we saw in Trump 1.
Yeah, we keep talking about that, right? And we don't know exactly how this movie ends in terms of, because reversed
Did you
from
see
what we
Odd
saw.
Lots today?
I did not.
So everything seems to be reversed. In Trump 1, the markets puked, and then they did okay when he actually came into office. Whereas now the markets rallied hard, and they're coughing it all up as he sits in the Oval Office every day.
Which is why when everybody says same playbook, I'm like, it's not the same playbook. Ed Harrison, thank you so much. Bloomberg News senior editor. Hey, we're going to stay on today's evolving investment environment, where the opportunities may come from, where the liquidity shifts may be, and that takes us to Russia. There are signs that investors are quietly betting that President Trump's overtures to Moscow for a deal to end the war in Ukraine will eventually translate into Russia's return to the global financial markets. It's a bet, could pay off, may not pay off, and yet already it's a bet some global investors are willing to make. This is a story that is actually today's Bloomberg Big Take. It means that our editorial team has deemed it a must-read. So let's get to it. We head to London and to Bloomberg News team leader for Russian economics and government, Tony Halpin. So Tony, first of all, get into the transactions that have come to light to Bloomberg and that Bloomberg is revealing for the first time.
Yes. Well, it's things like Russian debt was previously untouchable a few years ago. People searching for owners of dollar-denominated bonds issued by the energy giant Gazprom, for example, which are in demand from Middle Eastern family offices, or other people looking for a way to get into the ruble play that previously clearly has been very difficult because the Russian market's been so sanctioned. Russian bonds are particularly in demand, and the demand has been so high that it's pushed down yields something like 5 percentage points in February alone. So there seems to be a great deal of interest from clients. Money managers are reporting approaches from Wall Street sales teams looking to, as I say, make bets on the ruble through something called non-deliverable forwards, which are derivatives that don't involve a physical Russian asset or an individual person who might be subject to sanctions. And there's a good reason for that. The currency's up 13% against the dollar this year alone. So there's a lot of interest in these deeply discounted securities. And the bet is, as you said, that sanctions may be lifted if a peace deal is reached, and the discounts on these securities will evaporate.
What is the likelihood of, Russia being invited back into the fold? That does seem like it is a priority for the Trump administration.
Yes, it is. We learn practically every day different aspects of the way Russia and the US seem to be interested in working together on anything from Arctic exploration to developing new trade routes to a story we've just moved today, in fact, that the US and Gazprom may be exploring ways to work together, which would certainly be a striking departure from past policy. So there seems a great appetite in this Trump administration to find ways to work with Russia. And one of the reasons for that is because they're very keen in a kind of geopolitical sense to draw Russia away from China, to sort of reduce its dependence, which has only grown during this war, on China's economy and on China's diplomatic support, as a way to bolster U.S. policy in regard to China itself.
I mean, that sounds like Angela Merkel's plan, which didn't seem to work out very well for Germany, did it, Tony?
Yeah, that's right. And you know, one has to remember that Russia and China have really been deepening their ties in the last 3 years. Russia's become very dependent on China for economic support to help weaken Western sanctions and for political and diplomatic backup in places like the United Nations. And these are two neighboring countries. They're big, interested countries in each other's well-being. So it's not clear that the U.S., whatever it offers, could actually separate them.
I guess the thing that kind of always sits out there for me is that you've got to make sure that Vladimir Putin at some point doesn't say, go back for war. Like, we haven't even gotten, you know, Russia-Ukraine resolved at this point. And
but you don't trust him? You don't think he's trustworthy?
The devil's in the details, right? And so how do we get, what kind of guarantees? I mean, and could you even trust a guarantee from President Putin that I'm never going to kind of look to expand my territory again? He's done it twice already, right?
Yes. I mean, this is the giant geopolitical gamble that lays behind this interest from traders, right? It's the assumption that the Trump administration can succeed in producing a deal that ends the war between Russia and Ukraine, and then that deal sticks, right? And that sanctions are lifted and people can go back to making money and doing business. But the real risk there, clearly, is that a deal that gets done isn't stable. It might break down within a matter of weeks or months. Sanctions might be restored. War might resume. And then traders and investors find themselves in a very difficult position of having committed to Russia and finding themselves stuck in a country that's back at war.
Trust but verify. For those people of a certain age, that was a Russian proverb made popular by Ronald Reagan. In terms of Europe's concerns, Tony, are there any being voiced? I mean, as the Trump administration moves ever closer to the Kremlin, are you hearing concerns from Downing Street? Are you hearing concerns from Berlin? Are you hearing concerns from Paris?
Oh, no doubt. I mean, it's fair to say that Europe's been deeply shaken by this rapprochement between the US and Russia and where it may go. They very much lined up behind Ukraine in this war as the victim of this war. After all, it was Russia that started it and invaded. And what they see is a coming together of Trump and Putin to sort of produce and promote their joint interests. And that's leaving Europe on the sidelines to watch all this. And they're afraid that in any peace deal that may emerge, they may be left with the bill in terms of peacekeeping, in terms of monitoring, and they worry greatly that if it all breaks down, they may be left as the ones to try and piece it back together again. So there's a great deal of concern, I think, in Europe that the two sides, Trump and Putin, are talking to each other, leaving Europe and in some ways leaving Ukraine on the sidelines, and they're trying very hard to get in on that conversation and to influence it.
But I'm just wondering then, do we see any really big name investors trying to get in on this trade? Or do they, you know...
all the emerging market investors who I feel like you go back 20, 30 years. I was thinking about Jim Rogers, you know, the biker investor who like rode around in the commodity. I mean, we just constantly...
And he had also some, you know, sketchy collections at his house. Are there any, family names, household names, Tony, that are willing to make this bet? Or is it only... you know, the Jim Beelan, Rogers, and then emerging markets investors of the world?
Is it still an emerging market, really, right, with a lot of risk?
Yeah, no, I mean, we've learned from sources as part of this big take that companies like Goldman Sachs, JP Morgan Chase are among banks that have been acting as brokers to facilitate some of this growing investor demand. So, these are enormous names in the world of finance. So it's clearly the case that there's a growing interest in Russia. And there's one simple reason. There are hundreds of billions of dollars of potential trade and investment at stake here, right? And if they can get back into the Russian market and it proves a bet that's sustainable, then people see an opportunity to make a lot of money, regardless of whether they take a position on the war itself.
Yeah, right. A few steps to be taken, though, and, remove all the sanctions and make sure that the president doesn't impose any additional new sanctions. Tony, great story, great read, and so glad we could get some time with you. Tony Halpin, he's team leader for Russia economy and government at Bloomberg News, joining us from London. All right, let's get back to the markets. An update on the trade. We've seen a fair amount of selling once again, but we have bounced off our lows of the session. Let's head things over to Charlie Powell.
All right, I thank you very much, Carol and Matt. Here's what's going on with the Dow, the S&P, NASDAQ, all lower. Volatility surging across asset classes. The index close to that 10% correction, sparking demand for havens in treasuries. The S&P now at 55.46, down another 52 points today, down by about 1%. We've got the Dow down 417, down 1%. NASDAQ right now down 236, down by 1.3%. Key takeaway at this hour, we are off session lows. The 10-year is yielding 4.27%. The 2-year, 3.94%. Gold is up 1.6%, $29.81 the ounce on the precious metal, while West Texas Intermediate crude down 1.7%, $66.54 on WTI. Earnings news, Dollar General has forecast sales to grow this year in a range with the top end higher than what Wall Street was expecting. The retailer up now by 3.9%. Dollar General 77.83, rival Dollar Tree down by 3.7%, and both are losing market share to Walmart. Walmart shares right now, we've got Walmart trading a little, actually down 0.5%. Again, recapping, S&P down 1% for on-demand news 24 hours a day. Subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, President Trump's trade war chaos has led to growing calls to lock in profits, sit on the sidelines, replacing the buy the dip mentality that dominated Wall Street for decades. And despite some attempts to snap up discounted stocks, S&P 500 hasn't notched 2 consecutive days of gains since its February peak, and market watchers say they do not see signs of a meaningful rebound rally yet, which can definitely make it tricky for someone who has more than $1 billion in assets under management, which is the case of our next guest. Let's head to Scottsdale, Arizona, and to Brian Vendig, Chief Investment Officer at MJP Wealth Advisors. As we mentioned, they have exactly or around $1.2 billion in assets under management. Brian, good to have you here. S&P continuing to flirt around correction territory. Curious about your clients. Have they been reaching out over the last couple of weeks as stocks have sold off?
Hey, Carol, great to speak with you again. Yes, I mean, the outreach from clients has been intense, and I think that intensity has picked up over the last couple of weeks. And look, at the end of the day, from an investor's point of view, not having that certainty to know how the extent of these policy decisions might go on varying degrees here, plus hearing that economists are talking about stagflation, recession concerns, and couple that with outlooks changing for S&P 500 growth this year and revisions to U.S. GDP, Carol, people need guidance. People need clarity to know what is the extent of this correction. And I will just say that the setup was there for some volatility going into this year as well. This is not necessarily all just policy driven. I think there's some fundamental valuation concerns about different parts of the market, because when you look under the hood, you see that there is a rotation going on between growth and value. And I think that has a lot to do with how much investors want to pay for growth right now.
Well, and the tech earnings may not be exactly what we expected. It's not unusual, right? I was looking at the Qs last year, and we had a summer swoon that was, I think, a discount of 13 or 14% in July to August on the NASDAQ 100. But the concern is you don't get the 14% growth everyone was expecting this year, because you just don't have to pay as much to make a DeepSeek AI model work.
No, that's fair, Matt. I mean, I think when you look at the quality of earnings over the last couple of years, I mean, the outlooks for this year was that tech would grow about somewhere between 16 to 20% on average, and you'd get a bigger push from earnings coming from areas outside of tech, which we've talked about with our clients and our investors and still believe that that's going to be one of the main themes over the balance of the year. But I think to your point, the reaction of DeepSeek, I think was a little bit of a knee-jerk because as innovation normally happens, price and cost does go down, but then that improves productivity and a wider adoption. So for our clients, we are cautious in this environment for sure because we're lowering our expectations of growth because of the uncertainty around policy. But I also still see that there are opportunities in tech when you think about the expansion and adoption through software. And maybe it's not so much of that hardware conversation that you're implying, Matt.
So, all right, first of all, where do you see those opportunities? And is it enough to make up for a drop in the massive hardware gains? I mean, if you look at the $3 trillion companies, you know, Apple and NVIDIA, you know, if those lose their mojo, can we make it back with Microsoft or, you know, more of a software play?
Well, I think this correction and this reevaluation of earnings multiples going forward, it's really a case-by-case basis. I think you're seeing more of active management, you know, helping us for portfolios and making those choices between company names and growth versus value. Like, let me give you an example. I mean, Apple for recently pulling back because it's delaying a launch of an AI innovation tool that surprised investors. That's a different story than possibly what we're going to hear next week from NVIDIA regarding the adoption and the ramping up of Blackwell and the next version of Blackwell, which might be even more efficient to implement from a server perspective and what the adoption rate might be in their ecosystem going forward. So I think it's a case by case and looking at things on a forward PE perspective, NVIDIA looks a lot more attractive now, obviously, than it did at the beginning of the year. I think the opportunities still exist in those aspects of that AI innovation trend because it's still going to play out over the next 5 years, but you just got to be patient. It's not going to happen all in 1 year. And on the value side, we still like those names that can participate in growth moving forward, healthcare, industrials, some elements of financials. But you got to be cautious that the economic environment is changing in the short term because the administration is looking to decouple the United States in some aspects of the global economy. So you have to be sensitive to small caps right now. You have to be sensitive to some of these companies that will get caught up in the tariff conversations like autos and others where there is a lot of this cross-border exchange issues that companies pay for. And that's the part that I think investors don't realize with some of these conversations is that it's not that this extra tariff money is going to go back to the government. It's actually being absorbed by companies. And companies now are making a decision on how they're going to try to protect margins. And then, of course, the concern is how does that play out to consumers? So we're cautious in this environment, Matt, but we're also not giving up on the U.S. capital market system.
Yeah, I'm looking at the Russell down about 10% so far this year. Hey, Brian, just got about 30 seconds here. We talked earlier with our Ed Harrison about money moving from the U.S. to Europe. We've seen the European markets outperform easily by a wide margin. U.S. stocks as measured by the S&P 500. Are you moving money outside the U.S. for your clients, Europe or elsewhere? Just quickly.
Yeah, sure. I mean, we have an exposure to international in most of our portfolios, and we are evaluating adding to that because it seems like the investment in countries right now are being bolstered when you think about what's coming out of China and Europe being less reliant on the U.S. and looking to invest more domestically. I think we want to get through the next couple of weeks on the tariff conversations and where these policy decisions are going to go in the beginning of April and getting a little bit more there. But I think there is an opportunity that international equities could be a good spot for your portfolio and also comes with a more attractive PA.
All right, good stuff. Hey, Brian, thanks so much. Good to see you again and talk with you again. Brian Vendig, Chief Investment Officer at MJP Wealth Advisors, joining us from Scottsdale, Arizona. All right, from Arizona and New York to Canada we go. Underway in Canada, the 2025 G7 Summit of Foreign Ministers. Talk about an agenda, especially considering the global backdrop. It is a full plate. Let's head to the meeting and Charlevoix, Canada. That's where we find Bloomberg News correspondent David Gore. David, great to be checking in with you. I got to ask you first, are you feeling any hostility as an American in Canada? We know we've seen at hockey games that The anthem, the American anthem, has been booed. I'm just curious on the ground how it feels.
I am not. There was one lone protester here at the entrance to this hotel, just about 2 hours north of Quebec City. But no, I personally have not felt any yet, Carol, or any at all. Although, of course, as you say, we have seen it kind of manifest itself in these recent weeks, and you bring up the fact that there is a busy agenda, a busy official agenda here at this G7 meeting of foreign ministers. There's also kind of the unofficial agenda provided by the backdrop of what's happened here. And so you have these foreign ministers, foreign secretaries, secretaries of state gathered here who are really trying to reckon with the fact that the global landscape as they knew it has changed so much here over the last 6 or 7 weeks. And so you look at the official agenda, there are meetings about China, for instance, meetings about the global south. The backdrop, the unofficial agenda, has to do with trade and kind of the structural integrity of this alliance, which has been around for such a long time now. The role that the U.S. has played as a close partner of many of these nations is now radically different. And so people within the building behind me are trying to figure out how they carry forward with that as they pay attention to, of course, Carol and Matt, what's been happening both in Saudi Arabia and Moscow when it comes to prospects of a peace deal in Ukraine.
I thought it was interesting. Howard Lutnick was on Bloomberg Surveillance this morning, and he said that Canada's military only has 60 planes. And his broader point was that we pay for their defense, or we provide their defense. Is there any message out of this, I guess, not new government, but new leader, that they're going to step up their defense spending and really build up their military?
I think we'll see in the coming days and weeks sort of how robust a plan we get for that going forward here. But defense is something that I think is top of mind, not only for Canada, a participant in this event, but the European Union as well. And a little bit later, I'm going to speak to their chief diplomat about what's been going on the European continent. Of course, everyone here watching very closely what's been transpiring in the German parliament when it comes to funding increases in defense spending. And, there's been floated around over these last couple of weeks the prospects of maybe creating a European army. Those who oppose that indicate that, NATO is that effectively. It's been built for defense. But I think what this has caused these last few weeks is a great degree of introspection on the part of all of these allies, all members of the G7, about how strong that sense of defense is, what they might need to do going forward here, Matt. And Canada, of course, is a part of that conversation.
Yeah, I am curious too, David, when all is said and done, is there a missive? Is there some kind of platform that they put forward? What comes at the end of this?
So that is the basic thing that comes out of meetings like this, the so-called communique. And so over the course of the meetings that are taking place today, all the participants are haggling over what that might be, what the language might be. And Bloomberg News is getting the sense here that there's likely not to be one. And it wouldn't be the first time that's the case, but there is fundamental disagreement about language in that communique when it comes to how Russia is characterized, for instance, how prospects for change in the Middle East are characterized. And I should say, I'm standing here on the site of where the G7 Leaders Summit was a few years ago when Donald Trump was president the first time back in 2018. And it was an incredibly dramatic moment when he flew here and in a fit of pique kind of ripped up that communique and left that meeting early. So that moment isn't lost on any of the foreign ministers who are participating in that today. And I think what they're trying to figure out over the course of these meetings is, what's the quality of the dialogue that they're having with the Secretary of State, with Marco Rubio, and how much does what he's saying jive with what the president thinks and what he intends to do. And of course, we all know that he has many advisors. Matt, just a moment ago, bringing up Howard Lutnick, who will say one thing and the president will do something different. So there's an awareness this time around in this second term that they have to be careful as they listen to what this president says versus what his diplomats, what his advisors and cabinet members say.
Dave, just got about 30 seconds, but it was surprising to me when Doug Ford backed down within hours of Trump putting up those aggressive tariffs. Is that what we're going to see, you think, from other leaders as well? Are they going to, turn tail and run when Donald Trump comes with a big 50% tariff?
I'm not sure that'll be universal, but there was kind of resoluteness to what we've heard from a lot of the European leaders in particular here at the event so far. That moment with Ford, what was so fascinating. I'm also thinking back on the interview that you brought up this morning on Surveillance with Howard Lutnick, in which he said that if the president is made unhappy, he's going to react in an unhappy way. And I think that's what we're seeing sort of play out, certainly today, and as we've seen over these last few weeks. As these retaliatory tariffs are put in place, he kind of reacts in kind. Of course, it goes both ways. And so we'll see sort of how all of that shakes out. But I'll say, broadly speaking, with the exception of what we saw with Doug Ford, it seems like there's a message of resoluteness coming from a lot of the allies who are gathered here.
All right, David Gora, thank you so much. Look forward to your reporting. That's going to do it for this hour of Bloomberg Business Week. The close coming your way on TV.
CBS News on the Hour, sponsored by O'Reilly Auto Parts.
I'm Cammie McCormick. A federal judge has just ruled the Trump administration must offer reinstatement to the probationary workers who were fired across multiple federal agencies. He said the firings didn't follow federal law. Rehiring those workers, though, will be a problem, as Jake Rosen reports.
That offer is obviously complicated because a lot of these people have turned in their government devices. There are no offices for a lot of these people to go to, especially in the case of some of these groups who have had their offices shut down or who were told to not go to work.
President Trump's envoy is in Moscow for meetings on the Ukraine ceasefire deal. Russian President Putin said today he has serious questions about it. President Trump said he's ready to discuss.
We have to get this war over with, and we'll be back to a normal, much more normal life. And maybe we're close. We're getting words that things are going okay in Russia, and it doesn't mean anything until we hear what the final outcome is.
There have been nearly 100 arrests outside Trump Tower in New York as Jewish protesters demand the release of a pro-Palestinian activist who led demonstrations at Columbia University. Stacey Lynn reports.
They're demanding the release of Mahmoud Khalil, the Palestinian activist detained by ICE over the weekend despite having a green card. Hundreds of demonstrators from Jewish Voice for Peace packed the building's lobby, chanting while holding signs that read, "Free Mahmoud, Free Palestine, Fight Nazis, not students, and you can't deport a movement." Khalil's being held in Louisiana. The government just formalized its request for a change of venue. Stacey Lynn, CBS News.
There is an impasse over a Republican spending plan as a shutdown looms. Senate Majority Leader John Thune.
I'm not sure how long the Democrat leader thinks we should drag out the funding process for fiscal year 2025. Until fiscal year 2026, beyond.
But Caitlin Huey-Burns reports for the Democrats it's complicated.
Something that is really fueling some Democrats right now is that their base of support is very angry that they don't have much leverage for legislating at all in this Trump era. So do they try to use this as a point to get some of what they want?
President Trump threatened more tariffs today, this time on wine and champagne from France and other EU countries. In the meantime, Canadian officials are in the U.S. for talks on tamping down the trade war. Kelly O'Grady of Money Watch.
If there is an agreement to be made and they come out of this happier and potentially with a better trade relationship, that could set the tone for negotiations that the president could have with other countries like the EU.
This is CBS News. The former pastor of a Texas megachurch has been indicted in Oklahoma on child sexual abuse charges. More from CBS's Steve Kathan.
63-year-old Robert Morris is accused of 4 years of abuse that began in 1982 when the child was 12. Morris was a traveling evangelist at the time who stayed with her family. There's been no comment from Morris on the case. The Gateway Church, based in the Dallas suburb of Southlake, was founded by Morris 25 years ago. He resigned last year. The church said in a statement that its members are praying for the accuser and all those impacted by what it calls a terrible situation. Steve Kathan, CBS News.
Former movie mogul Harvey Weinstein's retrial is next month, nearly a year after New York's highest court overturned his 2020 conviction on rape and sexual assault. Weinstein is now 72 and expected in court next week for rulings on how the trial will proceed. I'm Cammie McCormick, CBS News.
This is Bloomberg Business Week. Insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Massar and Tim Stenovec on Bloomberg Radio.
All right, everybody, we're just about 55 minutes away from the closing bell on this Thursday. Carol Massar, Tim Stenovec is on assignment, and with me is Matt Miller, co-host.
I wish Tim was here.
Wait, what is that show called?
Yeah, so I anchor Bloomberg's most watched television show. It's every day from 9 a.m. to 11 a.m. It's called Open Interest with Katie Greifeld and Shonali Bassick.
Most watched?
But I listen to this show.
I'm told that this is the most watched
I listen to this
TV
show
hour.
In terms of I listen to the show every day, and I miss Tim when he's not here, even when I'm in for him.
I know. He's like such a gem. We are so lucky that he's here. Well, you know, maybe one day we could do the three of us.
Yeah.
Like, that could be fun.
I'm not sure if that would be allowed by the universe.
I don't know either. Well, we'll have to ask the universe. Hey, folks, we got stocks coming off their lows of the session, but we're down across the board. We've got every major industry group. Matt, there are 11.
Yep.
They're down today.
Yeah, SPX, L1, Index, GRR is the best way to look at that.
Yeah.
It has been an absolute clobbering of these equity indexes. I will say I saw a very cool chart on the Bloomberg terminal today. You can type it yourself or look at it yourself if you have a terminal in front of you. It is #BTV3116. I had put it in the chat, so you could just click it.
Oh, sorry.
It just shows you that NASDAQ 100 has had a few points, 3 to be exact, in the last couple of years where trading volume on the Qs has gone over 75 million. And each time that's marked the bottom and the market has turned around from there, we're right there right now. So if you're a bottom fisher, if you're looking for a place to start catching falling knives, this could be it, just going by that one indicator.
That's pretty interesting. I'm looking at the QQQ. I mean, definitely oversold.
Yeah, it's definitely oversold on the RSI.
Relative Strength Index, right? Yeah, you look at it, right?
And you've seen the valuations come down. We've seen a correction now of more than 10% on the NASDAQ, just about that on the S&P 500. And as I said, we saw this last year in the summer as well. The S&P was down almost 9% in July, and the NASDAQ 100 was down almost 14%. So it's not unprecedented to have a correction.
I think it all determines, right, whether or not these tariffs, how long they stick around. Do we get more tariffs layered on? And then what do we get in terms of tax policy and other regulatory that maybe opens up things?
That's
all right. We got to stop talking because we got to get to Charlie Pellet. We are going to talk crypto, though. We're going to do that with the co-CEO of Republic. He was at that crypto summit at the White House last week. We're going to get into munis. We're also going to get into President Trump's no tax on tips. Do not say anything yet because I know you'll have a lot to say on that.
Well, dude, we're going to talk to Ian King.
And we're going to talk to Ian King.
This is a guy that I want on my show every day, and I was just complaining to the head of global television, like, I can't get Ian King. How do I cover Intel if I can't get Ian King on my show? But you are lucky enough to have him on this program.
We love Ian. All right, we're going to get to him in just a moment. First up, though, let's toss things over to Charlie Pellet for a check on the trade. Hey, Charlie.
Well, hello there, and here's what's going on. We got Intel shares surging now by 14.6% ahead of Ian King. The Qs, you touched on that ETF. Right now, we've got the Qs down 1.5%, extending the year-to-date loss now to 8.1%. The Dow, the S&P, NASDAQ, all in the red. We've got 52 minutes to go ahead of the close. The S&P 500 has not notched 2 straight days of gains since its February peak. Right now, we've got the S&P down another 1.2%, down 68 points. The Dow lower by 484, down 1.2%. NASDAQ lower now by 1.6%. The 10-year, 4.27%, with the 2-year, 3.94%. Gold up 1.6%, 29.82 the ounce. Bitcoin right now trading lower by 2.9%, 80,690. And West Texas Intermediate crude down 1.7%. WTI now trading at 66.52 a barrel. So again, recapping here, the Dow, the S&P, NASDAQ, they are all lower. S&P down 1.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thanks so much. Got to talk about Intel jumping the most, and I think more than 5 years. I got to check my numbers. Right now, it's up about 14%, was up almost 19% at its highs today. Company naming Lip-Bu Tan as its next chief executive officer and trusting a former board member and semiconductor veteran with one of the toughest jobs, safe to say, in the chip industry. with what you need to know. Back with us is Bloomberg News U.S. semiconductor and networking reporter Ian King. He's out there in our San Francisco bureau. I'm guessing you've had a pretty busy 24 hours or so. Ian, who is Lip Bhutan?
Yeah, Lip Bhutan is obviously, as you said, an industry veteran. He's kind of 65 years old, got into the industry really as a sort of venture capitalist, then migrated to become the CEO of an electronic design company called Cadence, arguably rescued that company from a difficult situation and built his career there. I think the defining characteristic, according to everybody we're speaking to, is that he's renowned as somebody who has the biggest network, all of the contacts, knows everybody, knows every company, knows what's going on in the industry, and they're hoping that that will be of use to Intel.
In a sense, I was thinking this morning, he's kind of like the Kamala Harris of Intel.
Wait a minute.
So,
I'm not sure what you mean.
Tell me if I'm wrong, but it seems like he plans on keeping pretty much the same strategy as Pat Gelsinger. Is he going to do something different that we know of, or do you think he has maybe an ace up his sleeve?
Yeah, I mean, that's a very good question. So to address that directly, we don't know yet. I mean, from what was publicly put out there yesterday was, as you just indicated, very much, well, you know, we're going to stay the course here. But I think, and you're seeing that reaction in the market today, a lot of investors would quite like to see some value realized from this asset in the form of splitting it up. Maybe, you know, as we know, his predecessor, Pat Gelsinger, was virulently opposed to that idea. Maybe he isn't. So that's one of the plays that's going on here. And also, perhaps a more realistic, maybe he uses this great contacts network that he's got to bring in some of those outside customers that Intel needs. I mean, these are all of the things that are going on in people's minds right now, but to your point, we don't know yet. We're going to see him face direct questions once he gets his kind of feet under the table next week.
Well, that's what I was going to also wonder, or I wondered, Ian, because he has such great contacts across the industry, does he help facilitate some deals? I know that we've seen Intel move higher on maybe some kind of deal with his foundry. We've seen headlines about TSMC pitching Intel Foundry as a joint venture to NVIDIA and Broadcom. That was a Reuters story. But like, you've been focusing on this too, about, you know, kind of what iteration of Intel going forward, and is he the guy to kind of get it done and get it done well?
Yeah, I mean, again, I think you're going to the heart of the matter here. If Intel is to stay the course, it needs outside customers. It needs orders from NVIDIA, from Apple, from AMD, from everybody else. So you need somebody who knows how to talk to them and persuade them that Intel is no longer the big bad wolf, that it's here to help you and you should use its factories. That would help Intel to become what it wants to become, what it says it should be. On the flip side of it, if you're going to split Intel up, it's an enormously important and complex set of dependencies, set of requirements, whether it's government, whether it's customers. So there's a lot going to have to go into a deal if it's going to be split up, whether it's for the product side or whether it's for the factory side. That would require somebody who knows how to pull on these various threads and dance through the various corridors of power and boardrooms to make this happen. So maybe that's who he is as well. So could work either way, but Intel certainly has a lot of work to do ahead of it.
You know, my biggest worry is the great state of Ohio here. Intel was going to invest, I think, $30 billion in a new fab right in between Granville and Columbus. So many businesses and consumers there had been preparing for the big windfall that would be. Are they still going to be able to do that? Is it dependent on billions of dollars from the federal government? Is Trump going to put an end to that with the sort of cancellation of the CHIPS Act?
Yeah, so what Intel have said is, look, we'll build it when it makes sense, and it doesn't make sense right now. Okay, we don't need the capacity, we're not going to build it. So in theory, if they do get some of these orders from outside companies, if they do realize, you know, some engagements, they do get better products out there, they have more demand, then it makes sense to build Ohio. The project could come back online. And as you know from the CHIPS Act, as it stands, is basically an achievement-based system where you do a certain thing, you get a certain amount of money, you move on to the next stage and you get the money for that. So it all could come back together. But the chip industry is littered in history with what are called shells. the plants built, but no equipment in them. Without the equipment, they're meaningless. Companies throughout history have built these things thinking maybe I'll need this as kind of an option, and then it never comes to pass, and that could be Ohio's fate.
Hey, Ian.
That's horrible, Carol.
I know. I'm sorry for that. Well, right.
Poor Buckeyes.
I know, right. And the expectations of what that would do, certainly for local economies. Hey, Ian, there's naming a CEO, and then there's making sure that you've got kind of the key senior people in place for wherever the company's going. Do you anticipate that he's going to be bringing in other people? Does he need to change some teams around, or is it enough just to have the CEO with maybe be a different background and just kind of taking the company on his own forward?
There was a sense under his predecessor, Pat Gelsinger, that things got shaken up at the top. There were a lot of comings and goings of executives, and there was also the same thing under their predecessor, Brian Krzanich and Bob Swan. So it's hard. Intel used to be a company that grew its own and had a very clear succession plan, and everything would filter up. Now, we're really not sure whether it's internal folks that are the answer or whether they need talent from outside.
Yeah.
Going to be hard to do that, though.
So how much time does Intel have, or how much time does Tan have? In other words, how much time do investors give him to kind of figure this out?
Again, I think the very important question, the doom and gloom talk is, Intel's finished, oh dear, it's gonna fade away. It's still a very big company.
Right.
If they cut back on the spending, if they cut back on a plan to return to being what they were, it's a profitable company. It's a smaller company. It's not the Intel that it used to be, but it's a viable company. So there are a lot of decisions to be made here. If they still go for it, it doesn't have a lot of time, right? Because the numbers don't add up. If they retrench, if they are less ambitious, there's no time limit.
Yeah.
Intel's a $102 billion company right now.
Yeah, $50 billion in revenue, right?
NVIDIA's $2,850 billion company. There's a big discrepancy there, right? And by the way, the estimated PE for NVIDIA is 25. The estimated PE for Intel is 50.
Ian, got about 20 seconds. Any thoughts?
Yeah, you're absolutely right. I mean, the numbers do not lie. There's been a massive transfer of wealth, not only in the stock market, but reflecting where the industry has gone, away from Intel into NVIDIA. And unless Intel can do something about that, then the numbers are still going to be ugly.
All right, Ian, thanks so much. We know it's been a busy week for you, so appreciate getting some time and getting you to weigh in it. We actually, Tim and I read Ian's story as soon as it hit the terminal yesterday because we wanted to make sure we shared it with everybody. Ian King, U.S. Semiconductor Networking Reporter at Bloomberg News. As we said, shares of Intel, man, they are just soaring in today's session. I think it's the top gainer in the S&P and the NASDAQ.
Biggest gain since February.
Yeah, huge.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. We've got 39 minutes to go ahead of the closing bell with the Dow, the S&P, NASDAQ off session lows, but still very much in the red. 3-week drawdown in stocks resumed today in force. Right to the numbers. The S&P currently at 55.33. That is a drop of 1.2%. That index down 65 points now. The Dow off by 469, down 1.1%. NASDAQ down 283. For NASDAQ, a decline of 1.6%. 10 years yielding 4.27% with a 2-year 3.94%. Gold up $48 the ounce, $29.82, up 1.6%. And West Texas Intermediate crude right now down 1.6%, $66.59 a barrel. As for the market backdrop, Tracy McMillian is head of Global Asset Allocation Strategy at Wells Fargo Bank. She is recommending using weakness in the market to pick up mid-cap stocks.
Once we get past some of the tariff negotiations, that CEO confidence will be revived. That could lead to additional mergers and acquisitions. That could benefit mid-caps. And we also see that mid-caps are almost as high quality as large caps, but often they get lumped in with small caps, which are much lower quality.
Tracy McMillian of Wells Fargo Bank. Speaking of M&A, drug makers Mallinckrodt Pharmaceuticals and Endo plan to merge and create a $6.7 billion company. Shares of Endo, NDOI on the ticker, down now by 10.3%. After the bell, we'll be hearing from DocuSign ahead of earnings. DocuSign now down by 5.9%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, everybody, you might recall last week we did see a visit to the White House by executives in the crypto industry following President Trump's executive order creating a strategic Bitcoin reserve and a national stockpile of other tokens. Our next guest was at the White House Digital Assets Summit last week. Joining us is Andrew Durgee. He's co-CEO of Republic. It's a private investing platform for crypto, for startups, gaming, and real estate. Valor Equity, Galaxy Interactive, and Morgan Stanley are among its backers. Andrew joining us from Florida. Hey, Andrew, good to have you here with Matt and myself. Hey, take us to that meeting last week, kind of how it all went down.
Yeah, it really was a special experience overall. For 15 years that I've been in this space, every day has been nothing but headwinds, particularly from the U.S. government, or what I would say felt like getting punched in the face over and over again. And me and a variety of close friends and partners that have been in the trenches in the industry for a long time show up, and we got a hug from the government. So that was a very emotionally confusing moment, I think, for a variety of us. It really showed how serious the administration is at not only looking at the space of what's coming in the future, but making sure that we can prevent what has previously happened in the past. And they really gave a forum for the industry leaders to all come together and have an opportunity to have a speaking moment and have requests and figure out what's going to be the right path over the next 4 years to make sure that change happens and change stays.
Hopefully getting punched in the face over the last 15 years, the blow was softened as you got richer and richer if you held Bitcoin. I mean, it hasn't been that bad, right? For those who hold these digital assets. At one point, I bought a Bitcoin for $600, and a couple weeks ago, it crossed over 100,000. Is that directional? Is that direction going to continue to be up, up, up?
I love what you said there. Oftentimes people will associate this happiness with the economic growth, but that's assuming that people held the asset like indefinitely, right? And usually what I tell people, I got involved in 2010. The only difference between me and someone who got involved in 2019 is I just suffered a lot more, right? A lot of people didn't understand what was going on. A lot of people were concerned this was a scam or Ponzi or whatever. And, now we see institutions are very much involved as it relates to Bitcoin. And it's just an entirely different veil that we get to wear. And that's exciting. And what was the second part of your question?
Well, I was just wondering if you expect Bitcoin to continue to move in that direction. I mean, it has been astounding to me. I remember Joe Weisenthal. Yeah. I told him I loved it at 250, and he messaged me at 75 and said, "You got to double up now." And I wish I had, obviously.
You're still here, so I'm guessing you didn't.
Yeah, I was transacting with my Bitcoin, which is ridiculous. I bought a beer with Bitcoin.
Expensive beer.
Could buy a car with that now. But do you think we're going to go to 200,000 to 500,000? And what's your time frame for that? What are your expectations?
Yeah, listen, the reality is there's only ever going to be 21 million Bitcoin, right? That's it. And in 2034, I think 2035, 99% of that Bitcoin will be in circulation, 99.9%. So there is a real scarcity around it. And now, the comparison we always like to draw at the firm is, what is the value? If we're looking at Bitcoin as an actual gold competitor, and we compare it to what is the actual size of the gold market, Bitcoin has a long way to go still to this day. And as we're moving through, as it's already been announced that there's a strategic Bitcoin reserve coming, and it's been announced that they are going to be buying Bitcoin. There is a scenario here, not just in the U.S., by the way. Obviously, we're talking about the U.S., but it will expand far beyond that, where governments will print money to buy Bitcoin. Now, ultimately, the U.S. commitment is it's not going to cost taxpayers any dollars, right? They're going to build a strategic reserve without additional cost to the citizens here. But every other country may not operate that way. So you're looking at a really unique dynamic, again, where governments will be printing fiat, be printing money, and ultimately to build up their Bitcoin reserves. So, yes, I think it's very much still directional.
But were you somewhat, I want to go back to the White House meeting, weren't you somewhat disappointed? It seemed like the crypto industry was overall, I think they expected, the administration, the government to be active buyers and not just Bitcoin, but other currencies. So weren't you disappointed a little bit?
I think the industry itself definitely has very much knee-jerky reactions. It's the nature of the space in and of itself. But I think that event was a very big symbol, and symbols can be powerful. I would not ignore that, right? I can't remember if it was Tyler or Cameron Winklevoss had a really great quote, and I told them I was going to steal this in the future, so I'm doing it now, guys. Sorry. They said, a year ago, they thought it would be more likely that they could be in prison rather than in the White House, right? And that's a wild thought. And they continued on beyond that to even say, right now, crypto businesses are born in law firms rather than being born inside dorm rooms and garages, right? And so that is a real problem. So
that is crazy because those are a couple of the most respectable people, I think, in the crypto industry.
Yeah. But wait. But were you disappointed? Did you expect to get more in terms? No. Okay.
What was going to happen? Like what? It's not like their bills were going to be passed in that room, right? But we had a room with there was about 30 people. You had 6 or so cabinet members and legislators, you had 4 regulators, and you had 20 industry people, give or take, something like that. Everyone had a moment to make a request and ask for something, and those asks were very, very powerful. And one of the more common ones that took place that, the 20, probably 8 to 10 people asked is they want to see legislation. The real fear is that we're going to make these executive orders and we are going to make these big moves, but 4 years from now that those can be undone. And we don't want to see that happen. We want whatever we do ultimately to have longstanding power on a go forward, so we can build a business around it.
To me, the fear is a lot of people in the crypto industry have worked for over a decade tirelessly to build a respectable industry, and obviously there have been some meme coins and I won't even say S coins along the way that kind of ruin that. And when you see a rug pull like Trump coin or Melania coin, that's got to be concerning as well, right? The president of the United States issuing a meme coin and then, was trading at $75 and then dumped everybody involved and now it's 10. Isn't that a concern for you? Don't you want someone who's a little bit more consistent and someone who has a kind of a different image than Donald Trump to be backing this up?
I think the thing that people need to recognize is a lot of promises are made in presidential campaigns all the time, and they're often not kept. And people make commitments, and when you call on those commitments, it's, oh yeah, we'll get to that. I got to take care of this other thing. Regardless of where you sit politically, Donald Trump came in, he made a commitment to make a variety of changes, and in like the first couple months, those things are happening, right? David Sachs had a really great quote during the White House event. He said, the administration is moving faster than most startups that David Sachs has worked with, right? And that's a wild idea. Like, we're already this far in a very, very short window. What will we be longer? Now, yes, is there other things going on in Trump coin and, and other distractions? Certainly. But like, will I take those things to also get something in the longer vision? Absolutely. I think, the alternative to what is happening now was unthinkable. And so now we're in a position where we have leaders and legislators that really want to figure out how to make this work and bring innovation back to the U.S. One of the largest capital flights, human capital flights that I know of, was when we basically eliminated the industry from the U.S. And all the money and all of the incredibly intelligent developers were forced ultimately to leave the country. We have an opportunity to bring them back, right? And people who I thought would never move back to the U.S., some of the smartest people I've ever met in my entire life, are now making their way back, and they're bringing the capital with them. And that's going to have a real impact on not only the industry, but just the economy in and of itself.
But you think they'll shake? I talked to the CEO of Tether today.
Yeah.
He came to us live from El Salvador.
And, well,
he
US.
must have just flown back. He was just he did his first trip to the U.S. ever last week and this week. So he was in D.C. And then he was in New York for a Cantor event over the past couple days, and that was his first time in the U.S.
Is that because, Andrew, you think he was afraid before this administration of the same thing as the Winklevi, that he would end up in jail?
I mean, I can't put words in his mouth, but I can't imagine that wouldn't have been a thought, right? That happened with others.
Let me ask
that's
you,
a real fear.
Yeah, I get that. Let me ask you a question that you're probably asked a lot. But Kara was asking me about this during the break as well. And now I'm getting a listener who writes in and says, when will we see any real utility use for Bitcoin besides just a proxy for beta risk taking? That's a little bit flippant. I think of it as digital gold, but it's a valid question.
To really do transactions.
And I'm sure, is that the ultimate goal? Is transactions what you think we eventually want to be doing with this? Or how do you see it?
I mean, for the industry, payments is a real use case, and it's being done now at scale in multiple places. Bitcoin,
but you don't want to buy anything with Bitcoin, right? I mean, I asked Michael Saylor about that, and he says only if you're crazy.
Yeah. And, Mike Saylor is very much in the camp that Bitcoin's a commodity, even though it's not taxed appropriately as a commodity, but that it is a commodity. And, from a transactional perspective, in its native state, it's not great for that, fundamentally. It's a store of value. There's other things built on Bitcoin, like Bitcoin Lightning. Tether's building an L2 on Bitcoin as well. That's all moving now, which will allow it to be very transactional. But Bitcoin in its native state is very much a store of value, or like that digital gold idea, which is why a strategic reserve for that actually makes a lot of sense.
All right, we got to leave it there. Interesting stuff. I didn't even get to the headline. Did you see the Journal about the Trump family holding talks to take a financial stake in Binance?
Yes.
To be continued.
That goes right along with the Melania coin.
All right, Andrew Durgee, co-CEO of Republic, joining us from Florida. All right, folks, we're counting down to the close. We're going to talk about the markets. In particular, we're going to get into the muni market. That's coming up next.
Ooh, munis.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all in the red, very much in the red as the selling continues. In fact, right now, we are close once again to session lows on the S&P 500 index. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Sean. That's right. It's another ugly day for stocks amid the trade tensions and the war in Ukraine. The Dow is currently down 581 points. S&P's dropped 86, while the NASDAQ is off by 2.1%. The U.S. 10-year yield is at 4.27%. Gold is at an all-time high. Oil is sinking, and Bitcoin, that's falling by 3%. Among the main 11 S&P sectors, all were trading in the red, led by losses in materials and utilities. And leaders to the upside in the Dow, Verizon and Merck, while Salesforce fell 4% and led to the downside. After earnings, Dollar General rose 5%, Adobe plunged 14%, and in the tech space, Intel jumped 15% as the company named a new CEO. Wrapping things up, DocuSign and Ulta Beauty report after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. To hear live breaking news over your Bloomberg, type SQUAK, S-Q-U-A, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, folks, we are just about 18 minutes away from the closing bell on Wall Street. I want to point out a story on the Bloomberg today. It just reminded us about what we've seen in the municipal bond market. Biggest sell-off in more than 2 years, causing valuations to tumble, opening a buying window for investors able to withstand the volatility. Welcome to our new reality. Our next guest invests in the muni market. With us as we drive to the close, Lyle Fitterer, co-lead municipal sector and senior portfolio manager over at Baird, joining us right here in our Bloomberg Interactive Broker studio. How are you?
Good. How are you guys doing? Thanks for having me.
It's good to have you here. Trying to keep up with the headlines. How do you kind of pull in everything that we're getting out of Washington and just geopolitics, trying to figure out kind of what it means for the U.S. economy, what it means for state and local governments, how it impacts the muni market?
Yeah, I think what you're seeing going on right now is in obviously every market, right, is that people are reassessing risk in the marketplace. It's the same thing in the municipal market where what sort of federal support are you going to get on a go-forward basis? What programs are they going to cut? What's going to happen to Medicaid? How's that going to impact a healthcare organization? So for us, it means you got to take down risk, which we had already been doing in our portfolios, probably take up liquidity in your portfolios to really, from our perspective, provide ammunition for and dry powder to invest when the market gets cheaper, and we're seeing that now.
It makes a lot of sense that the muni market would feel it worse than others because you need that federal backing in a lot of situations. And, the Doge has shown that it could get axed at a moment's notice. Where are the biggest dislocations in the market?
Right now, again, it's interesting. What happens in our market is the high-grade part of the market actually reacts first. Mm-hmm. So, because things trade and so therefore they get remarked in people's portfolios, the high-yield sectors actually usually that reaction takes a little bit longer. So whereas in the corporate market, you're seeing corporate credit spreads widen, you're seeing, structured product widen out a little bit. In our market, actually, higher quality names are actually leading the way as the market has sold off, which again isn't unusual. But again, I think it's actually providing an opportunity where you can go out and, there were deals priced today, I think with 5 coupons, AA rated, that were pricing at a 4 3/4 yield on the long end, which again, that's pretty attractive for a tax-exempt buyer, again, assuming that tax exemption continues.
I mean, is it a safe assumption, Lyle, that with what's going on with the U.S. federal government, that less money, if we continue along this path, is going to be going to states? And they have mandates, right? Often, right, they've got to get balanced budgets. So somewhere, things are going to be cut.
Yeah, and again, I think they're dealing with the reality already that the stimulus money has run out now. So a lot of those were still It was part of their budget last year and potentially this year that they still had some of those funds left over. So many states and local governments didn't necessarily build that into their budget forecasting. They had it built in as if that money was going to continue into perpetuity. So they're dealing with that. Now they have to deal with the uncertainty surrounding, are they going to get cuts to other federal programs? In the end, again, maybe I'm too much of an optimist. I think they're going to realize that the impacts of this, especially for smaller state and local governments and smaller issuers in the muni market, would be substantial. And so the funding will come through. But again, there's going to be a period of volatility, and that volatility and that kind of unknown out there is what causes, markets to sell off.
If we have a government shutdown, how does that affect the sector? You've seen it before, right? So what's the playbook look like?
Yeah, again, I don't know that it necessarily has spilled over hugely into the muni market before. I think, there used to be, you had the pre-refunded market that you couldn't do deals that would get pre-refunded because you didn't have access to treasury strips to fund those refundings. You don't have that anymore. So it would be just like any other market where, again, the uncertainty of, okay, how long are we going to shut down? What does that mean for payments that are going to state and local governments? What does that mean to payments that are going to Social Security beneficiaries? So it's the trickle down of impact. And again, all it means is uncertainty. What does the market do with uncertainty? It creates volatility. It means things probably have to get cheaper.
What if we have a recession? I mean, there's somewhat of a growth scare over the last few weeks, and I'm not saying that a recession is forecast, right?
But people are talking about it a lot more, so you wonder.
I think a recession actually means that Treasury market probably rallies. So while munis maybe lag in that scenario, it still means that high-quality muni prices go up and yields come down, which for most buyers, that means their portfolios actually appreciate in that environment. But it also means that people start to reassess then credit risk. So your lower quality issuers then start to get impacted more in that type of scenario. But again, historically, what happens in those scenarios is when interest rates come down, a recession hits, the price impact of lower yields in the Treasury market overwhelms maybe that spread widening, if you understand that. So effectively, you actually have a portfolio that could actually appreciate in value.
We had a great segment yesterday where we're kind of going through thing by thing, the equity market, the bond market, credit spreads, a lot of different factors to see whether or not they were pointing to a recession, because you can focus and kind of obsess with one indicator and say, oh my God, a recession's coming. And this was a Bloomberg opinion column by Nir Kassar, and it was just, in totality, no, it doesn't seem like recession. But I do want to ask from your vantage point.
By the way, that was a great interview.
Yeah. I know it was. But from your vantage point, do you see anything that says to you recession?
Not at this point. So again, I think you mentioned, corporate credit spreads have held in extremely well. Now they're off 13 basis points or something, I think, off their lows on a year-to-date basis. High yields probably off a little bit more than that, but still well through their long-term averages. If you look at the muni market, even, if you look at where credit spreads are in the muni market, they're tighter than their long-term averages, especially within high yield. So again, all those markets, I think, are saying, hey, we're not headed into a recession, but they're quickly reevaluating. And that's why you're starting to see credit spreads widen. That's why you're starting to see people reassess, okay, how long is this volatility going to be out there? When are we going to get some certainty from the administration to kind of understand what's going on and give us the confidence that we can then make a rational decision and put money to work in our portfolios?
Just got 30 seconds here, but got a bond trader on the horn. He says, what's a catalyst to take risk here? Every day is a Tate bomb or a war headline.
Again, I think you got to just look at the long term. What are you getting paid in the fixed income market to take risk? And again, I think if you look at it, you would say buy higher quality securities. On a Treasury right now on the long end, it's what, 4 3/4, somewhere around that. On a 30-year muni, I think you heard me say it earlier, I think some stuff traded today at around 4 3/4 tax exempt. If you adjust that for taxes, that's pretty attractive. So
when I say about tax-free munis before we get started,
Paul Sweeney just goes home and swims in a pool of munis every day after work.
We used to have a reporter here years ago, and she's like, "You win the lottery, put it in tax-free munis." Like,
and just go home and relax.
Exactly. Lyle, thanks. Great to get some time with you. Lyle Fitterer, co-lead municipal sector and senior portfolio manager at care. Kate coming up, folks. 10 minutes until we wrap up the trading day on this Thursday. We're counting you down to the close. We're back in a moment.
Listening to Bloomberg Business Week with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, we are just about 7.5 minutes away from the closing bell on Wall Street. We're going to head over to our TV colleagues in just a moment, count you down to the close, do some earnings as well. Carol Massar along with Matt Miller. Matt is in for Tim Stenovec, who's on assignment. And you said, maybe we should talk about the most read story on the Bloomberg.
Exactly. I mean, we haven't really addressed it, head on. We did play some of Howard Lutnick this morning, and he was on Bloomberg Surveillance responding in part to Trump's threat to the EU. It was essentially...
we have tariffs, and then you've got tariffs. When you go after wine and champagne...
Yeah.
That's an issue.
But this is something that happened last time, but not to this same extent, right? The EU, in order to retaliate against Trump's tariffs on steel and aluminum, says they're going to tariff like the most popular goods. I was living, by the way, in Europe last time this happened, so it was in a sense painful, right? Because they raised tariffs on bourbon. So they raised tariffs on Levi's jeans. They raised tariffs on Harley Davidson motorcycles. And, obviously I wanted.
Did you buy one?
I didn't buy one when I lived there.
You didn't?
In part because the regulation just makes it impossible. When you have a Harley, you want straight pipes, not a catalytic converter and mufflers, right? You want it to be loud. And in Germany, they'll just arrest you if you do that.
Some folks care about the environment, and maybe you want to do those kind of things?
Yes, I know some folks do.
Some smart
in any
folks
case,
do.
Now that I'm back here in America, where
Pollute
we
away.
have
That
freedom,
pollutes away.
I'm going to buy a Harley this month. But the point is,
go ahead.
Trump is angry that they're putting tariffs on those things, which he thinks, Howard Lutnick was telling us, is silly. Compared to the steel and the national security issues that he's putting tariffs on here. And so he threatened 200% tariffs on wine, on champagne, and other liquors out of the EU, which I think would be painful for Americans as well.
Well, you know what they say about what's fair, not fair in love and war and tariffs?
All's fair in love and war is what they say. Are you having problems with your idioms today?
I am. I'm a little tired. No, I always have problems. So all's fair in love and war and tariffs. I mean, listen, they're fighting maybe not fairly, or maybe they're fighting where they know it's going to hurt.
I mean, it depends on who you ask. To me, the EU has these big tariffs on U.S. goods, and the U.S. doesn't have tariffs on, big EU goods. For example, on cars, a European car that's been imported from the continent, you're going to pay 2.5% tariffs here.
That's pretty low.
That's pretty low. Yeah. If you're in Europe and you want to buy an American car, and by the way, I wanted to buy a Hellcat when I lived there, and they were going for well over $100,000 because Europe puts 10% tariffs on those vehicles.
So you seem to say that maybe some of what we're seeing out of the administration makes sense.
Certainly that makes sense to me. If they have 10% tariffs on the same goods that we only have 2% tariffs on, that needs to be balanced, as Lutnick was saying.
The president has said if this tariff is not removed immediately, the U.S. will shortly place a 200% tariff on all wine, champagnes, and alcohol products coming out of France and other EU-represented countries. Okay, that's going to be a problem.
Yeah, but the best line he saved for last. This will be great for the wine and champagne businesses in the U.S. What? You can't make champagne in the U.S. That's kind of the point.
Yeah, I know, right?
Yeah.
Well,
it's got to come from the Champagne region, which is in France.
Maybe he's got to work on the messaging a little bit.
Can you make Prosecco here?
His point was well made. I don't know. Are there American makers of Prosecco?
I don't know if Prosecco is the same thing where it has to be from a certain region. To me, Prosecco's Italian, right?
Yeah.
And then
maybe, I don't know.
In Germany, it's called Sekt.
Maybe we need a big take on this.
Yeah. David Gura, I'm sure, would be happy to research and report it out.
It's pretty interesting, though. Cece's saying it is regional. What, Prosecco?
Prosecco, I guess, has to be Italian.
Sounds like somebody who's had a few bottles of Prosecco every once in a while.
I mean, I like American wines.
You're not drinking, though.
True.
Are you done?
Yeah, I'm finished.
All right, folks, we've just got a few minutes to go until we wrap up this trading day, some earnings as well. We're heading over to our TV colleagues. That's because the closing bell starts right now.
Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Steele, taking you to that closing bell. A global simulcast. It starts right now. Scarlett Fu in the TV studio as normal. Carol Masser in the radio booth as normal. Tim Stenovic, for some reason, has the day off. In his place. They had to look far and wide, but they found somebody who could fill those shoes, and that is Matt Miller, the co-host of Open Interest. Welcome to our audiences from across our platforms here, Carol, on another brutal day.
Yeah, exactly. Another day of selling, right? And so it just seems as long as those tariff headlines continue or tariff threats continue, that we continue to see stress on Wall Street because you're just seeing it clear across the board. Matt, do you have anything to say?
Yeah, well, no, for sure. I mean, I've been watching these markets all day. We're looking at, I guess, a correction almost near as damn it to 10% off the S&P 500 highs. Obviously, we're already there on the NASDAQ. My question is, when are we going to know the bottom? I don't know if you guys have seen this chart on the Bloomberg 3116, but what it shows you is the NASDAQ 100 has had huge volume today. And when we've seen more than 75 million shares traded over the past few years, quarters, you always see a bounce. That is the bottom, and we're seeing that indicator today, so maybe this is it.
I like the note that I read from Dave Lutz over at Jones Trading saying markets occasionally like to find people's pain thresholds, and at the moment, the market is trying to figure out what President Trump and Secretary Bessent are, basically.
And you have to wonder, is that a 15, 20% move in the S&P? Like, is the Trump put there? It just ain't there at 10%.
Yeah, certainly not here. And the real key number that you're looking for right now is that 10% correction on the S&P. Basically, a close below 55.30 would effectively mean that. It takes a while for these numbers to settle, but right now we're right around 55.21 and change, down about 78 points or 1.4% on the S&P 500. Should that number hold, that means the S&P will have drawn down a full 10 percentage points from its all-time high that was set just back on February 19th, which was just 3 weeks ago yesterday. The other indices also taking the punch as well. The Dow Jones Industrial Average down more than 500 points or 1.3%. The NASDAQ Composite down more than 300 points or 2%. And the Russell 2000 is going to lose about 33 points on the day or 1.6%.
All right, everybody, and just digging a little bit deeper into what we saw in the S&P 500, 372 names to the downside on this Thursday and 131, Scarlett, to the upside.
All right, let's take a look at the IMAP. There's a lot of red, as you'd expect, but there is a little sliver of green there, and that's mainly in the utilities index. Too bad it's one of the smaller sectors in the S&P 500. The actual smallest is materials, and that group is down by 0.1%, also outperforming the broader market. In terms of big decliners, 3 groups finishing down 2% or more. You have communication services, consumer discretionary, which includes home builders, retailers, and automakers, and then you have the real estate investment trust group down, again, 2%.
All right, guys, to the individual gainers, a lot of red on that IMAP, but I did find some gainers. Intel, clearly one of the big movers to the upside in today's trade, up as much as 18.6%, finishing the day with about a gain of 14.6%, top gainer in both the S&P 500 and the NASDAQ 100. Of course, we know we got the news late yesterday about the chip maker naming Lip-Bu Tan as its new CEO, so succeeding to interim co-CEOs. We did have B of A upgrading Intel today to neutral, citing Tan's solid track record. There's still a lot of questions about the future and what Intel looks like going forward, but as our own Ian King reminded, you know, still a big market cap and still a company with about $50 billion in revenue.
Well, it's a small market cap. It's only $100 billion.
It's not that small.
Compared to other chip makers we talk about?
So maybe it's a smaller chip player, but he said, don't count it out. All right, just wait your turn. All right? All right, let's get to 2 other names. Dollar General up about almost 7% in today's session. This was a top name in the S&P 500. The company came out fourth quarter comparable sales, comp sales, topping Wall Street expectations. Analysts also say its annual outlook likely better than some investors feared. And so we did see that name move higher, up about just shy of 7%. Also bringing up Dollar Tree, that was up about 6.5% as well in today's session. And another name, we don't say it much, Fabrinet, up almost 11% in today's sessions. It makes optical components used in data centers, and it did rally after entering a warrant agreement with Amazon to buy up to almost 383,000 shares. So that got that one moving in today's session again, up about 11%.
I'm just looking it up. Fabrinet, you say?
Fabrinet. FN is the ticker.
Fabrinet.
Yeah, it's about $8 billion market cap.
8 billion. So not nearly as big as Intel.
Correct.
I'm looking at Adobe. Last time I checked, it was the biggest loser on the S&P, both in percentage terms and in points. It gave an outlook that was mixed relative to expectations. And actually, BI, Bloomberg Intelligence, said their guidance for 11% growth in annual revenue, recurring revenue for its digital media segment was encouraging. But KeyBank, Bernstein, Stifel, Mizuho, they all cut their price targets, and Evercore wrote that the report wasn't strong enough to change the narrative around the stock. So that's a big loser today. Ulta Beauty, I could have chosen, by the way, any of these real consumer-facing companies. Airbnb and CarMax as well got hit hard today, but Ulta is coming out with earnings momentarily, so I thought it would be a good one to focus in on. There's a concern that their guidance from January is at risk now because of the steep drop in let's say consumer confidence after the holiday season and in the beginning of this Trump 2.0 term. That's according to Bloomberg Intelligence. The beauty industry, like all of these big consumer-facing businesses, has been hit by so many things: wildfires, weathers, illnesses. Raymond James is concerned about illnesses. It'll be the first earnings report, the first earnings call for Ulta's new chief executive officer, Kecia Steelman. So we'll see how that goes. And then Cummins. I could have picked any of the big diesel motor makers or diesel truck makers. And this is kind of counterintuitive, but the EPA is reconsidering regulations on vehicle emissions, as you would expect in the Trump administration, rolling back nitrogen oxide emissions. It would significantly reduce, I guess, climate protections, and you would think, oh, that's good for these big diesel makers. But the pre-buying for heavy trucks was expected to be much bigger because of new regulations. And if they don't put those new regulations into place, nobody needs to buy a new truck.
Well, yeah, and also, Matt, to that point, a lot of these companies were already sort of changing what they were providing and producing to help that as well.
Ulta Beauty, they are out with their earnings. Matt was just talking about them, and it is a big beat on the bottom line, at least. Fourth quarter EPS, $8.46 a share. The street was looking for $7.12 per share. Net sales, though, that was relatively in line with estimates for $3.5 billion. Comp sales on a percentage basis, the growth there was 1.5%. The street was looking for growth of about 0.8% here. So a beat on the bottom line, a significant beat, it will, in terms of the growth in comp sales, although the aggregate number on net sales at the top there pretty much in line with estimates. And here's your forecast now crossing the wire. For the full year, the company says its net sales will be in a relatively tight range of $11.5 to $11.6 billion. The street on average was looking for 11.6, so basically guiding relatively in line with street estimates.
All right, let's take a look at Rubrik as well. Enterprise software company, does some cybersecurity. It is moving higher in after-hours trading by a lot, up 15% after its first quarter revenue forecast beat analyst estimates. It sees first quarter revenue of anywhere from $259 million to $261 million. It's a pretty narrow range, but analysts were looking for $243 million on average. In terms of the full year subscription, recurring revenue, $1.35 billion to $1.36 billion. Again, a narrow range, but higher than what analysts had anticipated, which was $1.31 billion.
All right, let's get to DocuSign. That stock down about 7%, 8% here in the aftermarket. All has to do with the outlook. First quarter revenue, DocuSign expecting $745 million to $749 million. The street estimate was for $757.2 million. This again is their first quarter revenue outlook, so some disappointment, and that is putting pressure on the stock. Looking to the fourth quarter, the quarter that just happened, we saw fourth quarter revenue that was actually beat at $776.3 million. Fourth quarter EPS, 41 cents a share versus 13 cents year over year. Adjusted EPS for the fourth quarter, 86 cents a share. That was a penny better, but it's all about that first quarter revenue outlook. And you are seeing, wow, the stock actually now up about 2.5%. So a lot of bouncing around here, despite that miss in the forecast. We'll keep an eye. It's now down another 6%. So a lot of volatility.
All right, bouncing all around there. I want to just take a quick look at the bond market here because we have a lot of auctions that happened this week, and they actually went pretty well. And we saw some buying come in today. The 30-year yield had $22 billion worth of issuance. The takedown was just fine. And it makes sense, guys, as we see this volatility, just take a look at earnings, and we see the decline, and we see the S&P in correction territory. That bid for the bond market continuing.
All right, guys, that's a wrap. Our cross-platform coverage on radio, TV, YouTube, and Bloomberg Originals. Alex is heading out. I know Scarlett and Romain are going to continue on television. Matt and I continuing on Business Weekend. Guys, I'm going to take a couple of days off, so I will see you on Tuesday. But that's a wrap for our cross-platform coverage.
See you next Tuesday.
This is Bloomberg Business Week. Insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
All right, everybody. Carol Masser along with Matthew Miller. Matt, of course, in for Tim here in our Bloomberg Interactive Broker Studio. What?
Nothing.
Okay.
I'm excited that we finally got the correction. You know, Adam Johnson used to always say the pause that refreshes. And
a
correction on the S&P 500.
Listen, markets don't just go up, 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 right? Like, we know that. And I would still argue, I'm not an expert, but just watching markets and market cycles, that markets go up, markets go down. And there is a point where you want to see some of the fluff taken out of equity, especially after a tremendous
over the long term, though, stocks always go up.
I mean, go back, right? 5 years, 10 years. I mean, it's,
20 years, 50 years.
Exactly. All right, folks, let's talk a little bit about what's going on in the market because we have seen retail investors pour about $7.3 billion into equities in the week through Wednesday.
I was thinking about that as well.
See,
you've got all these
that
warnings out of
terrifies
Wall
me.
Street. Although I will say they still have the strategists. If you type in SPX Index ANR, you can see Lou Wang's survey of the biggest Wall Street strategists. It's fantastic work.
Yeah.
And we're still looking at an average year-end price target of 64.79.
We're at 55.21 on the S&P.
Yeah.
That's a move up. All right.
A 14% move up.
Yeah, and I will say these retail investors, they were boosting exposure to Tesla. This is coming from Emma Wu, a global quantitative and derivative strategist over at JP Morgan. All right, let's see if that's the case with the clients of our next guest. With us is Tina Hurley, head of planning and ultra high net worth solutions over at Citizens Wealth, joining us from Johnston, Rhode Island. Tina, good to have you here with Matt and myself. So I am curious, what's your client's mood right now and sentiment? Are they looking to put more money to work, or are they in kind of a risk-off type of mood?
Yeah, well, hey, thanks for having me. I appreciate the time today. You know, I think, you know, in general, when we're working with our clients, we're really focused on their unique goals. And so some are and some are not, right? So it depends on what's going on with that particular client, what's going on with their families. And our advisors are really taking the lead from the client in terms of their goals and creating a wealth strategy that's appropriate for them.
All right, so I guess you don't have an overview, like an average of what your clients are doing?
But you don't tell people like, hey, listen, if you really like this name, which you have liked for a year or two, this is an opportunity to get it. You know, like, I am curious if you know, that you, in this environment, is it opportunistic? I mean, is it investable? Is it an investable market in your view?
Well, here's what I would say. In our business, we're investing for the long haul. So as I was listening to you guys, you were talking about the market always goes up, whether it's 10 years, 20 years, 100 years. And so that's what we're looking at, is really making sure that we're doing what's best for our clients in the long term.
Yeah, I mean, that's exactly what I was thinking. If you're in for another 10 years, I probably won't retire for 20, right? So I guess it can't be a bad point to buy when the market has dropped 10%. Now, if you have a shorter window, if you're looking at a few years or if you're retiring soon, what do you think about rates at this level?
Well, you know, I think that's a variable. You know, all of our advisors are really trying to balance. Again, when we're leading with planning, we're thinking about the long-term goals and balancing rates of across the industry, whether that's in the market or it's in a cash position. So it's important for us, I think, to take a step back and really spend the time necessary to understand what those clients' long-term goals are, whether it's, you know, an interest that the client has, or it's really just achieving that goal.
Tina, let me ask though about, you know, I get that everyone has different investment horizons and everybody has different risk aversion, and that you deal with really a diverse clientele. But in general, right, if you look at expectations going into this year, you know, post-November, the rocket launch that we had when Trump won, and what we're seeing develop now, how do you think that turned out, and where do you think it's going?
Well, listen, I'm not going to predict markets. That's not what I do. But I will tell you, we're going to stay in it for the long haul with our clients over a period of time, make sure that they are invested appropriately to achieve their goals.
So one thing I did want to ask you, because I know you guys have done some research about women in particular and the great wealth transfer. But before I ask you that, is there anything that you've noticed with your clients when it comes to men versus women, how they deal with volatility, how they deal with risk or risk off in this kind of environment? I'm just curious if there's any trends that you've noticed.
Yeah, you know, actually, thanks, Carol, for asking that, because, you know, generally what we're seeing from women, and this is really, you know, embedded within the survey that we did, they're risk aware. And so they are thinking about stability. They do think about prioritizing caring for their children. And so as we're working with them and developing a financial plan or an estate plan, we're really thinking about the investments that match that priority for that unique individual. But in general, women do lean more towards stability.
What kind of, you know, I was talking about this wealth transfer with Sally Krawcheck a couple months ago, and I thought it was fascinating because, I mean, how much money are we talking about here? I've heard Ed Yardeni estimate that the baby boomers have like $75 trillion in assets. So how big is this, Tina? And how much do you expect to end up? This is something I thought was interesting from Sally's perspective. How much do you think is going to end up in the hands of women as opposed to men?
Yeah, great question, Matt. Overall, I think we're seeing that $124 trillion transitioning now through 2048.
$124 trillion.
Trillion.
That's huge.
34 trillion is really transitioning to women. And it's transitioning to women because you think about, first of all, women outlive men, right? So you've got this sort of predeceased situation where you've got a widow that will receive $34 trillion. And it's very significant, and it's a huge opportunity. The way we look at it is this is our opportunity to really dig deep. When we lead with planning, we're doing really deep discovery. We better educate those women because they're not quite confident yet. We've really got to work on making sure that we're empowering them. These are going to be the recipients of $34 trillion, by the way, in the next 5 years. So of that 124, 34 trillion is moving to women by 2030. It's huge, and it's a huge opportunity for us to empower these women to be able to take control of their financial futures.
Tina, who are these women? Because I feel like this is a conversation I had, I think, years ago. I remember actually Don Strassheim, if you remember from, I think it was Merrill, and he used to talk about that. He actually took his wife to an investment advisor that she felt comfortable with. But this is, I'm going to date myself, like 30 years ago. So who are these women that,
Well, and a lot of times they're picking new investment advisors. This is an issue, right? So you're going to see a lot of that money, those huge numbers, Tina, that you're talking about, move.
Right. That's right. That's right. Which is frankly why the advisor's role in this is so critical. They have to be engaged with both parties now. Now more than ever, they need to be making sure that these women are comfortable and gain confidence. So it might mean that these advisors really need to start spending time educating women on basic financials. Or, when they are still married and the husband hasn't passed yet, make sure both are at the meeting so they're talking to both people and they really understand the depth of that relationship so that, Matt, they don't move when that husband deceases. At the end of the day, this is about making sure that a woman feels confident at the table and comfortable talking about her finances. When we did that survey, 84% of the women who responded are still not confident about money matters. And so we really have to embrace this moment and dig in and really make sure that we are spending time not only with the women, but with their children, because that ends up being one of the top 3 priorities of women when they're thinking about financial future.
All right. Well, good to spend some time with you. Tina Hurley, she's head of planning and ultra high net worth solutions over at Citizen Wealth, joining us from Rhode Island.
I hope also that this younger generation of women, and I think for sure, is going to be much more confident, than previous generations.
I think so. I think women are in some ways.
I'm more confident in my future because my wife has taken over our finances.
I'm glad she's going to take care of you. All right, coming up, we're going to talk virtual reality, how it's changing all of our worlds. That's next.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. We begin with DocuSign. After hours, the stock is up roughly 5% right now. The software company's forecast for 2026 billings exceeded the average analyst estimate. A down day on Wall Street, down, putting it mildly. The Dow, the S&P, and NASDAQ all declined. Tariff worries rattling Wall Street once again, pushing the S&P 500 into a correction that left it at the lowest in 6 months. The S&P's three-week rout now past 10%, a level that does meet the technical threshold for a correction. S&P down 77 right now, 55.21 on the S&P, down 1.4%. That is the lowest in 6 months. The Dow down 537, down another 1.3%, and NASDAQ tumbled 345, down almost 2%. The price of gold today up $47 the ounce, $29.82. That was an advance of just about 1.6%. West Texas Intermediate crude down 1.6%, $66.59 for a barrel of WTI. So again, recapping, the Dow, the S&P, and NASDAQ all lower in a correction. S&P down 1.4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master along with Matthew Miller in for Tim Stanovic on this
We've only known each other for 25 years,
a
so.
long time. I know, it's just like, I get on remote. All right, this is one of those segments, first of all, that I think it's really important for you to know a little bit about our guest. She is a deep space engineer, digital cinema pioneer, holds 10 plus, more than 10, technology patents in digital cinema, augmented and virtual reality, real-time streaming, artificial intelligence, and spatial audio.
Do you have any patents?
No, my dad does, though.
I wish I held patents.
Yeah. I don't. But anyway, let me continue. Her technologies have been utilized by Microsoft Xbox, Universal Music, Lucasfilm, and more. She serves on the board of Amazon Launchpad and Meta Oculus VR for good and is a scientific reviewer for the U.S. Department of Defense. She sounds like she's been pretty busy. She's also the inventor of the world's first 360 4D audio headphones for music, VR, sports, ASMR,
awesome.
and more. And she's worked with three-time NBA champion Dwayne Wade, Lady Gaga, and Demi Lovato, and I'm sure more. We were talking about Mary Spio. She's also the founder and CEO of Seek, a blockchain-powered virtual events and Skillshare platform, and she joins us from Miami. Mary, I'm sure I'm leaving some stuff out. Your background, it's a lot. Tell us a little bit more about yourself, how your career has evolved around emerging technologies, and what among those emerging technologies that you find fascinating today.
Oh, thank you so much, Val. What a great introduction. Thank you. So my background, I actually started out as a space engineer, but before that, right out of high school, I actually joined the military. I went in the Air Force, and that's how I, started my journey into satellite engineering and communications technology. So, from there, I've always had an interest in entertainment technology, particularly. And so after working, building satellites, launching satellites into space, I just decided to focus on live streaming over satellite. And that's how I came up with a technology for digital cinema. And I sold the patents to the Boeing company. So I came in as head of satellite communications, worked with the Boeing company, and we launched the digital cinema technology. And basically what that was, the technology enabled movie studios to do a single broadcast. So if you had a movie release coming, the first movie we did was Star Wars Episode 2, and we released that to 30,000 theaters. So instead of doing all these reels, which could cost millions, we could do a single broadcast for thousands. So you went from spending maybe 30 million in distribution costs, for FedEx and the reels, to spending maybe 300,000. So it was a substantial transformation for the movie industry.
Before we get to Seek or deeper into Seek, I want to know about these headphones. Where can I get some 360-degree 4D audio headphones?
So if you go to seek.com, which is CEK.com, you can also pick them up from Amazon. We're on Amazon, and Neiman Marcus also carries them. And the 360 headphones, how, that came about is in working in VR, I noticed, a while back, if you remember, the most of the mobile VR phones would heat up. I think even the Samsung phones were exploding at one point. And a big part of it was how much the audio and other aspects were tasking the phone. And so I wanted to create something that would allow the 360 environment to be consumed independently of the mobile phone, and that's how the headphones came about. But there were because before VR, there was really no need to be able to hear above you, below, and all around. But inside of the VR environment, especially if you're gaming, if you're watching a movie, now you're engulfed in the process. So the 360 headphones, even though you don't need to use it for VR, I've seen a lot of athletes use it for training. Actually, I saw Derek Rose with it on for an interview that he was doing. But so a lot of people use it for sports training, but it allows you to hear above, below, and all around, as if you're actually in the location.
Yeah, I can imagine it for
cool,
for
right?
military training, right? And I know you're a reviewer for the Department of Defense as well, Mary. If you're in a combat simulation and the enemy drops a shell casing, you want to know where that's coming from. How do you even do that? I don't know if we have time, but how do you even make that happen? Because I'm looking at these headphones and you wear them like normal headphones, one cup on each ear. It's not like there's a piece of the headphone that's in front of my forehead or behind me. How do you make that? How do you trick the brain?
So what we're doing is sound reproduction. So a lot of headphones, basically what they do is they just do like a sound model. So they place the audio where you're supposed to hear it, to the left and to the right. So we're using a binaural effect. And so it's a physics-based process. So we tell your brain the sound is in front of you, the sound is behind you, or the sound is to the left. And we draw a sphere around you. And then we actually reproduce the sound exactly where it's happening, in relation to the sphere. So instead of just saying, okay, you're going to hear it on the left or on the right, it's all around you. So if a shell casing drops behind you, now you can hear it. Another cool thing about, and this is a chip that we're using to do the sound, recreation. And another cool thing about it is we also detect the material properties. So if a shell casing falls on a hard floor, the sound is going to sound different than if, let's say, a raindrops in the pond somewhere. And having the differences in the sound, it makes for better visual experience. It also makes, because the audio actually informs the visual, right? So when the audio is that crystal clear, it feels even more immersive. And in the case of fight, simulation, you can imagine where it would be good to know if, you're running in water, right, or, where things are falling. Yeah. And for gaming too, it's incredible.
So
you can hear something next door and so on and so forth.
So tell us just about Seek and the companies you're working with and what you guys are doing specifically.
So Seek specifically, we are a platform that enables you to upload content once, and then we stream the content to VR headsets. So Meta's Oculus, Oculus, HTC Vive, Apple Vision Pro. We stream it to all the different, in addition to the regular, iOS, Android, and our own VR headset, you can also access it. Because, VR is truly exciting, but it's also very complex, time-consuming, and expensive if you have to create content for Oculus and then for HTC and for all these different headsets. So we've made it super easy for you to just create once for our platform, and then we distribute the content to all these different, venues.
Well, I just wanted to say thank you for your service, first of all. And I know you did a chicken soup for the soul thing, so I'm definitely going to check that out to hear more about you. I think it's really cool stuff that you're doing, and I definitely want to have you back on again.
Yeah, come back soon. We've got to jump just because of all the news and the market moves. But Mary Spio, the founder and CEO of Seek, thank you so much for joining us. We do want to remind everybody we did see a correction in the S&P 500 today. We've been kind of flirting around it for a while here, but closing there. Let's get to it. Just a quick roundup of the trade today. Bloomberg News equities reporter Norma Linda here. in terms of the correction. We got a correction. We hit it.
We did. We officially hit that level. And of course, this isn't a great level as we're thinking about what analysts are thinking and what investors are thinking across Wall Street right now. We have bearish sentiment at extremes. But this particular correction marks the 7th fastest correction that we've gotten since 1929. That's according to Bloomberg data that we have back to that point. Now, if we think about 3 of those 7 fastest drawdowns of this magnitude, they each happened under President Trump once in 2018, 2020, and now being the 3rd time to mark that case. But of course, we saw red across the screen as we were hitting the close. Only industry that we were seeing in the green was utilities. All other industries were in the red here. And it really is just showing that people are uncertain. People are really afraid. We're seeing people who are selling off. And it does seem, as I've been hearing and speaking to sources, that people are just looking for hope and looking for places, safe havens, to sit during this tumultuous time period as we think about the trade war.
Can I just say we're still up almost 44% since the end of 2022.
Which is really important to note.
A little perspective.
Some green.
Yeah. I mean, I'm just saying.
I was also going to say, Carol and I have been there for a couple of those fastest drawdowns. Like a couple of them.
During the financial
even
crisis?
you, Normal.
Yeah,
and,
I've been there.
Because, well, during COVID, right?
Yes.
You saw a couple of them in
During COVID.
2020.
Definitely in 2020.
Where you saw in one day a drop of, one day there was a drop of 9.5%. That was on March 12th. So almost exactly 5 years ago. And then on March 16th, 2020, there was a drop of 12% in one day. But
that's because everything shut down. Like we
This is true.
understand
Everything
that we could
stalled.
explain it, right? And then as soon as money started pumping in, we saw stocks bounce back.
Well, also, I was going to point out, on those 2 days, you saw like 496 stocks fall on the S&P. Today, only 372 stocks fell,
Very
right?
important to add that context here. I mean, I think people are just a bit
Context
uncertain.
changes everything.
Context does change everything.
Wait, what's the tagline?
Isn't that our
we have?
slogan? Right?
Context changes everything.
Sounds about right.
I mean, I think it's safe to say that we understand that we've got a market that is trading out of news out of Washington, and in particular,
Most
the
definitely.
tariffs, right?
Right. But we also have the Fed meeting next week. And it's funny because we spent so much time thinking about the Fed. Now it's been tariffs nonstop.
We've actually been talking about it.
See, and I appreciate that. But we've got economic data.
But I take
really-
your point, Nora, because for a long time we were breathless about the Fed and every single day caring about the data points. Today, somebody was like, PPI's coming, and I was like, so what?
Yeah, who cares, right? That's what we're doing.
It actually came in cooler than expected, and the futures didn't even rise.
Exactly.
It's been like our top conversation today and yesterday.
The Fed?
The inflation. Yeah, inflation numbers. What it means for
It's still a conversation,
offense.
nonetheless.
I mean, we're laughing, but it's not funny. I mean, people are, money, the markets are going down, and I think everybody's trying to figure it out. We are, though, not expecting the Fed to do anything. Just got about 10, 15 seconds.
Yeah, I mean, I think that's really what the focus will be as to whether or not the Fed will actually cut. Will they just kind of remain where we are? Of course, that's really what everyone's got their eyes on, but lots to look at in the market here.
All right.
And you're going to come back and do that with us.
We shall. Take a look under the hood.
Nora, thank you so much. You are listening and watching Bloomberg. This is Bloomberg Business Week.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks officially now in correction territory. In this Bloomberg Business Flash brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. Shares of DocuSign after earnings, they are moving lower after ours. We've got actually moving higher. We've got the DocuSign after ours rising after 2026 billings forecast tops estimates. Right now after ours, we do have DocuSign up by just about 7%. The Dow, the S&P, NASDAQ all lower today, with the S&P down 77, drop there of 1.4%. Tariff concerns again rattling equities. The S&P now at 55.21, lowest in 6 months. The Dow down 537, down 1.3%. NASDAQ today down by 2%. 10-year 4.26%. The 2-year 3.95%. Gold up $51 the ounce, up 1.7%. And West Texas Intermediate crude down 1.5%, 66.69 a barrel. As for the market backdrop, Brian Vendig is Chief Investment Officer at MJP Wealth Advisors, and he was a guest right here on Bloomberg Business Week.
This is not necessarily all just policy driven. I think there's some fundamental valuation concerns about different parts of the market, because when you look under the hood, you see that there is a rotation going on between growth and value, and I think that has a lot to do with how much investors want to pay for growth right now.
Brian Vendig of MJP Wealth Advisors. Again, recapping stocks lower, DocuSign higher after hours, after earnings up by roughly 7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master along with Matt Miller live here in our Bloomberg Interactive Broker studio at Bloomberg headquarters in New York City. He wanted to get to a story out from the Business Week team. Donald Trump's promise to eliminate taxes on tips and overtime pay has raised concerns among tax experts who warn that such a policy could have unintended consequences and create complexity in the tax code. With more on what some say are the possibly crazy things that could happen is Bloomberg News wealth reporter Ben Steverman. He joins us now in New York. His Business Week story, by the way, it's on the Bloomberg terminal, and you can find it also at bloomberg.com/businessweek. Ben, bring this up, and I got to say, you get a pretty good debate on this issue. Remind us about the president's pledge and how this could ultimately work, especially in something like tips, which seem to be kind of a tough thing to track.
I never paid tax.
Yeah, so these promises came out of Donald Trump's stump speech last year, and he says the origin of the no tax on tips was just a waitress at his hotel in Las Vegas walked up to him and said, "You shouldn't have taxes on tips," and he liked the way that sounded, and the polls suggest voters like it too. But when I talk to experts about this, I really hate the idea of exempting one kind of income, whether that's tips or overtime, from everything else, because it just kind of just opens up a ball of big can of worms. It's because it incentivizes people to shift their money income from one category to another. And so it just becomes really important how you write the rules, how you draw those lines. And then that drawing of the lines makes everything more complicated for taxpayers, especially the ones who want to access the benefit.
I mean, on the one hand, I understand that, because then I guess the idea is I could go over to my boss and say, listen, instead of paying me a salary and a bonus, can you just give me like a small penance and then a tip me at the end of the year? That's not really going to happen, though, is it? And let's be honest,
Not
Ben,
for most people,
those
right?
of us who have worked in jobs for tips in the past, Carol, do you ever wait tables?
No.
All right. Well, I waited tables and I never paid tax on those tips. Like nobody did. That just, I mean, how do people pay taxes on tips?
They do now. I think this is one of the reasons this is coming up is that because of credit cards and debit cards, this has gotten a lot easier to track. So far more of tip income. Back in the 60s, the IRS estimated that only 20% of tips were being reported. And I just looked at a study, actually several years old now, but it suggested more than 2/3 of restaurant tips are now being reported. one of the issues with this is that the proposals that Republicans and Trump would be talking about are exempting tips and overtime from income taxes, but really the important tax that tip people pay is payroll taxes. 2/3 of tip workers never pay income taxes, and most workers pay more in payroll taxes than income taxes. So one issue here is that they could be exempting this kind of income, but really it doesn't really end up benefiting very many of the people who are actually waiting tables or working at coffee shops or all the other things that get tipped.
How did you avoid waiting tables, Carol?
I had other jobs.
I love the, obviously people are going to try and game the system, Ben, and I love the example you bring up. I was thinking about this recently. I don't know where I was, looking at a building with bricked windows and trying to remember, I thought I knew, why did they do that? And you remind us that some king in the 1600s in Britain started taxing buildings based on the number of windows. And of course, what happens is then all the landlords brick up as many windows as they possibly can.
Yeah, and somehow that tax was on the books for like 150 years. And so you ended up with all these tenement poor people were living in that didn't have enough light, didn't have enough ventilation. And it's just an example of these unintended consequences that tax changes can have. It's often things you might not even think about when you pass the bill. Another example I bring up is the luxury tax that was passed in 1990. That was just seemed like a good way to close the budget deficit. Poor people, which wealthy people will pay this tax? Well, it ended up like devastating the yacht industry and it in the United States, and all these working class people lost their jobs, and it really didn't bring in much revenue. So, and it was repealed in a couple of years in that case. So what we were trying to do in the piece is just kind of like imagine how people are going to use these, because it really, sometimes it can take a few years before the effects can be really felt.
I mean, do people also think that, I don't know, there's part of me, I feel bad because I feel like people who get tips, they often have a lower wage, right? And so the whole idea is that they make it up in their tips. But at the same time, I pay taxes on everything I make. And so why, like to how you started, like why should some
you do,
income...
but super rich people, pay much lower percentage than...
Because it's investment income. It's like a whole, right? There's a whole other thing. But will people then maybe stop tipping because they're ticked off and they're saying, I pay taxes, but you don't have to on your tips? Like, could there be, I don't know, what are you hearing?
Yeah, I mean, only about 2.5% of the workforce gets tips, and there are a lot of working class people. So you think about the cook in the kitchen isn't necessarily getting the tips. Sometimes restaurants pool tips, and you might know Matt better than me.
Yes.
But yeah, like a convenience store clerk making $30,000 a year and a waiter making $30,000 a year, one of them would be getting a tax break under this plan, and the other would still be paying the normal amount. So does that end up creating resentment when people get around to ask for those tips? We're being asked now everywhere we go on those screens that they tilt toward us, 20, 25, 30%. Do people start saying no more often? This could backfire in that way as well.
Hang on a second. Did you also never work as a waiter, Ben?
So I actually worked as a lifeguard, and we were looking at some data on what occupations get tipped, and some people said that they actually tipped lifeguards, and I never got a tip doing lifeguarding.
I was a short order cook. I was a dishwasher.
I had jobs where I was
a stock
I got a
boy.
bonus.
I was a bus boy.
I did clean houses, or a house at once.
You cleaned a house once.
That's
Carol's
No.
work
I don't mean
experience.
just once, but I mean I had a job that regularly I cleaned a house. It was a gorgeous house, by the way.
All right. I think it's a great story, Ben, and I recommend everyone. Obviously, we didn't get to the other things, right? Overtime, you could game the system with that. No tax on Social Security. I was frankly surprised when I learned that people have to pay taxes on Social Security.
I know.
I'm against taxes in general.
Check out Ben's story. I also did inventory in a factory. I've done that.
All right, so you did a little bit of work.
I worked.
Yeah.
I just did different jobs.
That's good.
All right.
It's important. Teaches a little responsibility.
All right, coming up, some stocks that moved today. That's next on Business.
There was a correction.
You're listening to Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio and Television.
All right, let's take a look at some stocks on the move today. Bloomberg News equities reporter Nora Melinda here in our Bloomberg Interactive Brokers studio. Yep, we did have that 10% correction for the S&P. First time it's fallen into a 10% correction in almost 2 years because we've had such a run up in stocks. Having said that, a lot of names down today, but Intel was not among them.
They were not among them. They were in the green. We had a couple names in the green. So Intel was the best performing stock in the S&P 500 by percentage basis at the close. And this all comes after news that they were tapping a new CEO. And this is actually a veteran of the company. He was actually on the board. He's 65 years old, was on the board, but he stepped down back in August of 2024. So this is a quick turnaround, in my opinion. But we have shares that are up 18% year to date. But the stock did tumble a whopping 60% last year. And we know that this has really been an industry laggard when you think about it on the broader perspective in comparison to the likes of NVIDIA, AMD. And if you look
especially for somebody who used to be like a market leader.
This is true. It's been a fall from grace is how people have really been viewing it. And so people are really interested to see whether or not there will be a turnaround story here. But if you look at Wall Street, I mean, the stock has 4 buys, 40 holds, and 5 sells. So many people are really sitting here in the middle trying to debate what the outlook will look like.
By the way, there was a great story in the Wall Street Journal today about consumers getting hit at all income levels. So wealthy consumers and lower earners having real problems. That said, Dollar General did very well today.
That's true. And I actually read that story and I've been really just ruminating on the idea of that. So we have Dollar General. Shares finished 6.8% higher. This is the second best performer in the S&P 500 by percentage. And the CEO did talk about this. They talked about the fact that there's this trade down effect, which is essentially where people of higher incomes are actually going to discount stores to actually save some money as opposed to spending a bunch of money on other things and splurging. And then you also have like the lower income buyers who are actually pulling back on some essential items here. So it's a bit mixed here, but in terms of Dollar General's report, they said that its annual outlook was better than investors had feared. And so they're definitely encouraged by the plans to close some of the underperforming stores. But it's really important to note that Dollar General shares have slid more than 50% through Wednesday's close.
We also saw Dollar Tree, right? Higher.
Neither one of those in New York. We were looking this morning.
I heard there were 3. Didn't you guys talk about that on the show?
She said, Isabel Lee said there were 3, but then we looked a little harder and found she was wrong.
They're non-existent.
That was so that was the Herd on the Street column.
Yeah.
And they pointed out some stuff I thought was fascinating. Number 1, over the last 12 months, savings balances have declined across all income levels, and they're getting closer to 2019, like pre-pandemic levels.
Pretty significant.
Number 2, wage growth has slowed for all income groups over the past year. That according to the Atlanta Fed. And number 3, inflation-adjusted debt is rising past pre-pandemic levels. So it's not great. That's a little depressing.
Not good.
That reminded me of your interview with Doug Ramsey the other day from Luthold. Like, it's a real concern.
Yeah, that's actually worrisome. Those are pretty important metrics, right? And that's going to impact in terms of spending. And when the consumer pulls back, not a good thing.
Adobe.
Yes, let's talk about a name that closed in the red. We had shares down 14%. This is the worst performing stock in the S&P 500 today. It fell by the most since 2022, and this is after the company gave an outlook that was mixed in terms of comparisons to estimates. Analysts are generally positive, but Evercore did release a report that they said that it wasn't strong enough to change the narrative around the stock. And then we also have Jefferies noting that investors seem unimpressed by the new and removed disclosures that are hoping to give clarity on the AI transition. So we know that AI has really been a topic as of late, and that's something that people are being very critical for on Adobe here. But we do have shares that are down 15% so far this year.
Ouch.
You know what I'm looking at? I did an MRR on the S&P, and I'm looking at year to date because we got into a correction. The biggest losers year to date, I was pretty surprised to see the number 1 loser is Deckers on the S&P 500. I always confuse it with Trex, so I think people aren't putting Porsches on. You know, but it's not about
No,
porches.
it's
It's about shoes. I guess they own Uggs.
Yeah, they own a bunch of brands. Yes, yes.
The second biggest loser is Tesla. Tesla shares down
Not
40% year to date. Not a surprise. On Semiconductor is one of the biggest losers of the year, down 33%.
We had the CFO on this past, not this week, last Friday, we had the On Semiconductor. And actually, we're going to feature that interview with the CFO in our weekend.
What, in terms of like what not to do if you're the chief financial officer of a company?
They listen, they're working on things. They also just announced they're doing an acquisition. You're right. They're cutting jobs.
You know what the biggest gainer? The biggest
CVS.
Can you
I
believe
was
that?
gonna get to that.
Yeah.
Insane. And then Supermicro right behind them.
CVS up 46%.
Wow.
Maybe there's a turnaround in the stores. Usually I go in the CVS down here in the corner, somebody's sleeping there and everything's locked up.
Everything's locked up.
I love the coupons I get from CVS.
I need to check those out. Supermicro Computer, isn't that the company that like not even the auditor believed their books, so the auditor quit?
But they're up 28% this year.
And then Philip Morris International is the third biggest winner. Is that because of they don't own Zinn, right? They're not the ones that make the lip pillows, are they? Philip Morris International, but they must make some kind of chew or like
let's see,
smokeless tobacco product, because that's what's all the rage these days.
Smoke-free future, and it's evolving its portfolio for long term to include products outside of tobacco and nicotine. Actually,
yeah.
The more you know.
I used to chew Copenhagen all the time and
Doesn't
Kodiak.
surprise me.
You went to school in Virginia, so you're used to that.
In rural Virginia.
I have quit 4 years. It's been 4 years since I've thrown in a lipper.
Proud
but
of you.
I miss it. I miss it.
All right, this has been fun. This has been fun. It's been kind of fun to just watch this. All right, that's a wrap. Nora, thank you so much. Thank you for coming in.
It's been a pleasure, Carol Master. I miss Tim, and he'll be back tomorrow.
Maybe I'll have Tim here, and I'll leave.
To continue this conversation.
All right, that's going to do it for us. Balance of Power starts right now.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
From Bloomberg's Washington, D.C. studios to our TV and radio audiences worldwide, welcome to Balance of Power. Alongside Joe Matthew, I'm Kaylee Lyons.
President Trump says serious talks are being held with Vladimir Putin about ending the war in Ukraine, even as Russia stops short of committing to an immediate ceasefire.
If President Putin agrees and does a ceasefire, I think we're going to be in very good shape to get it done.
The president today meeting with NATO's Secretary General on Ukraine and America's commitment to the alliance. We'll discuss with Daniel Fried, former U.S. ambassador to Poland and former Assistant Secretary of State for Europe.
And we'll be joined by economist Catherine Edwards to gauge the impact of a new round of tariffs threatened today by the president on wine, champagne, and other libations from Europe.
And that is where we begin this evening. Thank you for joining us. President Trump threatening retaliation for Europe's retaliation against his fresh 25% tariffs on steel and aluminum. Writing on Truth Social this morning, quote, "The European Union has just put nasty 50% tariff on whiskey